search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City this morning. Good morning. Equity futures on the S&P 500 down on the session by about 0.1%, down on the month by something like 2.6% so far on the S&P. The fact that that's the biggest monthly loss since September tells you how good things have been for the equity market over the previous 5 months. Yields are higher by 2 basis points, up to about 463.23 on a US 10-year, and crude well behaved to end the month in the low 80s, 82.82, positive on the day by 0.2%. Under surveillance this morning, a ceasefire on the table.
Now, the quickest way to bring this to an end is to get to a ceasefire and the release of hostages. Hamas has before it a proposal that is extraordinarily generous on the part of Israel. And in this moment, the only thing standing between the people of Gaza and a ceasefire is Hamas. They have to decide. And they have to decide quickly.
Here's the latest this morning. Mediators urging Hamas leaders to respond to a proposed temporary ceasefire. The deal would see the release of Israeli hostages and delay an invasion of Rafah. Secretary of State Antony Blinken continuing his trip in the Middle East with stops in Jordan and Israel. Former senior U.S. intelligence official Norman Rule joins us now for more. Norman, what if I get you to get your perspective as always? I think we've heard this story a few times, and it's been a series of false dawns. Do you get the impression that this time is different?
Good morning. It is different. We are approaching an inflection point. Israel has completed its final preparations for an operation. The administration continues to state that its concerns regarding the humanitarian impact of that operation have not been entirely assuaged. But Israel is reaching a point where it's got to decide whether to go against Rafah or not. The deal that is made involves a number of significant concessions. Israel has lowered the number of hostages it is seeking, has increased likely the number of Palestinians it will release, and it will have a ceasefire that in essence provides Hamas with a victory of survival. So the next few days will be quite important.
Why would Hamas say no then to this deal on the table?
For Hamas, a deal is important because it allows survival, but at the same time, Hamas has got to decide within itself, has it reached the end of its ability to put pressure on the United States and Israel? If it decides it's reached the end of that point, if it decides that it faces a life and death moment with an Israeli attack, then it's going to be more likely to accept a deal. But if Hamas believes further concessions are likely, it will not approve this offer.
Norm, is a ceasefire, or does it just mean that it's on pause in terms of this Rafah invasion? Does this just push it back, or actually will Israel, if they strike this deal, not go in?
I think there are three different perspectives. The entire Israeli cabinet believes that it's important to eradicate Hamas's leadership and its capacity to be a military force. So even for those who support the ceasefire in Israel's cabinet, they're looking at something that is temporary. The United States is looking at a temporary deal that it can then extend into a longer ceasefire, permanent ceasefire for a political settlement. And of course, Hamas is looking for the withdrawal of all Israeli forces from Gaza and its return to power and in a permanent ceasefire environment. That's the dance that's taking place at present.
Norm, you're at the World Economic Forum special meeting in Riyadh right now, and that's a key place to answer a question that I had when I was reading some of the reports about the latest discussions, which is who's going to fill the void when Israel pulls out in this ceasefire? Is it going to be Qatar, Saudi Arabia, United Arab Emirates?
None of these partners, according to my discussions, are willing to take the lead in such an effort. It's just not a good thing to have Palestinians shooting at Arab forces or international forces. They're all looking for some sort of U.S.-led process by which they can participate in some way to allow the Palestinian Authority to reassert itself in Gaza and the West Bank. It's not entirely clear that the Palestinian Authority is prepared for that. Palestinian President Mahmoud Abbas spoke at the World Economic Forum. His comments were, let's just say there was not a lot of new there, and there wasn't a lot of indication that he has that capacity. But the conversations among diplomats here in Riyadh have been intensive and extensive on this issue.
But Norm, are you basically saying that if this ceasefire or temporary pause, whatever you want to call it, gets effectuated, that essentially U.S. troops could be on the ground keeping the peace in Gaza?
Very unlikely. U.S. forces are very unlikely to be involved in any on-the-ground effort. The Biden administration has been consistent in that regard. The problem is there is no other entity that's willing to step in. There have been discussions of maybe an international force, but those discussions really haven't gone anywhere. This is a work in progress and a critical issue to be decided.
Norm, anytime you have the Secretary of State, Antony Blinken, in Saudi Arabia, everyone starts whispering again about this idea of normalization. Are we any closer to that today between Riyadh and Jerusalem?
No, but we're no farther away either. The Saudis have made their position quite clear. They're looking for a finite, clear, and concrete path to Palestinian statehood, and that must be worked out by the various diplomats involved. And until that happens, and until they see that's going to occur in a manageable manner, they're unlikely to agree to restoration, or rather normalization of relations with Israel.
Norman, thanks for making time for us this morning. We know you've got a busy evening ahead of you. Norman Rule there, the former senior intelligence official. Let's just take the temperature of things in the commodity market. Crude on the month is high by 1.2%, which is pretty marginal stuff relative to what's actually taken place so far this month. People like Norman Rule saying this is a new Middle East. New lines have been drawn around the confrontation between Israel and Iran, and yet here we are with crude higher by 1.2%.
Especially given the fact that there was actually the specter of direct confrontation between Iran and Israel. And that was taken off the table, and maybe the de-escalation is what gave people confidence that maybe we weren't going to see true oil disruptions. What I think is interesting is that we're higher, 1.1%, on the fact that inventories have been taken down. There actually is fundamental reasons for there to be some feeling that maybe we could see higher prices unrelated to what's going on in the Middle East.
Few things. People are starting to erode some of that geopolitical risk they put into the price. And two, global supplies still have not been hit. There has been a tremendous amount of missiles flown back and forth, but actual supplies have not been hit. Until that happens, probably not going to see this market take off.
Yeah, you can sense the reluctance of this administration to do absolutely anything that disrupts global oil supply. That's the story with crude. Story with equities right now. If you're just waking up and tuning in, welcome to the program. Equity futures on the S&P down by just 0.1%. Plenty to talk about in the FX market. Coming up shortly, we'll catch up with Winthin of Brown Brothers Harriman as the BOJ accounts point to so-called yentervention. What do you make of that yentervention?
I don't like it.
No?
Actually, you know, it's kind of cute. It sounds like yenta. But it sounds like yentervention. What, you're going to go there?
You know, I've used it a couple of times in the last day. You think it works?
You think that you could use it for other things too? Ugh.
What like?
You're going to bring that into the conversation? Doing another yentervention?
Yentervention?
No?
No. I guess it doesn't work, does it? Through 160 yesterday briefly, gapping back down, trying to figure out what was behind it. Most signs point towards yen intervention.
Very good.
We'll talk about that in just a moment.
I killed it for you?
Thank you. Yeah, I think it's died. From New York City, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The month of May just around the corner, closing out the month of April with equity futures negative by 0.2% on the S&P, similar move lower on the Nasdaq 100, down on the month, down on the session. Over the next couple of days, Amazon later on this afternoon, Apple Thursday, you'll get about 10% of the index reporting earnings across just two names. That's the equity market. In the bond market, we look a little something like this as the first day of the Fed's two-day policy meeting concludes tomorrow afternoon, 2 p.m. Eastern Time. Yields are higher by almost a basis point. On a two-year, 498.30. On 10s, Bramo, 463.43.
It's a long-term trajectory that I find actually most interesting about the narrative shift in April. Essentially, people are talking about the idea that maybe rates are not restrictive and that maybe they could stay around here for a much longer period of time. If you get a Federal Reserve that indicates that in any way, if they get popped the question and they indicate the wrong answer, how big of a sell-off could we get if people truly have come around to this idea that earnings are resilient enough to keep this going even with rates where they are?
Given that Chairman Powell knows what question is coming in the news conference, do you think he fumbles it or not?
You know, you've asked this before, and in the past we've said no way, and he still fumbles it, right? So ultimately, I'm not going to weigh in on that.
Would you consider hiking interest rates? Yes, no, yes.
Yeah, intervention.
Yes. And then go
He
through
needs
the
to
paper.
practice.
Let's talk about the euro. Okay, the euro right now, 107.32, positive by 0.1%. Under surveillance this morning, the Eurozone exiting a recession with better than expected GDP data to start the year. Consumer prices also rising 2.4% year over year to meet estimates. The gains helped by an improvement in Germany as it faces a troubled industrial sector. Those troubles still persist, but ultimately, relative to expectations, surprises in Germany, France, Italy, and Spain, and the right kind of surprises this time around.
You put it well when you said basically, is this the U.S. becoming less exceptional? Is this basically a broadening out of what we experienced in the United States and the rest of the world, where growth is coming in better than expected, but inflation is remaining stickier than expected? And then how does the ECB respond to this? The euro doesn't know what to make of it, neither do we. But I think that the key is, just a question of, is this not just a U.S. story?
Euro's been dazed and confused for months now.
Yes.
But I'm with you. It's about how you close the gap. So you've got the U.S. up here, Europe and the rest of the world down here. Is it the U.S. coming down to the rest of the world, or is it the rest of the world coming up to the U.S.? And based on the data we had overnight, China, Europe, things getting, relative to expectations, a little bit better.
Absolutely. Things are getting better when you look at China and when you look at Europe. What's interesting, though, about China is you do see a lot of emphasis on exports, which makes you think that, oh, okay, what's happening on the domestic front? Where is that domestic demand? Interesting, an IMF official actually came out and said it's actually not overcapacity. Touring Asia right now and says it's not actually overcapacity, but they do need to do more when it comes to domestic demand.
Yeah, I think the Americans have got a very different perspective on that issue. Speaking of Europe, car makers, nothing good about it at all. More headwinds for EVs and a broader sector. Volkswagen, Stellantis, Mercedes, all reporting disappointing sales to start the year. Meanwhile, the information reporting Elon Musk is planning hundreds more job cuts, with 2 more senior executives set to leave Tesla. That stock is down by 2%. But listen to this, Lisa. Mercedes first quarter earnings down about a third. Volkswagen earnings down about 20%. Not pretty.
Electric vehicle demand down, and that's what we're really seeing across the board, but even in Europe. Let's link the stories. This idea we were talking about China and overcapacity and the IMF saying no. This is going to be the first time the Chinese president, Xi Jinping, is going to be coming to Europe Where is he going? He's going to come May 5th. It's the first time in about 5 years. He's going to France, Serbia, and Hungary. What's he probably going to be talking about? Buy our cars. This has been an area that has been less immune to some of the exports from China at cheaper price points. This, to me, is going to be interesting. Do they get some sort of division between the U.S. and Europe, or is this going to be something that's really focused on EU?
60, 30, 10. China, Europe, U.S. That is where sales are when it comes to EVs. So China and Europe really need to start buying more in order for these car companies to do better. And you can see that across the board in the auto sector.
Attempted to open some more BYD factories and get the brand. Yeah, do you know what? Are people actually going to buy the brand, though, in places like America? You're going to buy the brand China? BYD, is that really going to take off? Even if you didn't have the walls, you lowered them. Even if they are really cheap, is that going to take off?
It's not going to happen in the U.S., but it might happen in France, in Serbia, in Hungary. And I think that's the reason why it's telling that Xi Jinping's over there.
In Italy, the presidency of the G7 is looking at potentially opening up a BYD plant, yet they ditched Belt and Road. What's the difference? I don't quite understand. But to Sarah Hunt's point yesterday when talking about the iPhones, that luxury appeal of a brand, similar point you have to make by BYD. BYD is not the same, I think, in a lot of Western minds as a Tesla.
As Lisa said, May 5th, the Chinese leader heading to Europe. Let's finish on this. Secretary of State Antony Blinken continuing his trip in the Middle East, making stops in Jordan and Israel. Blinken urging leaders of Hamas to accept a deal which would release Israeli hostages and delay an invasion of Rafah. This marks Blinken's 7th trip to the region since the Israel-Hamas conflict began last October. Amory, there's a sense this morning that this time might be different. We might be closer to a deal.
And that's because Secretary Blinken came out and said this is the most generous deal that Israel's putting on the table. What I was talking to individuals last night, a lot of individuals from the region, is that you have representatives from the United States, Hamas, Qatar, and Israel all going to be in Cairo today. And then yesterday, the president got on the phone with El-Sisi of Egypt and Sheikh Al Thani of Qatar. A lot of pressure from the United States on all of these countries or teams to accept this deal.
We'll return back to this story throughout this morning. Let's turn back to foreign exchange and the yen falling against the dollar following new accounts from the BOJ indicating it likely intervened on the currency yesterday. Joining us now to discuss is Win Thin of Brown Brothers Harriman. Win, is it sufficient even if they did intervene in this FX market?
Hi there. First of all, again, thanks for having me. I always enjoy coming on your show. My short answer would be no. I continue to go back to monetary policy divergences, and that's what's really been driving dollar yen higher, especially with this latest round of Fed hawkishness, coupled with really a quite dovish hold from the Bank of Japan last week. That invited further dollar yen buying. The market didn't disappoint. I guess I'm a little disappointed that the Bank of Japan didn't think this out, or doesn't appear to have thought this out quite clearly, because they even made a specific mention of how the weak yen wasn't impacting inflation yet. Again, another invitation to take dollar yen higher. So until something happens, either on the Fed side, it gets more dovish and starts cutting rates, or on the Japan side, the Bank of Japan side, where they start getting more hawkish and hike rates, I can only see dollar yen going higher.
When people like to throw around the word crisis, particularly in financial media, crisis, currency crisis, what would a crisis look like? And do you think we have the ingredients for one?
Again, I'll give you a short answer, no. I think, it's always, markets are always looking for the next sort of shoe to drop or some sort of trauma for the markets. But, the strong dollar is a problem for many countries, but it's not a crisis. I think if we start to get sort of dislocations in other markets, say the JGB markets or the U.S. Treasury markets, something wider than just this exchange rate, we could maybe start talking about a crisis. But I just don't see the seeds there. This is really it's a strong dollar issue. It's not just Japan. We know that Korea is complaining, others also, especially in emerging markets. But I don't see anything like a sort of a plaza type accord emerging anytime soon. The movements just haven't been that large or that disruptive yet. But again, it's worth keeping an eye on.
When the idea of $40 billion, $50 billion, $35 billion of yen intervention, not significant in the scheme of things. The idea of hiking rates, much more significant. Do you think that puts this back on the table for the Bank of Japan in a more material way?
Well, yes. I think, again, they delivered such a dovish hold last week that I was really quite shocked, because they knew that the currency markets and the markets were looking for something more hawkish. So the first sort of next step would be a more hawkish forward guidance, because right now the market's only pricing in something like 50 or 60 basis points of tightening over the next 2 years, which is obviously a very shallow tightening cycle. And again, the Bank of Japan's guidance hasn't helped. But overnight, we had some soft data from March IP, retail sales, housing starts. That sort of underscores why perhaps the Bank of Japan is being cautious. But again, you can't have your cake and eat it too. If you're going to be dovish, you're going to have a weak currency. If you want to really, really put a floor under your currency, I think you're going to have to hike rates. And at this point, I think the Bank of Japan is still gun shy. I mean, think about it. The last 2 times they've tried to hike rates, Japan has fallen back into recession. So I understand why they're being so cautious. But again, there's so many moving parts. I just don't know if this how well thought out this policy path has been.
There's a broader point here, and it's a real question that we've been asking all morning. This idea of, as John said, is this basically the U.S. exceptionalism running out of being exceptional and the rest of the world kind of coming to that same place where growth is stronger and inflation is stickier, and that means higher rates globally, where a lot of central banks cannot lower rates nearly as much as many people previously expected. Is that basically what you're looking at in this mishmash of foreign currency moves that basically have left all of us scratching our heads?
Yeah, that's always the problem with foreign exchange. You know, it's not an absolute story. It's always a relative story. And the U.S. exception is absolute in the sense that the growth is multiples of what we're seeing in Europe or elsewhere. But the relative story has shifted recently. I have to say the one thing I did get wrong in this last cycle is that I think the UK and Europe has been more resilient. I thought they would be in a much deeper recessions. And we're already seeing, obviously, the European data out earlier today. That was quite shallow. But when I still step back, it's still hard for me to get excited about Europe. I still think there's a lot of headwinds. You know, Europe is much more dependent on China. I remain very negative on China, despite some signs of life there in the economy. So maybe we're not quite as exceptional as we were before here in the U.S., but we remain, I believe, relatively exceptional. I still like the dollar higher. The Fed is going to, I think, deliver a very, very hawkish message tomorrow. You were joking earlier about whether Mr. Powell can sort of stick on script. I'm pretty sure he's going to have it written on his hand. Don't say anything about cuts. And if he sticks to script, I think that we'll be okay. But I really, I think markets are always in for some kind of dovish slip from Mr. Powell. I continue to think they want to do an insurance cut or two this year, but the data just won't allow them. And so it's sort of a waiting game to see how the economy evolves.
Let's pick up on that final point. You said he's going to be very, very hawkish tomorrow. What do you think that actually sounds like? What do you think he's going to say?
He is going to, I don't think he's going to say the H word. I believe the hike word is not really in his vocabulary at this point, but he will continue to say that the rate cuts are going to continue to get pushed out. Remember, earlier this year, he was saying, well, we're going to cut rates sometime this year.
Yeah.
And it sort of said there's coming soon. But he can't say that. He's going to really just say, look, it's all going to depend on the data. The data are not allowing for a cut right now. We don't have confidence that inflation is going to the 2% target relatively soon. Again, these are all things that the Fed officials have really talked about before the blackout period. And so I see a continuation of that. Nothing has happened since the blackout period began that makes me think they have to change the script. The data remains strong. We're looking at 250,000 plus jobs this Friday. Inflation remains sticky and actually higher. So to me, it'd be very, very difficult for the Fed to deliver anything short of a hawkish message tomorrow.
We've got a show to promote tomorrow, Win, and you're not helping. You're basically describing a guy who's going to sit there with one hand, don't cut, don't say it, and on the other hand, don't say hike either. So this is going to be fun. Win Thin of Brown Brothers Harriman. Win, thank you. Looking ahead to the Fed tomorrow afternoon.
This feels like preschool or kindergarten.
You think?
There's the H word, there's the T word, there's the C word. Don't say hike, don't say transitory, don't say cuts. Just sit there like a deer in headlights and say, hi, we're the Fed.
TK would always say it, just reach for the notes. It's going to be one of those news conferences, isn't it? Just reach
or
for
your
the notes.
palm is from Win Thin.
Yeah, apparently your palm as well.
Just don't wash your hands. Honestly, look, I personally think he has to come out, and this is Julian Emanuel's point. Doesn't he want a sell-off? Doesn't he want to prolong the sell-off in order to get inflation to a place where they can do some of the cuts that they're looking for? And if he is willing to do that, well, then why not come out and say the H word?
If you'd said that back in August 2022, I would have said, yeah, that's exactly what he wants now. Ask him where financial conditions are. Ask him if he thinks they're loose or tight, and he'll tell you already he thinks they're tight. He thinks they are sufficiently restrictive.
John Williams went there, and John Williams is dovish. John Williams said the H word. He said he would consider it, so I wonder if that sort of paves the way for that to be washed off his left palm.
Let's see how they navigate that tomorrow in the press. Some headlines coming from the Prime Minister's office in Israel. Benjamin Netanyahu saying this: we won't stop the war before achieving all its goals. Bear in mind, these comments are coming against the backdrop of ongoing talks between Israel and Hamas, and a lot of experts around this story suggesting we might be very close to some kind of ceasefire. And going on to say this as well, Anne-Marie, we will enter Rafah. We will eliminate Hamas battalions.
So this says to me that even if they get an agreement on the table, Netanyahu is determined to go into Rafah and make sure that every last bastion that Hamas holds is eradicated, which these kind of comments, as they're sitting down in Cairo, potentially their representatives discuss this deal, could potentially mean the deal would be off. To Norm's point, a ceasefire is a ceasefire, but until what point? Does this just mean 6 months and then potentially Israel recalibrates and goes in? We're not sure yet. We have to wait and see.
The objectives have not changed, according to the Prime Minister's office. Let's get you some stories elsewhere. Let's get to your Bloomberg brief now. We can catch up with Danny Berger. Hey, Danny.
Hey, John. Elon Musk's wealth is once again climbing the rich list. Tied to the performance of Tesla shares, Musk gained more than $37 billion in net worth in the past 5 days. That according to the Bloomberg Billionaires Index. Now, off the back of news that he had gained support for his driver assistance program in China, Musk added $18.5 billion to his fortune yesterday. He now has a net worth of more than $201 billion, and he's close to overtaking second place Jeff Bezos. And we're still talking about return to office. This time it's Macy's. They've issued a mandate to corporate employees, get back to the office or face disciplinary action. The company informed its hybrid employees that they will need to be in the office 2 days a week. That will start May 13th. That according to people familiar with the matter. Macy's is giving employees a 3-month grace period to move back to the New York City area. And if they haven't returned by then, workers will risk consequences, including termination. Cocoa prices plunging by the most ever. They've fallen by nearly a third in 2 days. Don't forget they surged more than 100% this year alone. But the price swings are becoming more extreme, and fewer investors and companies can maintain trading positions. A supply deficit had made cocoa more expensive than copper this year, but now liquidity has drained from the market. That's your Bloomberg Brief. John.
Summer diets everywhere, Bramo.
Exactly.
You said it as Danny was speaking. Danny, thank you. As Danny was speaking.
This is Operation Tread.
Absolutely.
Like surveillance.
Going into Memorial Day weekend, of course. Up next, slim odds. There you go. For the Fed's first cut.
As the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, the Fed easing later this year.
These jokes are getting so much worse. That conversation's just around the corner, live from New York. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Equity futures on the S&P 500 pulling back by just 0.1%. No drama here in the equity market this Tuesday morning. Yields are higher by a single basis point on the 10-year 463, and the euro advancing. GDP a little bit better across the top 4 Eurozone GDP economies. The countries, France, Germany, Italy, Spain, all doing better than expected. 107.28 on a euro right now. Under surveillance this morning, slim odds for the Fed's first cut.
The labor market is also getting into better balance in terms of supply and demand. As the labor market gets into better balance, that should slow the rate of wage growth, and then that brings back down the super core rate of inflation. So that's kind of what we're looking for in terms of, you know, the Fed easing later this year.
Here's the latest this morning. The Fed's two-day meeting kicking off with the central bank widely expected to hold rates steady. A string of hot inflation prints and labor market strength setting the stage for Fed Chair Jay Powell to make a hawkish pivot. Claudia Sam of Bloomberg Opinion writing this. The strong economy does not complicate the Fed's fight against inflation, nor is it a reason for the bank to delay rate cuts. Notwithstanding 2024's bumpy start on inflation, there is reason to believe that the trade-off between demand and inflation is weaker now than in the past. The brilliant Claudia Sam joins us now for more. Claudia, let's go to that final point first. I'd love to get some thoughts on that. What are the forces that is changing that relationship between demand and inflation?
Well, first and foremost, the pandemic came through the economy and disrupted us in ways that we have not seen in living memory, right? Like this was fundamentally a different kind of, really twist and turn the ability of the economy to produce. One that was really important that we unwound last year is we had a notable labor shortage. People left the labor force at the beginning of the pandemic. Last year, we brought a lot of workers back. That's a big reason why the U.S. economy could grow and not be inflationary, like push inflation up more, because we could produce, we could meet that demand, right? That is not, when you have supply disruptions, you have the opportunity to fix them. We did that with the labor market largely last year. And then you can get these two pieces together, right? And it is unusual. Usually it's that we got demand out of control and it's hard to get supply. This time we fix things on the supply side.
It's been impressive to see how that's played out over the last 12 months. Could we focus more on the last 3 or 4? Claudia, the Fed seems to be preoccupied with the recent upside surprises of the start of 2024. They've described them initially as bumps in the road, and now they're starting to sound a little bit more concerned. Why shouldn't they be concerned by these positive surprises, so-called upside surprises of the year so far?
They should be concerned about everything. I mean, we all are staring at every month of inflation data that comes out. We did learn, especially last week, that January was the month that was just a mess, right, in terms of inflation really picking up. We didn't see the path back to a real disinflation in March. I think that was the disappointment. That's one that Powell really seemed to think we were going to get back on track in March. We didn't. And so, yeah, I mean, I get it, but there's a lot of pieces left in inflation, like the owner's equivalent rent that we talk about, the vehicle services, the vehicle insurance. It's like, what level of interest rates do you need to get those things down in a sustainable way, right? They're very complicated. They also have the supply aspect. And with the shelter costs, they're very backward looking.
What's the upside, Claudia, though, of Fed Chair Powell saying the C word? I mean, we've heard basically we're playing kindergarten Federal Reserve version. We're talking about the H word hike. Is he going to entertain that? Is he going to talk about the T word, transitory? No, that's absolutely a dirty word. C word, if he talks about cuts, I mean, what's the benefit to him?
There is none. I mean, really, if he opens his mouth, there's all downside risks, right? Like and this is, I think, to a place where we all want certainty. We all want, and we look to the Fed as some oracle, which we should not. And thus, what comes out of his mouth, what comes out of Powell's mouth, people want to grab onto. They want to hear, but they want to hear. And off and running they go. Powell will aspire to be the most boring he possibly can tomorrow. I can't imagine the Fed wants to move the markets out. I mean, less than 2 cuts. 2, 1, 0, like the September meeting where that could get started with 2, they have 5 more CPI prints. That is forever. We could be back in the why haven't they cut yet discussion. I mean, like things can move very fast, and what possible reason does he have to like reset expectations? Like just, take a breath. This was disappointing. We don't know what comes next, and he will totally emphasize the data driven. If the data gets better, things get better. They get worse.
Well, stay tuned tomorrow, because tomorrow afternoon we'll be covering Jay Powell as he attempts to be the most boring guy in the history of the Federal Reserve. Claudia, I'm curious, though, as you talk about this idea of the Fed kind of being in a bad spot either way, they do have some communication that acts as forward policy, as monetary policy. And there is a theory, and Julian Emanuel was talking about this, that if there was a sell-off, more protracted sell-off in equity markets and risk markets, that could help the Fed get to their goal of lower inflation. Why do you disagree with that?
The Fed has really struggled, and this makes sense, they have really struggled to fine-tune forward guidance, right? It's like it's very hard to predict what the markets are going to do, what they're going to go off and running about. As was said before, Powell has looked at this economy and said interest rates are restrictive. We are putting downward pressure on the economy, and you can see it in some interest rate sectors. So do they know exactly, do we want to be 25 basis points higher or 50? You know, I think it's just you're wading into territory that it can just get away from you. And so I think he'll just repeat, we're in a restrictive territory and they're ready to do whatever it takes to get inflation down.
Claudia, when you talk about we're seeing the biting of some of the higher rates, we're not seeing it from some of the biggest companies. They're still reporting earnings that are delivering enough of a positive surprise that people are enthusiastic about the prospects for corporate America. Do you think that this Fed should err on the side of protecting smaller businesses, of protecting a whole host of consumers that are more affected disproportionately by higher rates at the expense of a higher long-term inflation rate in the United States?
The Fed's mandate is for the country as a whole, right? So they are not set up in a way to pinpoint certain groups of consumers, certain groups of businesses, and say, we're going to give you relief on interest rates. They're focused on getting inflation down. I think the one thing that speaks to we don't need to turn the cranks that much is, I mean, we are within less than a percentage point of their goal. Right, like we're not at the 5% of core inflation, core PC inflation that we were, you know, back before the disinflation started. So we don't need to get too worked up here about 3 months of data, and yet take it very seriously, right? If it gets stalled out here, this is a problem, and the Fed will adjust course. It's just like swinging around this much expectations in markets, it feels overdone.
Claudia, appreciate your insight into the story. Claudia Sam there of Sam Consulting on the Federal Reserve and Chairman Powell tomorrow afternoon. If he opens his mouth, there's downside risk. That's going in the promo too.
100%.
It's quite a start to this morning, isn't it? Day one of the two-day meeting of the Federal Reserve. Tune in at 2 p.m. Eastern tomorrow for
the most boring guy on
Okay,
earth.
wonderful. The politics, I wanted to talk about the political calendar. Another note, this time from BNP Paribas. The economics team over there saying this: delaying the start of the cutting cycle to July, if you can call it that, while remaining of the view that the presidential election likely precludes a cut in September. Consequently, we now see the Fed implementing its first cut in December. So they pushed out to July, they're pushing it out to December now. Lisa, it keeps coming up again and again, the importance of September and the lack of willingness to do anything at that meeting.
Given the fact that historically it's always been a bad move. I mean, if you think about it, right before an election, you've been talking about this, Anne-Marie. So it's basically July or December.
Conversation continues in the next hour on Bloomberg Surveillance. Dan Greenhouse of Solus, Bloomberg's Craig Trudell, Geetha Raghunathan of Bloomberg Intelligence, and BlackRock's Amanda Lynham. Equity futures recovering just a little bit softer. This is Bloomberg.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kayleigh Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There's very little room for the Fed to be particularly dovish or quick in terms of rate cuts.
As long as we've got a reasonably strong economy, I think the market can handle the Fed just sort of staying steady.
The market has already started to game out the Fed decision. They've already started taking rates off the table.
July is probably looking a little bit soon. It's a tough hurdle, but they'll still probably be able to cut this year.
Could they cut rates in September? If things are slowing down enough, then yes.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, equities recovering just a little bit. Equity futures still negative by 0.04% and down hard on the month so far, but a little bit of perspective. Yes, this is the biggest monthly loss potentially since the end of September. Yes, we're down by something like 2.6%, but really, this is really about the 5 months of gains previous to this, prior to this, Bramo, which were just out of this world.
Down so little to me. The fact that we're down so little is to me really telling, given the fact that we saw some pretty big misses on a number of the tech stocks. To me, the swinging around of the tech names is really interesting. We haven't talked enough about the fact that Amazon's coming out after the bell. What if they miss on AWS?
You missed yesterday. 24 hours of it.
Okay.
Just Amazon on repeat.
You know, I actually watched the show, and I know that that's not true. So I'm going to call you.
Did loads of Apple as well on Thursday.
I know.
We did.
I know you mentioned it.
We did a whole segment with an analyst.
I saw that. I did watch it, and I will just say that I think that everyone yesterday was talking about how.
Why are you tuning in on your day off?
That's what my question was.
Because I love you, and this is where I get my information. So there you go.
Too.
I think that this is really important. You know, it goes back to whether Fed Chair Powell is going to pop the question today, but yesterday it was all about
love and proposals.
Yeah, but it was all about yesterday why it wasn't going to matter what happens there, and it's all about earnings. So today it's almost flipping the script completely.
We've missed you, Bramo. Let's talk about bearishness in the bond market. Let's get to the month so far. The 2-year and the 10-year, we're talking about moves of 30-plus basis points and moves of 40-plus basis points on both a 2-year and a 10-year. If I told you at the start of the month that's the move we'd get, we'd get more hot inflation prints and we'd reprice the yield curve higher this way, would you have guessed that equities would only be down 2.6%?
This has been the story. To me, this has been the issue, is the narrative shift around how much of higher rates can this equity market tolerate. And it turns out quite a bit. We heard that from Max Kettner this morning, kind of putting a bow on it. They're getting more sort of bullish on certain risk assets because, hey, guess what? Rates are high for the right reason. How long does that last? Depending on whether or not Fed Chair Powell, who tries to be the most boring person on earth tomorrow, uses the H word.
I just pulled up Max Kettner's note, immaculate high for longer. This idea of immaculate disinflation, perennial Goldilocks, has given way to renewed inflation fears. And that's what makes Powell's job so much harder. But already he said enough where the likes of Jay Pawlowski said, this Fed story this week, already in the rearview mirror.
Backseat to the data and the earnings a little bit later this week. Amazon, really important after the bell.
Thank you.
A little bit later.
That's
I
true.
did that a few times. Come on.
Really
important. How many times do I need to do it this morning?
I just want to know, are you paying $2.99 for the subscription?
You want more? More. Really important after the close a little bit later. Coming up in a moment, you heard him. Dan Greenhouse of Solis joining us shortly with stocks poised to snap 5 months of gains. Geetha Raghunathan of Bloomberg Intelligence on the upheaval at Paramount, and BlackRock's Amanda Lynham on what the Fed's path forward means for credit. We begin with our top story. Stocks on pause awaiting earnings, economic data and a Fed policy decision. Amazon kicking off things today, followed by the Fed decision tomorrow. Then it's on to Apple on Thursday and a jobs report on Friday. Dan Greenhouse of Solis Alternative Asset Management joined us around the table. Dan, tell us how important Amazon is after the bell.
It's pretty important. I think we need to talk more about it.
Apparently.
It is. I mean, it is important. It's obviously one of the largest stocks, and it has a few different touch points. Obviously, AWS being the crucial driver for the stock and its performance in the index, but also its touch point with the consumer, et cetera. So, of course, it's important. But I think any number of other companies, McDonald's just reported, also important. And I think that the focus on those names does something of a disservice to the information that can be provided by a host of other companies, of course.
Do you think the focus should be on the earnings and not on the data or the Fed this week?
Well, no. Right now, the focus is on the Fed. And I think getting back to the point about the strong rally that we've had off the low, why are we pausing here? Now, obviously, it comes in the context, as you mentioned, of the big rally off the low, but we're pausing here because of the Fed, because of inflation and those concerns. Earnings season has been going well enough, not awesome, but pretty good. And so obviously right now that's the focus. And so I think, the Fed meeting on Wednesday becomes crucially important. I think he's going to be boring because after all, he is the Fed chairman and there's no other mode but boring.
Speak for yourself. I find that really interesting,
well,
frankly.
We find it riveting because we're nerds.
Okay, we'll put that aside.
A normal person would watch Jay Powell and think this is the most boring thing I've ever seen ever.
I don't have any issues. But look, I'm just wondering, you actually said in your note that basically the ultimate level of rates isn't going to matter, that it's the adjustment period. And that, oh yeah, guess what? You're going with the narrative that 5% in terms of where yields are right now, benchmark rates, isn't that problematic for stocks? So how do you sort of pair those two things with the importance and the interest that I personally have in Fed Chair Powell tomorrow?
Well, okay. First of all, I share your interest. Right. I assume the rest of the table does as well. You don't have a monopoly on being a nerd. But that said, I think don't take my word for it on interest rates. As this conversation has gone on for the last couple of months, I sit here and I seem to be the only one on financial TV making the point. Interest rates have gone straight up all year long. From 420 to 5, there's been an 80 basis point move. Basically, pick the 2, pick the 10, your choice. It's basically been an 80 basis point move. We've repriced. Everyone keeps talking, well, we were expecting 6 cuts. Now it's only 2, maybe 1. And the stock market's basically at a high. You mentioned we're down a little bit, but no big deal. It's obviously not been a problem thus far. I don't know why another 20 basis points or 10 basis points is the straw across the proverbial camel's back. I think the economy has done incredibly well relative to what we certainly thought. And I think the stock market similarly has done well. Not I think, it clearly has. And so I don't understand why, getting back to your point about the short term, I think there's an adjustment period here where we're in a bit of an uncertainty, obviously. Inflation was stickier for a month more than we thought. And obviously we can parse that data out and say, well, if you X out this or you X out that, it's not that bad. Fine. But the inflation data has been a little more persistent than we thought, at least according to the CPI, not as much the PCE. And so I think we need to hear what he has to say, how he characterizes the environment before the market can resume what I think will ultimately be another push higher.
Do you believe that the market's rally in the beginning of this year off the Fed pivot late last year actually is responsible for some of the stickiness in the inflation data we've been seeing?
Yeah, you know, I find it difficult to disaggregate. I think yes. How much of a contributor is very difficult to prove out in the data. I think in retrospect, the enthusiasm for rate cuts before the data and the environment clearly called for it was probably incorrect. And when I say probably, I mean even at the time, there was a lot of confusion about what's the rush, so to speak. And I think the rush was, well, we want to start cutting rates before the election, sufficiently far away from the election, assuming the data cooperates. But characterizing it in the way that they had, probably not the best. And I think in retrospect, certainly, but even at the time, you could have waited another month or two before you started getting enthusiastic about cutting rates in June. And my final point on this is, having done this as we all have for a few decades now, good Lord, the fear of markets. Oh, we don't want to be seen for playing market. We can't pivot. I find it silly. You could have gone another month or two before you started signaling, hey, we're interested in reducing rates as soon as the summer. The rush to do it when they did, again, was probably premature.
But they rushed to do it because they thought the data was good then. So the bumps, does that basically mean potentially that's a trend, 3 months of bumps?
Well, yeah, the data was good, but the ultimate reason was they thought the data would continue moving in the old skate to where the puck is going thing. What an awful word to have used. But
Gretzky, I'm with you. We're following.
You know. They thought the data would go in a certain direction. Obviously, it has not. January and February was supposed to be an aberration. At least in the CPI, it was not. March was a little hotter. But the PCE has been better. And I think, again, if you parse out that data, it's not as bad as the headlines have suggested, but neither is it good enough that you feel comfortable cutting as soon as the summer. And I think that's the quandary in which they find themselves.
Can you tell us what you've been doing in credit recently? What's activity been like?
Yeah, listen, the credit markets have been strong. I will say, as a traditional high-yield distressed manager, there hasn't been as much distress, and you might not be surprised to hear that there aren't too many defaults, aren't too many of those bankruptcy situations, given how strong the economy has been. There have been, of course, one-offs here or there, but the default rate remains pretty low. So across credit, it's a lot of rel-val. It's a lot of finding thematic trades, not dissimilar to what you see in the equity market. But I have to say, we're spending a lot of time in the equity market. The returns potential seems more attractive to us on a relative basis.
Interesting. Why?
Well, for instance, we've been pretty optimistic on the energy space. As a fund, we've been pretty optimistic on the energy space. And from a return potential standpoint, it's been more attractive to be positioned in equities across the capital, across the market cap spectrum, as opposed to the credits. Now, mind you, again, energy, distress, high yield, not really a thing anymore because we blew up the entire space and restructured and merged, et cetera, et cetera. So to get yield, so to speak, dividend plus buyback, et cetera, you can do pretty well in the equity market, and I think we've been pretty happy with that performance.
We'll have a conversation with Amanda Liner of BlackRock, a little bit more detail on credit later, but can you just describe some of the price performance, the price action within high yield? We've been looking at spreads still super tight. Are the lower quality credits being left behind? Are there some worries about the ability to refinance later this year, going into 25, if rates stay at these levels?
No, from a performance standpoint, lower credits have done better. And again, that's commensurate with the risk-on environment that you've seen in equity, although in equity, obviously, the higher credit, so to speak, the large cap equities have done the best. But you've seen spread compression, you've seen outperformance on the part of triple Cs, double Bs, et cetera, which again speaks to the broader economic environment which has held in there, but also the quality of the high yield market. This is something that I'm sure you've talked about with any high yield manager who's come on here. The market is just, this is not your mother's high yield market. Not that my mom was in the high yield market, but it's a much higher quality market from a rating standpoint, from a leverage standpoint, from a cash standpoint. Everything about the market is better today than it has been in most periods throughout history. And so when people say, oh, look at the high yield market, it's telling you X, Y, and Z, it's very hard to do that comparison to history. Not dissimilar to what you see in the equity market, given the size of those large cap names.
To put on a bow on it, are you willing to say that right now all the people who are saying that this is a golden era for credit, at least in the public space, are wrong, and that actually equities hold a better risk-reward kind of value? Or are you just saying that in specific asset classes, like within the industry of energy, you're seeing better value in equities?
I look at things thematically. I have, it's a joke almost at this point to say it's the golden age of private credit, but in some respects it has been a golden age for risk assets. And I think that's borne out in the data. It's borne out in the performance. You do have a robust economic environment. The consumer has been quite strong. All of this is incredibly surprising. No, I don't think one asset class is necessarily more attractive than another on a permanent basis. Although typically, obviously, higher risk assets generate higher reward over time. But I think at this moment in time, for the last, call it 2 years or so, on a risk-reward basis, on a relative value basis, we've just been finding more opportunities in the equity space. It's not just energy, it's a lot of consumer-focused stuff as well. I think one of the ways that we positioned ourselves a couple of years ago, there was all this focus on the dwindling excess excess cash in consumer bank accounts. That never made sense to us. The consumer always seemed very, very strong, and there was always this we were always waiting for the next shoe to drop, and the next shoe never came. And so we found a lot of beaten up leisure and consumer-focused names to be extremely attractive, and I think in a lot of respects they remain so today. I can't say specifically what they are, but I think there is it's not a secret, some of the things that I'm talking about, I guess.
We won't ask. We won't ask. Dan, this was great. Dan Greenhouse there, son of prolific high-yield credit investor and member of Solace Alternative Asset Management. Dan, thank you.
Thank you for having me, as always.
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. 2 traders in Hong Kong have left SocGen. The French bank discovered perilous bets that went undetected by its risk management system. SocGen didn't lose any money from the transactions, but the trade could have costed hundreds of millions of dollars if there had been an intense market downturn. China's top climate chief Liu Zhongming is set to have his first official meeting with his U.S. counterpart. Tensions loom over issues ranging from chips to clean tech. Liu spoke with Bloomberg's chief North Asia correspondent Stephen Engel in Beijing.
That's one of the worry in this climate change community. I definitely hope that the American people will support the government to stay in the climate change process, stay in the Paris Agreement, even Trump wins the next election.
Treasury market fragility is only going to get worse. That, according to a new report from Barclays, with more frequent bouts of illiquidity, poor functioning, and heightened volatility. It's the continuation of a trend underscored by the COVID-induced dash for cash. Several things are going to make it worse this time around, including increased Treasury supply and complex dealer constraints. The strategist writing, quote, "The substantial supply of Treasuries means that regulators and investors are fighting an uphill battle." That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. We'll catch up with Danny in about 30 minutes' time. Up next on the program, Tesla's bumpy year.
Elon Musk saw an opportunity to go in there and say, look, I want to do this, because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides. To me, this is a way to say, I'm going to change up this math for myself.
Why more job cuts could be just around the corner. Live from New York City this morning. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Equity futures on the S&P negative here by 0.05%. In the bond market, yields higher by a single basis point. On a 10-year, 462.81. Under surveillance this morning, Tesla's bumpy year.
Elon Musk saw an opportunity to go in there and say, look, I want to do this because you've seen the clashes that have been going on between the U.S. and China. He's trying to put a foot in both sides, and all of a sudden the EVs in China started to get less expensive, and Tesla started to lose share, and he had to drop prices. So to me, this is a way to say, I'm going to change up this math for myself, but also if I can be successful in this, then maybe I get to be the outlier.
So here's the latest right now. Fresh off a breakthrough for its self-driving unit in China, Tesla is said to be considering more job cuts, with 2 senior executives set to depart the company. According to the information, CEO Elon Musk will dismiss everyone working for those executives, with only a few set to be reassigned. Bloomberg's Craig Trudeau joins us now for more, with that stock down 1.8%. Craig, what exactly do you think is going on?
Yeah, this is a report by The Information. We should credit them for this information, I guess. The 2 executives that they're getting rid of the 2 that are most interesting to me is the executive who was in charge of their supercharger team, because this is really a sort of crown jewel within Tesla. This is a company that really has prided itself on not only making electric vehicles that people want to buy, but making the infrastructure that's going to sort of facilitate interest in electric vehicles beyond just early adopters who are willing to try out something new and, you know, cope with experiences of having to wait for a plug. I think it's also just really interesting timing in the sense that, you know, in the U.S., the rest of the industry has really embraced Tesla's charging standard that they've tried to sort of make a certain their proprietary plug open to the industry and get everybody else on board with, you know, changing their plugs to you know, fit with Tesla. And then, you know, the rug is seemingly being pulled out from under the rest of the industry in the sense that the person who was leading a 500-person team, according to the information, is gone along with her entire team.
Well, the rest of the industry is struggling. I'm just going through the numbers that you've been going over this morning in Europe. Mercedes first quarter earnings down by about 1/3. Volkswagen earnings down by about 20% in the first quarter. Craig, are they struggling with the same issues that ultimately Tesla's been struggling with over the last few quarters?
I'd say yes and no. I think that it is absolutely the case that, you know, the higher borrowing costs that, you know, Elon Musk has cited over and over again as the reason for their slowdown is certainly being felt by the whole industry. And I think we are just in a sort of new era of, you know, back when the chip crisis was really restricting these companies' production, they had more demand than they were able to meet. That is over. We are now in a situation where everybody is producing more cars than they have demand for. That's going to mean pricing pressure, and we've seen that more acutely with Tesla. That's where I would draw the distinction, where EVs in particular, I think, have had a much more substantial come down in price that has hurt Tesla more so than it has damaged the rest of the industry.
China seems to be the juggernaut here. I mean, they're the ones that are producing electric vehicles more cheaply and more rapidly than anywhere else. How important is it for Tesla that he got this at least tacit or in principle approval for its driver assistance system to be deployed in China. What do you make of this? That essentially you've got Elon Musk kowtowing to Xi Jinping because is that really the only way that this company can regain some of its clout?
It's a fascinating story. I think it was obviously a huge success in changing the narrative, right? We've just been, seeing, day after day evidence of this company's earnings, earnings power really falling apart. And we've seen, just in the last few weeks, Tesla cut pricing in China yet again. Analysts, casting doubt as to whether there are any earnings left for Tesla China and their operations. There is, some potential here to get more incremental revenue out of each car they sell, or even their existing fleet by getting people to pay for what they market as full self-driving, their driver assistance system. And yet, I think there are some real questions about, just how long it's going to take for that, sort of in principle approval to be, a hard and fast approval. There are questions about how much they're going to be able to charge. I think just as there's pricing pressure for the vehicles themselves in China, I think, these driver assistance systems are now pretty common in China. And, other car companies aren't charging nearly as much for this functionality as Tesla has been charging for it in the US. So there's a real question of just how much of a revenue boost Musk may be able to get out of this.
Did he go to China for this reason? Because he also wants to show the United States he can get approval somewhere because he's having regulatory issues with FSD in the US?
I think it's a great question. I mean, it is absolutely the case that he has been cozy with China going back many years now. This is a company that, was the first car manufacturer that was able to set up shop in China without having to establish a joint venture with a local car company. And that was a huge, red carpet treatment that he was able to get out of, the then, top person in the government in Shanghai, who is now the premier of Xi Jinping's administration. And so, for him to have really secured that, gotten all the help that he did during the pandemic, keeping that factory open, it has been such a huge driver of Tesla's success over the last few years. And this trip, seems to send a signal to Washington that, Musk remains very close with the CCP and is able to, get preferential treatment, or so it seems, that other automakers have not been able to pull off.
That stock yesterday was up by 15%. Now, Craig, a lot of people have got questions. Here's one. How can he maintain this relationship with China at a time when we're all expecting EVs to be getting tariffs pretty hard later this year? I'm talking about Chinese EVs coming into the United States. And if the former president becomes the next president, maybe those wars are going to be even higher. How sustainable is this relationship?
Yeah, it's a very valid question. I think we have to separate out, just how much the U.S. is going to go after Tesla's operations in China. It seems unlikely that they would, interfere with the company having some success in a foreign market. But I do think, to your point, there is a real question about just how willing and open Washington is going to be for, this to turn into a relationship where, say, CATL, the giant battery company in China, it becomes even more of a supplier to Tesla for the U.S. There's not interest in facilitating that.
Stock is down 1.7%. Craig enjoyed this. Thank you, sir. Craig Trudell of Bloomberg. I just wonder how welcoming Beijing will be when those tariffs start to climb. Coming up on the program, we'll catch up with a story around Paramount, expecting to replace the CEO. That conversation up next.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Big day today this afternoon. Numbers from Amazon.
Thank you. That was great.
That's all right. Thank you. I can do it again if you want.
Please.
Bramo says, watch out. Amazon later on this afternoon.
It's been a big
Apple
deal.
Thursday. I agree.
That's good. You're
I
doing
agree.
great.
All right. Thanks. Thanks for the encouragement. Nasdaq's negative by 0.1%. Russell's down by 0.4%. On the month, the Russell is down by more than 5%. Been brutal. Big repricing in the bond market so far this month. 2-year up by more than 30 basis points. 10-year up by more than 40. Up a single basis point in the session at the moment. The 10-year 462.81. Going towards payrolls, the estimate, sneak peek at a payrolls survey, Lisa. I'll give it to you right now. The estimate for Friday is for around 250, 240 now on payrolls, which is still pretty punchy, isn't it?
Yeah, although I do think there's more of a focus on what kind of jobs. I believe Sarah Hunt yesterday was talking about that it's not just the number. It's what quality of jobs, what that pay looks like. Could you see average pay actually come in? Because this is a lot more lower wage kind of employment. To me, this is the reason why it's going to be interesting to watch ECI today, coming out in about an hour, as well as JOLTS coming out tomorrow and a whole host of other labor market data.
Mike McKee's going to break that down for us in about 60 minutes. I'll throw in the ISM as well.
Yeah.
ISM manufacturing tomorrow, I think. ISM services on Friday. In some ways, might sound a little bit crazy, but sometimes the ISM services index has more potential to whipsaw this market than maybe even payrolls does on Friday.
We saw the S&P Global services
Precisely.
index come in and actually surprise much more significantly than any of the data, or even what some people are saying about Jay Powell, who is going to try to be as boring as he possibly can tomorrow.
That's the big promo for our special Fed coverage tomorrow afternoon. Going to keep doing this, aren't we? Foreign exchange looks like this. Euro, dollar, and dollar yen. Take a peek. The euro at the moment just about unchanged at 107.21. The data out of Europe better. So the top 4 economies by GDP, Germany, France, Spain, and Italy, doing better than expected. The euro can't really catch a bid, still in and around 107. This story's been wild, and I think we can just call it that. Dollar yen, 156.93. So if I told you 157 a week ago, you'd be like, wow, yeah, that's problematic. We were at 160 briefly yesterday. So this is still a problem for the BOJ, for the Ministry of Finance. Let's put it that way. How much of a problem it is, I don't know. The Ministry of Finance has been very, very vocal about this. The BOJ has been very quiet. And the BOJ seems to be satisfied, based on its communication, with where policy is and where markets are.
This is the reason why the market isn't really believing that they're going to intervene with any kind of conviction. And that's the reason why people are willing to fight the foreign minister and the sort of Ministry of Foreign Exchange in Japan, just simply because they haven't shown conviction. And we haven't seen that from the Bank of Japan either. Is it a victory for the yen to trade in and around 155 to 160 versus the 170 that some people were talking about earlier last week?
Well, let's see if this does settle down in that range. Dollar yen at the moment, 156.92. Under surveillance this morning, Secretary of State Antony Blinken urging Hamas leaders to quickly make a decision on Israeli conditions for a temporary ceasefire. While not disclosing specifics of the offer, Blinken said Israel had been, quote, extraordinarily generous in their proposals. We have talked about this a few times already this morning. There is plenty of speculation that perhaps we're closer to a deal than we have been in the past. We did have some comments from the Israeli leader about an hour ago, which suggested that the objectives haven't changed.
Well, this is the big question. If Israel and Hamas were able to strike this deal, and amongst my reporting as well as others in Bloomberg News, they are meeting today to discuss this in Cairo, yet the President of the United States putting a lot of pressure on Sheikh Al Thani of Qatar to get this done, of El-Sisi of Egypt to get this done. But Netanyahu comes out this morning and says this: the idea that we stop the war before achieving all its goals is out of the question. We will enter Rafah and eliminate Hamas. So even if there is a deal, what does this mean for Rafah? That is still a question. Is a ceasefire just for a few months, or is a ceasefire actually mean a ceasefire?
There are many more questions than there are answers, and I think that you really illuminated that well, and I think that that's something that Norm Roll was talking about earlier as well. We don't understand what that peace would look like, or that non-military action would look like at a time where there isn't a willingness for anyone to really step in and oversee it.
These are super serious issues. What's going on with the farce at Columbia University? What's happening with talks over there?
Right now, it sounds like there is a little bit of more action, in particular with one particular building.
Didn't they set a deadline?
They did,
Wasn't it 2 p.m. yesterday?
And some students were suspended, but then other students decide overnight, I think it was around 1, 2 a.m., that they occupied one building on Columbia campus, and I think at the moment they're still occupying that building.
Okay, we'll see how peace talks go over at Columbia University. I mean, it's a farce, isn't it? It's ridiculous. You've got serious issues taking place in the Middle East, and you've got this taking place up the road at Columbia University.
It doesn't really feel comparable, and yet it is actually one of the biggest political debates and one of the biggest political liabilities for Biden. And it really has raised a question a lot about universities as sort of the heartbeat of intellectual thought at a time where some people are arguing that there is not actually an exchange of ideas that's going on in an active way, but rather it's a lot of people who just are kind of hunkered down and not wanting to discuss it.
This is a difficult one for Biden heading into November, because you see these are the individuals, young progressives, potentially that would come out and vote for him. And this is another reason why, besides the dire humanitarian issue that the administration talks about happening in Gaza, but domestically there's another reason why they'd want to get this deal over the finish line.
I think Mark Rowan of Apollo before Christmas absolutely nailed it before the turn of the year when he just said this is not about freedom of speech, it's about preferred speech. I think we've seen that on campus across colleges in this country repeatedly. Let's turn to the Federal Reserve. It is day one of a two-day meeting for the Federal Reserve. The central bank widely expected to keep rates on hold, but investors looking to Chair Powell and his news conference for a more hawkish tone and a possible pivot from the pivot, which is what Bramo's focused on tomorrow afternoon.
Absolutely.
Elsewhere, upheaval at Paramount. Shares of the broadcast giant lower in the pre-market. The company replacing CEO Bob Bakish with a management committee. The trio of executives will lead the company as it negotiates a potential deal with independent producer Skydance Media. That news overshadowing a strong earnings report for Paramount, buoyed by the success of its Super Bowl broadcast back in February. Geetha Raghunathan of Bloomberg Intelligence joins us now, and Geetha was on the main event, the showcase, the big exclusive, the earnings call. Geetha, can you describe what happened on the earnings call yesterday afternoon?
Yeah, thanks, John. So this was, unprecedented, right? This was the shortest call ever, I think, that I've seen in the history of media earnings, about 8 minutes long. It was just bizarre, right? There was the management committee that spoke very briefly. Then you had, of course, the CFO, Naveen Chopra, come in and deliver the results. But there was absolutely no questions from the analyst community, from the investment community. So it was really more not what was said, but rather what was not said, which kind of tells us that a deal is imminent.
Can you talk to us about these new executives, the so-called management committee, this trio of executives? Geetha, who are they and who do they represent? Because there were some reports that the former CEO wasn't happy with this deal that was on the table. Do we just assume that these three are happy with it?
I don't think so. I think this leadership committee is really just kind of a stopgap arrangement. It's definitely transitory. It's not the long-term strategic direction that Sherry Redstone is going to take, or that Skydance is probably going to take. I mean, the three executives are really just the division chiefs at Paramount. So you have George Cheeks from CBS. You have Chris McCarthy from MTV and some of the other networks, and then you have Brian Robbins. So they've been leading, the different divisions. But yes, you're absolutely right. Bob Bakish vehemently opposed the Skydance deal. He protested against it with, Sherry Redstone, and obviously that kind of ultimately led to his ouster.
Should this make us more comfortable, Geetha, that this was an incredibly short call, that we don't have a clear sense of what's going on or how close they think that this means that the deal is, and that we don't have a sense of who the permanent leadership is going to look like going forward?
I think it's pretty clear at this point. I mean, there is this looming deadline. So May 3rd, which is this Friday, is kind of the deal. It's when the exclusive negotiating period between Skydance and Paramount ends. And so they're obviously looking to get something done right before that. which is why you had that whole leadership change. They're working hard. Skydance came in, sweetened their offer a little bit. They're offering now $3 billion, a cash infusion into the company just to kind of assuage investors. And then it looks like Sherry Redstone has also kind of said that she's open to this majority of the minority vote, which means for the first time she's actually allowing kind of the non-voting shareholders to have a say. Again, this is all just a way to kind of appease investors who have been very, very opposed to this deal from the get-go.
Is there something that we can take away that's a broader kind of message in terms of what the successful media model could look like going forward from some of the messaging that we've seen? Sherry Redstone was concerned about Bob Bakish earlier just simply because he didn't sell Showtime and BET in previous iterations. The statement about these three in terms of streamlining operations and developing popular content, is this a matter of just simply jettisoning units that aren't as profitable? Is it about actually investing more in original content? Or is it just about being sold and being done with it?
Yeah, for Paramount, I mean, they have a unique set of challenges. And of course, it's emblematic of the broader media ecosystem, right? All of these companies were kind of faced with this really difficult challenge of pivoting away from their linear TV network business to streaming. Some companies could do it better than others. Disney, for one, has been, I think, fairly successful. Warner Brothers Discovery, again, they've had a fair amount of success. Paramount, however, hasn't really been that lucky, and that's kind of been one of the criticisms leveled against Bob Bakish, right? Yes, he managed to get 70 million subscribers on the Paramount Plus service, but it's come at a huge cost. The service has already, or the whole streaming business has lost $5 billion, since inception, and it's highly doubtful that it's ever going to be profitable. And so the question has been, should Paramount have even undertaken the streaming strategy in the first place? It's not the right strategy for everyone, definitely not for Paramount. They should have been kind of a content arms dealer, and that's kind of, a lot of the criticism against Bob Bakish for just kind of doing what everybody else was doing.
We're hearing a lot about Skydance, but what's the status of the Apollo bid?
So it looks like, I think Apollo is that there hasn't been any formal offer from them after that $26 billion offer, which was kind of, I think, soft and rejected by Sherry Redstone. I think they're waiting for this May 3rd deadline, and then they'll kind of come out with a more concrete offer. Rumor is that they're working with Sony to, again, lift that offer a little bit up from $26 billion to maybe $28, $29 billion, maybe even higher. There's nothing formal, so we don't really know the details yet. But I think we'll hear from them a little bit later this week.
Geeta, back to John's point, three feels like a crowd. Who holds the power in this troika of CEOs at the head of CBS, Showtime, or Paramount?
I really don't think it matters. I mean, ultimately, the power is really held by Sherry Redstone. She calls the shots.
I think we've seen that demonstrated quite clearly in the last 24 hours. Geeta, thank you. Geeta Ranganathan with Bloomberg Intelligence. The biggest thing potentially happening in media in the last week or so is the most obvious thing that should have taken place a long time ago, which is the Super Bowl taking place on President's Day weekend. Roger Goodell proposing what we've all been saying for years. Why isn't it held on President's Day weekend?
Because some people who have to wake up early the next day cannot watch the whole thing.
Precisely.
And so this way, yeah.
The whole country can.
Yeah.
It's not just about me, Bramo. It's not just about you.
It never is always about you.
It's like all-day breakfast at McDonald's. It was like so obvious. Then Steve Easterbrook comes along. The Brit had to come to America and run McDonald's and say, okay, that makes sense.
Okay.
All-day breakfast,
Really?
let's go.
Which is weird because you can't get all-day breakfast in the United Kingdom.
Okay.
This is like the all-day breakfast decision of the NFL. It's like so obvious. Just get it done. It's ridiculous.
What's the goal? To actually get more viewership? I mean, I think that they did pretty well. You think that they're going to get more
even
viewership?
more this way, yeah. The parties can go through the night, and then you can wake up on Monday and do what you want. It's a day off.
Which is ultimately your ultimate goal because you're a party animal.
Absolutely. Big party. I think everyone knows that.
Yep.
All right, including Danny Berger. Let's get to your Bloomberg brief. It's Danny. Hey, Danny.
I don't know what to say to that, John, but what I will say is I can check some earnings for us. Samsung up 1%. It's yet another case of AI-powered earnings. It topped earnings estimates. Its semiconductor division returned to profitability. Net income rose more than fourfold from a year earlier. Demand for chips used to develop AI has been insatiable, and Samsung says there are no signs it will let up this year. Now, if AI is one unrelenting earnings boost, weight loss drugs are certainly another. Eli Lilly shares higher by 6.6% in the pre-market. It beat and raised guidance guidance, thanks in large part to its diabetes and weight loss drug Zepbound. It also pulled in $517 million of sales for the drug, and it had similar success with its other weight loss diabetes drug, Mounjaro. Eli Lilly shares have gained 26% this year. Now, Walmart is abandoning a plan to build out a network of low-cost health clinics. It cited escalating costs and reimbursement challenges. The company announced it will close all 51 health centers in 5 states and close its telehealth business. Walmart launched the initiative in 2019. As recently as last year, it had promised to open more than 75 centers across the U.S. by the end of 2024. That's your Bloomberg Brief. I'll send it back to you, Party Animal.
Danny, thank you. And no one believes that. Everyone here knows I barely drink. First one in bed. It's like every night, 7 p.m.
This guy goes to a bar, sits there, and has peppermint tea.
It's true. That is a true story.
I know.
And at the White House dinner of the weekend, what did that? San Pellegrino with some lime.
Correct.
Then everyone kind of thinks you might be having a drink.
That was your goal?
Laid back Pharaoh.
Oh, yeah.
Yeah, right.
Getting wild.
Getting ready to be back on air Monday.
That's right.
With his voice. Who was sitting next to me on the plane Sunday? Lester Holt, professionals doing the same thing.
All right.
You know, just pros, focused on having a good voice for Monday, for the audience. Hey, up next on the program.
Some of us was asking the president questions
Sure,
and shouting.
yeah. All right. Making the case for credit.
The case can be made that we're looking at corporates which are in better financial health than they have been historically. I think that credit definitely has a space in portfolios.
That conversation just around the corner, live from New York. This is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities right now on the S&P 500, negative by 0.1%. Yields a little bit higher by a single basis point, 462.40. Later on this morning, the ECI, Employment Cost Index, dropping at about 8:30 for the first quarter. Mike McKee's going to break that down for us a little bit later this morning. Under surveillance, making a case for credit.
In spread terms, we're looking at pretty tight spreads. Again, the case can be made that we're looking at corporates which are in better financial health than they have been historically. I think that credit definitely has a space in portfolios, despite how tight it is from an all-in perspective. There is room for some credit in portfolios, I'd say.
Here's the latest this morning. Investors are waiting tomorrow's Fed rate decision. Expectations the central bank will keep rates higher for longer, fueling a search for yield and supporting demand for credit. BlackRock's Amanda Lynham writing this: policy normalization in response to improved inflation is a supportive backdrop for credit. An extended delay beyond 2024 for rate cuts because of economic strength would likely be more easily digested by credit versus a postponement of rate cuts because of a sustained sustained reacceleration of inflation. Amanda joins us now for more. Amanda, this is brilliant. Not all rate cuts are created equally. Not all delays are either. Is this a healthy delay?
Well, good morning. Thank you for having me. So far, it seems like a healthy delay because it's supported by resilient growth. I think the concern that we have is that the longer that these rate cuts are postponed, the more credence we get to the possibility of rate hikes. And that uncertainty around monetary policy is just not a great backdrop for credit. It's not a great backdrop for M&A or deal making. It's clarity on the macro that we need, not necessarily a favorable macro in terms of rate reductions. It's really that clarity that's key, so that's why we're focused on that.
What we've had so far this year has been a pretty resilient credit market in the face of a repricing of interest rates higher. What's behind that resilience, if you could go through the list for us?
Sure, so a couple of things. One is resilient growth, and I think that's been particularly important for speculative grade issuers that are more growth sensitive. So IG issuers have more of a cushion. They can handle a downturn in growth. High yield and leverage loan issuers, not the same defensiveness there. So growth is number one. Two is the yield backdrop. We've talked about this before. Spreads are tight, but yields are really attractive in the context of the post-financial crisis era. So if you're an insurance company, a pension, an endowment, you're looking for yield, it's been an attractive area to deploy capital into credit. But it's not been resilient across the board. I heard your earlier segment where you were talking about kind of triple Cs. It is true that triple Cs outperformed on a total return basis, but that's largely been driven by rates because triple Cs are less duration sensitive than, say, double Bs, that high end of the high yield spectrum. If you isolate credit spreads, which I would argue is actually the true measure of credit risk, triple Cs have been lagging. And so if you take the index level spread of high yield, 299, very tight, that would suggest that triple Cs should actually be somewhere around 600. They're around 720 in spread. So triple Cs on a spread measure, which I believe, again, is isolating that credit risk, has not kept pace with the tightening overall. That's also true in the loan market where triple Cs have lagged. So the market is efficient in telling you that not all of these companies can navigate high for longer the same way.
And it also expresses some concern about a lack of clarity around what the path of rates is going to be and how punitive that's going to potentially be for companies. Earlier this morning, we had Julian Emmanuel who was talking about popping the question. He was talking about how someone, maybe Michael McKee, is going to ask the Fed, well, under what circumstances could you imagine ever hiking rates, or is that off the table? Do you also think that that actually could really cause a massive dislocation in credit if he answers, yes, we think that we could, under certain circumstances?
Right. So two things I'm watching for tomorrow. One is there an acknowledgement that we are at peak policy rates? It seems to me like maybe the chair wants to step back from overstating that emphasis like he has in the past. So that's one. Two is how patient will they be to get down to their policy objectives? So how many more months of this kind of middle ground of not sustained reacceleration, but also not declining inflation can they tolerate? So that's what I'm watching for tomorrow. As it relates to credit, yes, it will have implications, but I would expect that theme of dispersion, not widespread market disruption, to remain intact. One of the really interesting points so far this year is that over 30% of the defaults that we've seen in 2023, and this trend has continued in 2024, has been repeat defaulters. So these are companies that have previously filed and they're filing again, or they've previously completed a distressed exchange and they're doing another one. Why do I mention that? It's because a lot of these companies that are under stress are not coming as a surprise to the market, right? So long as we have this high for longer environment, what you would expect is that the same troubled sectors, capital structures that were kept afloat by low rates but are not actually growing in a capital efficient way would remain under stress. Does that cause broad market disruption in credit? I think the bar is still high for that. What could cause that is a sustained reacceleration.
Well, especially because Dan Greenhouse of Solus earlier was saying that basically this isn't my mother's high yield market, that this has changed, right? And that essentially we're looking at something that's grown up and become much better quality. Does that mean that the risk has migrated to private credit, where you have a higher degree of less tested companies?
I mean, actually, I don't think that the risk has migrated to private credit. I think in syndicated high yield, syndicated leverage loans, and private credit, you can find vulnerable companies anywhere. And in fact, what we're actually seeing is an overlapping of the addressable market between public credit and private credit, where companies are demonstrated access to both. I really think what it is that, say, take triple Cs in the U.S. high yield market. This is using Bloomberg data. Interest coverage is 1.1 times. Just the margin of cushion to navigate a prolonged environment of high interest rates is very, very slim. And for most of the credit market, we don't view a 25 or 50 basis point rate cut as material or game-changing in terms of their capital structure. But there are some companies where they actually do need that. And I think what the market is telling you is that on the margin, there will continue to be dispersion. I think there are some themes, like the repeat defaulters that we've mentioned. Loan-only capital structures have also been leading the charge in terms of defaults, not surprising. So there are pockets of vulnerability that you can find, but I don't think that it's a wholesale shift in risk.
Could you give us some perspective on the all-in yield opportunity right now? How great is it? How big is it?
So on a percentile basis, using the post-financial crisis period, it ranks around the 80th to 90th percentile, depending upon the region and the rating that you're seeing. So what is that saying? It's saying that actually 80 or 90% of the time, yields have been lower than where we are now. On the spread perspective, it's the exact opposite, where we're kind of hovering around the 10% percentile. So basically, spreads have been wider than this.
So you've got to help me. Is it a good opportunity or not?
This is a great opportunity. So this is so maybe this is a little too nerdy for early morning TV. So yes, it's a great opportunity to deploy on an all-in yield basis, but we acknowledge that the opportunity for material spread tightening is pretty limited, just given that we're at 299. The post-financial crisis average for high yield is around 460.
Are you seeing equity investors migrate into your world? Because we had a guest, Lisa mentioned Dan Greenhouse of Solis earlier on the program, and he was talking about, very specifically about energy. He thought, relatively speaking, the opportunity was better in equity than it was in credit. Could you describe maybe a similar dynamic?
I would say on the margin, we actually kind of see the opposite, where we see equity investors and I would say this is very on the margin, take some chips off the table after some pretty strong performance and deploy into credit to lock in some yields. But I would say the conversation can go either way. It really depends on what the risk tolerance is, where the sector focus is.
Appreciate the depth. Amanda, thank you. Thank you so much. Amanda Lynham there of BlackRock on the big opportunity in front of you right now, Lisa, in credit and the risks on the horizon, the companies who will struggle if we don't get that rate cutting cycle anytime soon.
I'll put some numbers on it. Basically, you could see high yield bond yields, all-in yields, below 4% back in 2021, 3.7% all-in yields. Now they are 8%, a little bit north of 8%. That is the yield opportunity that people are talking about.
It's a massive, massive change. Third hour of Bloomberg Surveillance just around the corner. Coming up very shortly, Ron Temple of Lazard, Greg Valier of AGF Investments, Robert Sorkin of Citi, and Anurag Arana of Bloomberg Intelligence. Anurag looking forward to the big earnings story. Of the week.
What's that?
Amazon
Yeah,
later
that's
on
right.
after the closing bell. Apple, yeah. Two names making up 10% of the S&P 500.
Well, it's just the responses have been so violent after all of the earnings.
10% moves.
I mean, and these are massive, like $200 billion moves in market cap.
The $2 trillion names just moving 10% in either direction on seemingly nothing. Tesla, another example of that yesterday, striking a bit of a deal with Baidu over in China, 15% higher off the back of that.
You know, I don't know what to make of some of these moves in any way, shape, or form, or the legitimacy of this. Do you think they're actually going to soften ties?
Don't know. Peter Shea of Academy said is 10% the new 1% for some of these tech names. Looking ahead to Amazon a little bit later. From New York, equity is just about negative by 1/10 of 1%. You're watching Bloomberg Surveillance.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Mega cap tech just continues to crush it on basically every angle.
There's nothing wrong with tech. These companies have a ton of cash. It's just everybody's in love with them.
When you have these, powerful momentum stocks and growth rates decelerate, growth investors get angsty.
Earnings are earnings, and cash is cash. And so that is what people are looking at.
The Fed is in the rearview mirror. We're focused on other things. We are willing to trade rate cuts for earnings growth.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The week begins in 30 minutes' time. I mean, I don't even really mean that. The ECI is important. It's just sort of like not that important. The Employment Cost Index, 8:30 Eastern Time. Important enough for us to discuss. We'll do that with Mike McKee a little bit later on the program. Far more important today on the schedule is Amazon earnings after the closing bell ahead of Apple on Thursday. And sandwiched in between a Federal Reserve decision, the data just starts to heat up. An appetizer a little bit later on this hour. Then it's on to the ISMs, it's on to jobless claims, and Lisa, it's on to payrolls on Friday.
And it's really going to be how this comes together in terms of not just what that employment number is, but whether wages are reaccelerating, whether that confirms the 3-month reacceleration in inflation that we're seeing, and just how sustainable some of the strength and the inflation that we've seen really is.
Stephanie Roth yesterday was on the program, and she actually was north of what the street is looking for jobs, 270,000 after we had more than 300,000 last month. How, to your point, how sustainable is this job market? I'm so keyed in on what it means about immigration to this country. How sustainable is that supply side when it comes to this jobs market, which is really keeping a lid on inflation?
Yeah, it's the compare and contrast, Anne-Marie. The compare between what is happening at headline payrolls and the contrast with what's not happening with wage growth. Wage growth is not running away, even though we're printing something above 200K seemingly every single month in this economy.
Which is a reason why Employment Cost Index, which comes out in less than a half an hour time, is so important, because that is one of the key metrics that the Fed looks at. And if you see it reaccelerating, then that gives you a sense that maybe the story of disinflation with employment gets really challenged in a more material way.
As I said, the week begins in 28 minutes' time. Equity futures on the S&P 500 look like this. We're negative by 0.1%. In the bond market, quite a repricing of the month so far, higher by more than 40 basis points on a 10-year. Some of that move fades just a touch, back down to about 462 on a 10-year. Bear in mind, last week, Lisa, through 470 on a 10-year. So we've had some big moves in April.
And it really raises this question in terms of conviction in markets and what's going to give a sense of what we can really depend on when you have these massive whipsaw moves in pretty substantial instruments. We're talking about the benchmark borrowing cost of the United States.
Yeah.
We moved yesterday on a refunding announcement from the Treasury Department that increased the borrowing by $41 billion more than people expected. The market moved on that. Even though that's a drop in the bucket when it comes to the overall Treasury market, it gives you a sense people are skittish. They don't really know which kind of frog to look at jumping.
Which frog? Okay, that's good. Laurie Calvasina of RBC yesterday saying that mega caps behave like small caps, and we've got Treasuries behaving like, I was going to say penny stocks, but apparently frogs. Coming up, Lazard's Ron Temple on tech earnings divergence. Citi's Robert Sokin on his call for a July cut. Anurag Rana of Bloomberg Intelligence previewing Amazon earnings. We begin with our top story. Stocks heading for the biggest monthly loss since September ahead of more earnings from big tech. Lazard's Ron Temple saying this: I still see upside for US equities, but will have to be driven by earnings growth from here. So far, the upside in the S&P has been narrow, but I expect the earnings growth to broaden out as we move through 2024 with better participation from other sectors beyond the tech and communication services and a Fab 5. Ron's with us around the table. Morning, Ron.
Good morning.
We're not talking about Mag 7, we're talking about Fab 5.
Yeah,
who did we drop?
Well, if you look at the year-to-date, basically Apple and Tesla have been a drag, even including yesterday's gains from Tesla. So really, it's the 5 stocks. And if I look at the earnings results so far this quarter, all of the earnings growth is 5 stocks again. So we're back in that story that we've had for the last 2.25 years, where the rest of the S&P 500 is really not giving us much to get excited about. But I think that's going to change as we move through the year.
What tells you it's going to change?
Well, part of it is I look at it and say the only way this demand for AI and technology investment can be sustained is if the customers get a return on investment. Companies aren't going to keep pouring money into these products and services unless they see some benefits. The key question to me is how quickly do we see those benefits? Do they show up in the 2024 P&L? I'm a little skeptical. I'm hopeful on that front. But more importantly, I think as we start looking at the prospect of rate cuts, not just rate increases, interest expense will shift income statements in the market. And I think we're basically seeing an ongoing demand that's shifted from goods towards services, and that should also broaden earnings growth.
This was a story about 6 months ago, too, and a lot of people were talking about eventually we'd start to see things broadening out with rate cuts. And then it got pushed out 3 months, then another 3 months. Basically, are we in purgatory until we get the sense that the Fed is actually going to cut rates? And if they don't, you're not going to get a broadening out from the Fab 5 for the foreseeable future.
Well, I guess this is where a key underlying assumption for me is I'm still optimistic on the inflation front. I fully recognize the first quarter was an ugly surprise, right? January, I thought, okay, we can look at this and maybe it's a January anomaly. But we got February, and February was much better. But then March was kind of crushing in terms of that optimism. We had service inflation ex-shelter go from 5.1% annualized in the fourth quarter to 8.7% in the first quarter. Core PCE went from 1.6 to 4.4. I still think as we move through the year, you're going to see the labor market showing us an easing of tightness, and I think we're going to see that pricing pressure in the service sector start to ease. One of my favorite anecdotes, by the way, auto insurance has been basically 80 basis points of the 3.8% of core CPI over the last year. It's 3.5% of the index. Now, auto insurance rates are still going to go up for the next 6 months probably, but not at 22% annualized.
Steve Rashuda, though, of Mizuho would say you can cherry pick what you want. You still will have, you can get to 2% any which way. What would you have to see in some of the numbers that are coming out, starting with ECI, going to JOLTS that we get tomorrow, going to the payrolls report on Friday, as well as ISM data? What would you have to see to change your view?
Well, I guess what I would want to see, and back to the data this week, I think the ECI is probably one of the best metrics for wage growth. It's fully comprehensive, wages and benefits. It also works better in terms of adjusting for mix shift. If you look at average hourly earnings that we're going to get on Friday, that can be skewed. If you get more low-paying jobs, it makes wage growth look lower, so that one is probably less valuable. So on ECI, I want to see basically anywhere from a 90 to 100 basis point reading. It would be great if we saw something below that. I don't know if we see a 1.2, 1.3, that's going to spook the markets. I think if we look at the JOLTS data, questionable in terms of reliability. If you look at the response rate to the JOLTS survey, it's gone from 65 to 70% pre-pandemic to 30 to 35%. So some people do question if the data is reliable. I like to watch the quits rate within the JOLTS data. That tells you, are people finding better jobs where they're getting higher wages and they're moving? So it's another anecdote. And then on Friday, we'll wait and see. The market is saying around 240,000 new non-farm payrolls. We need about 130 to 140,000 in a typical environment to keep pace with population growth. If we get a big upside surprise and more positive revisions, that's going to make me a little more nervous that maybe this economy is reaccelerating. And by the way, if I take this alongside the data out of Europe this morning, upside surprises across the Eurozone, positive, albeit marginal commentary coming out of the Politburo in China, there is a risk that there's a reacceleration here and that would basically undermine some of my optimism on inflation.
To John's point earlier, so do you think Europe and China are catching up to the U.S. exceptionalism that maybe is petering out?
That might be a little too optimistic. I guess I look at Europe and saying going from zero to something positive is really great. But I do think there will be improvement this year. And I would also note, I think the case for the ECB cutting rates is a lot stronger. I mean, you basically don't have debating, and we're not debating whether Europe is reaccelerating. We're basically, it's clear that Europe's going from zero to something very low on growth. And inflation has been smoothly decelerating in Europe. So I think you're going to get 100 basis points of rate cuts from the ECB this year. And very importantly, monetary policy decisions in Europe have a more immediate and magnified impact on the economy than the U.S. because a lot more of the corporate rate is floating rate and a lot more of the household debt is floating rate.
So right now you're saying that your base case is you're going to get inflation coming in lower and you're going to get some rate cuts. What's the playbook if you do see that reacceleration in inflation and that case comes to play?
Yeah, if you get a reacceleration, then I think the Fed ends up keeping rates where they are. I don't think you're going to see the Fed raising rates from here. I don't buy into that hawkish thesis at all. I think 5.25 to 5.5 on Fed funds is plenty tight in real terms. And again, I appreciate the question, but when I look at the data, there's one part where there's a lot of uncertainty, and that's really the service ex shelter. If we look at the shelter inflation, we know from the Zillow Observed Rent Index that inflation there has basically declined sharply. It still hasn't shown up in the CPI, but historically there's a 1-year lag between Zillow and CPI and PCE. Based on Zillow, we know inflation for rent has gone from 16% 2 years ago to less than 3.6% for the last 9 consecutive months. CPI is still printing 6. So we know that part of inflation is coming down. We know core goods prices are still going to be soft because we can watch the Manheim Used Car Price Index. So when I piece it together, for basically 69% of core CPI, I know inflation is staying low or going lower. So I guess I have a hard time with the thesis that overall inflation is accelerating. I don't see that as likely. And I think we'd be better off focusing on what is the base case. We've gone from 9% inflation to close to 3%. There's been a lot of progress. Real interest rates are up a lot. And I think it's time for the Fed to basically start focusing on the other leg of the dual mandate, which luckily they don't have to worry about because the job market is strong. But if we can have a 3.5% unemployment rate and still get to the inflation target, that's how we should be thinking about later this year.
2 phrases I want to unpack with you. Plenty tight, plenty progress. Plenty tight. What evidence is there that we're plenty tight? And on the plenty progress, how much evidence is there that that's just a supply side story, not a demand one driven by the Fed, which you say is plenty tight?
I'm really glad you went there because I think one of the other things that's happened is we look at growth expectations in the U.S. The consensus for 2024, sorry, ECFC on your Bloomberg terminal,
I knew where you were going.
Is 2.4%. Just want to make sure I'm fresh. 2.4% for this year. If you go back to October, it was 50 basis points. So there's a lot of optimism around economic growth in the U.S. But there are signs of cracks. If you look in the consumer, mortgage and credit card delinquencies are up 40% year on year. Now, again, from a very low base. Auto delinquencies up 20%. In the Wall Street Journal this morning, there's another article about how many commercial real estate loans are coming due. The Mortgage Banker Association is saying $929 billion of maturities this year, $206 billion of which are office. You're going to see defaults on commercial property. We saw another bank failure in the last week. You're going to see more bank failures. There are going to be news stories that come through that start to chip away at some of this optimism. And so I think it's a little easy to get caught up in the excitement of current data and to say, what tightness? But the reality is monetary policy acts with long and variable lags. And I think we're going to see some of those lags come into play this year as the consumers depleted their excess savings, has trouble paying their debts, and as corporates actually find carrying these much higher interest expenses gets pretty difficult over time.
The short answer is wait. Ron Temple of Lazard. Ron, thank you, sir. Love a real-time conversation supported by Bloomberg and a terminal. We love that. Thanks, Ron. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The ex-Binance CEO is expected to become the richest ever U.S. inmate. The crypto mogul, known as CZ, is facing sentencing today after pleading guilty to money laundering and sanctions violations. Zhao is believed to be worth about $43 billion. The DOJ, they're recommending a 3-year prison sentence. His lawyers, though, are arguing for probation, citing a lack of precedent for incarceration. Boeing has raised $10 billion yesterday in a bond sale. It will help ease some of their financial strains. It attracted $77 billion of orders, and that outsized demand was helped by Boeing dangling a relatively strong yield premium. It's also a sign that the U.S. credit market is wide open, despite a shift to price out rate cuts, as insatiable demand for issuance continues. Goldman Sachs is in talks to transfer its General Motors credit card program to Barclays, that according to the Journal. It's yet another major step in Goldman's efforts to pull back from consumer lending. The investment bank's credit card unit had lost about $6 billion on a pre-tax basis since 2020. Barclays could strike a deal with GM as soon as this summer. The cards, though, have about $2 billion of balances outstanding. That's your brief, John.
Danny, thank you. I always wonder why this couldn't succeed, why Goldman couldn't come up with, if you think of sort of high-end luxury in the world of banking, you think Goldman Sachs, just in terms of the power of a brand. Why did they try and go mass market? Why didn't they sort of go down that road of getting high-end clients who want a credit card with Goldman Sachs written on it?
You know, my gut is they're asking themselves that question in pretty significant amounts, given the fact that their consumer lending unit didn't do that well.
Right.
So you have to think maybe they were trying to broaden out so they could get that customer deposit base, essentially. They could actually move in to get some of the other business. You know, they're probably
just never thought mass market Goldman. Just never worked, did it? From a brand perspective.
Which a lot of people, I think, would agree with you.
Yeah. Up next on the program, working towards a ceasefire.
We are approaching an inflection point. The deal that is made involves a number of significant concessions, and it will have a ceasefire that, in essence, provides Hamas with a victory of survival.
A conversation just around the corner. Live from New York this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bramo's got strong thoughts about domestic animals on farms. Now, if you're familiar with US politics at the moment, that's the top story. If you're not familiar, you probably think that's really bizarre, but knowing American politics, you'll guess that it's probably true. And it is. That is the top story in American politics right now. Equity futures on the S&P 500, negative by 1/10 of 1%. Wait for Bramo's thoughts. Yield's just about unchanged, 461.58 in about 14 minutes' time. 13 minutes' time now. We'll get the ECI, Employment Cost Index. Mike McKee's going to break that down for you. Under surveillance this morning, working towards a ceasefire.
We are approaching an inflection point. The deal that is made involves a number of significant concessions. Israel has lowered the number of hostages it is seeking, has increased likely the number of Palestinians it will release, and it will have a ceasefire that in essence provides Hamas with a victory of survival. So the next few days will be quite important.
Well, here's the latest today. Israeli Prime Minister Benjamin Netanyahu vowing to launch an offensive in Rafah, quote, with or without a deal. Netanyahu's office releasing a statement saying the idea that we stop the war before achieving all its goals is out of the question. This as Secretary of State Antony Blinken is continuing his trip in the Middle East, stepping up efforts to secure a ceasefire. Greg Vanier of AGF Investments joins us now. Now, Greg, 2 hours ago, we were hoping that we were close to some kind of agreement on this ceasefire, and then that statement that I just read out dropped from the Prime Minister's office in Israel. What are the prospects, the chances of getting a deal today?
Not great, John. Good to see you. I think that we've got a ways to go. I think maybe Blinken was right. There were some generous parts of the deal, but Netanyahu is not going to sign off on this after going through all we've gone through in 6 months. So I think there's still a ways to go.
Well, if there's still a ways to go, what's the Biden administration's plan B, given the fact that we've seen a tremendous amount of pressure exerted by Washington to try to get this deal over the finish line?
Yeah, they'll just continue the pressure with Antony Blinken. But this is reaching a point where the political damage to Biden is significant. I think that you'd have to conclude, based on Biden's falling numbers among young people, that if the election were held tonight, Trump would win, might even win overwhelmingly. This is really worrying Democrats in Washington who are concerned that it might not just be the White House, it might be the Senate and the House as well in jeopardy this fall.
You put out a note this morning going through potential VP picks for the former president. I actually wrote over the weekend about his meeting with Ron DeSantis. How difficult is it for Trump right now to shore up some of those individuals that DeSantis had in terms of the cash that he was able to bring in?
He'll get the cash, but I just get the sense, don't you, that the chemistry between DeSantis and Trump is never going to be very good. They just seem to be always at odds. But there are some intriguing names, and I think the number one name is J.D. Vance. He's red hot right now. I think he's the favorite. Elise Stefanik is high on the list. But I think you've got to say Kristi Noem is not going to be the nominee.
Okay, so I'm looking through your list, and I did notice she was the one you left off. Stefanik, Vance, even Greg Abbott gets a mention here. Kristi Noem. Greg, why did she do this? Why did she admit to killing a puppy on her farm?
I don't get it. Do you kill the family pet and then defend it as something, I guess, that shows she's tough and not going to back down? But I mean, this was really tone deaf, and I think that basically her political career has crashed and burned in the last 72 hours.
Yeah, you've never seen the left and the right unite under one instance recently than it has been when it comes to the governor of South Dakota. So let's talk about the actual potentials. Out of this list, who do you think Trump really wants to tap? Because also, the VP could potentially bring a voter base. Who would be the best in terms of trying to expand his appeal to the American public?
I would argue to expand his appeal, he's got to take another look at Nikki Haley. Wouldn't that be a story if he persuaded her to join? But assuming that's going to be too tough for him to do, he and Vance, according to the New York Times over the weekend, talk regularly. They've become very close. Vance, of course, as you know, a few years ago was a fierce critic of Trump, and now he's a big supporter. They don't need Vance for Ohio. I think the Republicans are in good shape in Ohio, but I'd put Vance as the #1 contender right now.
Greg, do you have a sense, you're putting out this list of the top 10, we are in full-on campaign mode, do you have a sense when the Trump team will actually come out and announce that pick? How long can they wait?
Probably until the day before the convention starts in mid-July. I think Trump is going to tease this. He's going to say, well, it's coming in the next few days, so stay tuned. And he'll just keep people on edge before he makes the announcement. I don't think he's picked anyone in his own mind yet. I think there's a ways to go that. And some people who need to get vetted, like Elise Stefanik, who most Americans have not heard of. So I think Trump waits until the very last minute.
There's also a question, Craig, and it goes on both sides, whether it's Republican or Democrat, which is, what is the mainstream for either of these parties right now? And it seems to be what both parties are trying to play with. On one hand, you have Donald Trump floating ideas of Fed independence and questioning all sorts of potential tariffs. And then you have, on the left, this question around what the protests on universities mean, how much that's going to be used by Trump against them, whether that's mainstream or on the fringes. Can you give us a sense of who the ideal Democrat is right now that represents the majority of Democrats, and who the Republican is who represents the majority of Republicans?
Well, I would say obviously Trump represents the clear majority of Republicans. No doubt about that. If you look at the polls, which have shown a little bounce for Trump in the last few days. On the Democrat side, it's pretty difficult to say. There are a lot of first-rate governors, Shapiro of Pennsylvania. There are several who I think would be intriguing and moderate. But the big political story to me is the polling numbers. And the polling numbers have taken a sudden dip for Biden. And I think that Biden and the Democrats are in real trouble right now.
Let's talk about that trouble, Greg. Some people are confident, Democrats constructive on this idea that there are independents, centrists out there that just haven't decided. And as we get closer towards the date, the president's pitch, it's me or democracy. Democracy's on the ballot. Let's make a decision. Let's make the right decision. We've heard that pitch repeatedly from the president of the United States. They think that ultimately the closer you get to November, the more it's going to land with independents and centrists, and they'll lean his way. Do you believe in that?
Well, we'll see, John. I mean, both of these candidates are infamous for their gaffes. There could be a big gaffe this afternoon. Who knows what we might see, or have Trump talk more about trying to control the Federal Reserve. So there's all of these wild cards that will crop up. But the one number two numbers have stood out for me in the last few days. Number one, young people turning against Trump, against Biden. If young people turn against Biden like they are right now, it's going to be hard for him to win because he's not doing well among Hispanics and African Americans. So he's got a big polling problem there. And I just think it's going to take a really concerted effort to see Biden pull this out, because the other issue is that more and more voters are saying under no conditions will we vote for Joe Biden. And the CNN poll that showed that was quite striking, that people are saying, no, there's no way in the world I could vote for him. Maybe I could vote for Robert F. Kennedy before I voted for Joe Biden.
Greg Valliere of AGF Investments. Greg, appreciate the update, sir. We'll catch up with you over the next few weeks. We get back to the book. Let's talk about the book. Okay. So hardly any politicians write their own books. We know that. They sit around a table. Some people pitch them ideas. They might ask some questions and they'll go, give us an anecdote, just a little story of a time where you made a tough decision. Can you imagine sitting there and thinking, got an idea? This time I took the pet out to the backyard and shot it. And then they put it in the book, and all the advisors sat around the table and read that chapter and went, that's gold, that's going to land really well with the electorate.
You know, it would land even better if you took the goat out back afterwards, because it smelled like goat. And you shot that one, too.
My goodness.
Cricket.
I mean, it is like, what are they thinking? Anyway, all right. You're going to see more gaps, no doubt, between now and November. Many more. Coming up next on this program, Citi's Robert Salkin, ahead of the Federal Reserve tomorrow and payrolls on Friday. ECI data just around the corner. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
They're still talking about the dog around the table. Hasn't stopped for the last 3 minutes. We're late to this story, you know.
Yeah,
I don't know why.
I know.
Only just started discussing it. Okay. Equities right now on the S&P 500 down by about 0.1%. In just about 10 seconds' time, the Employment Cost Index, which Lisa has promised is the most important economic data point of the week ahead, it drops in about 4 seconds' time. Of the day.
Yeah.
Of the day. Okay. Okay, correction. Of the day.
Thank you.
ECI drops. Upside surprise. Told you it was important.
See?
Here's Mike McKee with more. Morning, Mike.
Good morning. Well, this is an important number because it's the wage and salary and benefit number the Fed follows the most, and it is up 1.2% for the month, for the first quarter, rather. The forecast was for 1% rise after a 0.9 gain the previous month. Wages and salaries increased 4.4% for the year ending in March of 2024, and compensation costs overall were up by 4.2%. That's a decline in those numbers, so it does show some progress, but again, this falls into the category of not confidence building for the Fed as they try to decide when they want to get to cutting interest rates.
Mike McKee coming in hot. So let's go through the boards together. Equities drop by 0.4% on the S&P 500. The opening bell about an hour away. As you might expect, a pop at the front end of the yield curve. We switch at the board and go to the 2-year. We're high by 5 basis points and back through 5% once again. On a 10-year up by 5 basis points. Remember, we went through 470 briefly last week, getting closer again at 466. On a 30-year high by 4 basis points at 477. The euro pulling back, a break of 107 again at 106.93. We're negative by 0.25%. And you probably all want to see what's happening with dollar yen, given the challenges that the Japanese authorities have had with that currency recently. That's broken back through 157 at 157.24, positive by 0.6%. So if you are just joining us, the employment cost index coming in at 1.2%. That is an upside surprise. The survey, the median estimate was 1% flat. Lisa, as you mentioned, the last big data point going into the Federal Reserve tomorrow morning.
This is really important because it challenges the idea of disinflationary employment. Yes, we're getting it at an aggregate level, but not necessarily when you parse through and weight things in a different kind of way. It shows that wage pressures are still there. What you see is that 2-year yield now back at the highs of this year, which really suggests the Fed's going to maybe have to have a more hawkish tone tomorrow.
Mike McKee, on Fed Day tomorrow, in hand, they will have not only this, they'll also have the ISM manufacturing number as well. I believe they will also have the ADP too, and they're going to have, Mike, a little bit more data elsewhere. Mortgage applications, stuff like that. Mike, how could this data change the conversations on the margin away from where we thought it was going only a week ago?
Well, I think it changes the conversation over a longer period of time. In other words, this shows that we are still seeing, as Lisa was talking about, wage pressures in the economy. They've come down a lot. They were up 1.1% in the first quarter of the year, and they had been up by a lot less, a lot more last year. But there is still pressure out there. ADP they will look past because everybody kind of does. They'll wait till Friday to see what we really get. The ISM numbers will be interesting. We'll see what the employment figures are, and of course prices paid. It's been going up. That's not something that they necessarily want to see as commodity prices rise a little bit. But it isn't going to change Wednesday. Wednesday, I think Claudia Sahm said it best. Jay Powell needs to keep his mouth shut, not say much, and I think that's going to be the bottom line for tomorrow's Fed.
Mike, what are you going to do if you ask him a question and he repeats what you just said because he watches this show?
I'll give him credit for that. Because,
you practice that.
You know, if he says, I'm sorry, I've been told to keep my mouth shut, that'd be great, wouldn't it?
It's sort of a challenge when you try to keep your mouth shut. At a press conference, I will want to say, Mike, there's a bit of discussion around a lot of the inflation rates that we've gotten in the first quarter, that they're skewed for a host of reasons, certainly on the insurance side of things, as well as a host of other metrics. With this employment cost index, is there anything that's technical about people getting wages in the first quarter or anything like that that people are going to use to explain this away?
Not that I know of, and not that I've seen in the numbers so far. I mean, we've come way down the year-over-year rate, as I mentioned, for private industry, 4.1%. It was a year ago, it was 4.8%. So we're seeing 5.1% rather. We're seeing declines, but this sort of fits in with the narrative that we've seen over the last 3 months, that inflation has sort of flatlined. It's gone up a tiny little bit, doesn't look like it's breaking out, but the story of continual disinflation has sort of taken a breather. And that'll be an interesting question to ask Jay Powell, is why do they think that is? And why do they think it might resume if they do?
Mike, stay close. Going to break this economic data down with Rob Sock and Citi in just a moment. Mike McKee is going to be back in about 10 minutes' time with some final thoughts on this data. If you are just joining us, welcome to the program. The employment cost index for the first quarter coming in a bit hotter than expected. It's been the general theme for inflation pressure through the first quarter, coming in at 1.2%. The median estimate in our survey was 1.0. The price action, the reaction to it, we're negative on stocks. We're down 0.4% on the S&P. On the Nasdaq, down almost 0.5%. The Russell down 5% on the month so far, and this morning down another 1 full percentage point and change. If you switch at the board and turn to the bond market, Lisa spotted this straight away. Yields breaking out and back through 5% on a 2-year, up by 3 or 4 basis points at the moment. We'll see if this stuff sticks, but for now, this is the first move following this data from 5 minutes ago. We're up by 4 basis points on a 10-year, 465.71, and we're breaking out in the wrong direction for some authorities, including the Japanese Ministry of Finance. Back through 157 on dollar yen. We're positive on that currency pair now by 0.5%. Stronger dollar on the screen at the moment and a weaker Japanese yen. The dollar stronger against everything in G10. With us around the table is Citi's Rob Sockin. Citi's Rob Sockin joins us now, looking ahead to the Federal Reserve tomorrow and the data on Friday. Let's talk about the data that we just got. How much does that change things tomorrow?
You know, this is a challenging print for the Fed. It's not quite a nightmare, but it's something akin maybe to a really bad dream. You know, coming in at 1.2 is just evidence that the inflation data, the wage growth data is moving in the wrong direction to be consistent with their target. And you already got a lot of hints of that with the Q1 inflation data. And, you know, a saving grace may have been if wage growth showed continued signs of cooling on a quarterly basis. But I think putting all of that data together, it's going to be very hard for Powell not to lean a bit more hawkish into these figures and really say they're not seeing the progress on inflation that they need to be confident to start to ease policy.
This 1.2% increase in the employment cost index for the quarter was the biggest advance in a year. We're looking at a reacceleration at a time where even Citigroup, you believe that there is going to be a rapid deceleration and still a significant number of rate cuts later this year. Does this make you rethink that?
I think it's very challenging because, you know, our base case has been based on a market slowing in the economy as you get later in the year. And that on its own would give the Fed more confidence that inflation would continue to cool. But you've seen the start of this year, you know, GDP growth came in a bit softer than expected, but domestic demand was running near 3%, so I would call that a pretty strong economy. Labor market indicators are cooling, but still at pretty solid levels. And as I mentioned, the wage growth data are just not cooling enough for them that they can have confidence that the inflation moved back to target. So I think really the data, both on the activity side and the inflation side, are kind of moving against that.
There's also a challenge in this to the thesis that some of the employment numbers that have been really robust have been entirely driven by immigration, which has been disinflationary, and that we've gotten full employment without inflation. Do you think that these data that actually strip out some of the wage adjustments that we're seeing in some of the overarching payrolls numbers really presents a significant problem for that thesis?
Yeah, this is really key. We get a lot of data throughout the quarter on the labor market, on wages. It's really when you get to the employment cost index that's sort of supposed to be the be-all, end-all for wage growth. That is by far the best measure and indicator of wage pressures in the economy because, as you said, it controls for composition a variety of other factors. Now, it's not perfect. Maybe we are seeing some distortions in the first quarter due to bigger price gains and wage gains that are hard to seasonally adjust or control for, but this is supposed to be the one that the Fed hangs its hat on to tell really where wages are going. So I do think this is pretty difficult news for them.
If wages are too high and companies are keeping up with these higher costs, could this spell then maybe layoffs?
Well, right now what we're seeing is labor market has been fairly strong in terms of hiring. Wage growth has been somewhat elevated. Inflation's falling, so real wages have been pretty good, and that's fueling ongoing strength in consumer spending, which in turn is fueling more strength in the labor market. And right now we're really not seeing much appetite for layoffs. So I think more likely is you could get an environment where the economy stays resilient, but inflation just stays much stickier than expected.
Mike McKee, we wanted to bring you back into the conversation on the labour market. Can we talk about some of the numbers we're expecting to get over the next few days? Tomorrow, ADP and JOLTS, Thursday claims, Friday payrolls. What are you and the team focused on?
Well, I think the Fed, and therefore me, are most focused on Friday's, payrolls, because that'll tell us something about how tight the labor market is and whether this wage pressure will continue. If we continue to get the same kind of job creation, it doesn't suggest any relief on the wage side unless there's a big addition to the labor force. So it is something the Fed is going to be watching. JOLTS was important, less important now. It's been coming down. As long as it continues to come down, number of vacancies continue to come down, the Fed will be less concerned about that. So I think it's really the payrolls creation number and perhaps wages and salaries within that that are going to attract the most attention from policymakers, unfortunately, after their decision this time.
Mike, go get a drink. It's good to catch up with you. Mike McKee there, breaking down the economic data going into the Federal Reserve tomorrow. Payrolls in our survey, the estimate 240,000. Rob, you've got north of 200K on Friday. Where's that coming from, and why do you expect downside risk from here? What's guiding that view? I know it's a house view over a city. Andrew tells us it every time he comes on. Where's that house view coming from?
Yeah, absolutely. And we are expecting the labor market to still hold up well, as you said in this report. And the idea of the economy slowing is that we are starting to see in some areas a few cracks. In particular, if I was highlight on the labor market side, if you look at some of the small business indicators that we track, those are looking kind of worrying, especially in the survey data within the NFIB. That would argue that hiring is likely to slow a fair amount. That being said, as noted, the data have been kind of going against it in the first quarter, and we've seen upside surprises in payrolls throughout the first quarter, and over 200,000 in April is fairly strong number. So that's kind of the basis for it. But right now, I think the labor market's been holding up fairly well.
There's been an ongoing debate through the show this morning about whether or not Fed Chair Jay Powell is going to be interesting at all, but also whether he's going to answer the question about whether a rate hike could potentially be on the table for any reason. You don't think it would be. You think that we're sufficiently restrictive. But do you think that this is a Federal Reserve that has to indicate some level of sort of, I don't know, retracement from the pivot last year, just simply because you need an economy to run cooler with a market that really does sell off?
And this is a key point. And I think for the Fed, and you've heard Powell say something along these lines, they do feel they're restrictive. They would rather just hang out at these levels for longer than have to raise rates again. I don't think it's completely off the table. I think it would take something like an acceleration in inflation from where we are, and a continued acceleration through the year to really get that conversation on the table of raising rates. So I don't think he'll lean into it. I think he'll still say that they feel they're restrictive, but that they could hang out here for longer if they need to.
Do you think he's going to be boring, or do you think he's going to come out and try to make people feel a little bit more bearish?
I think he's going to be a little bit boring. I would expect him to come in and say that, not to say the Fed chair is ever boring, but that they'll come in and basically say that exactly as we're seeing that they don't have enough confidence yet. That the economy remains resilient. They do think inflation will move back down to target, but the data are kind of moving against that.
Would you like us to do a show tomorrow when we don't have to? We don't have to turn up.
Are you lobbying him or are you lobbying
No, just, for the people who make the promos, who are in the newsroom, if you want to put that promo on a little bit later,
still newsworthy.
Just take the three guests we've had this morning that just say it's going to be boring and suggesting Chairman Powell shouldn't even speak. Robert Socken of Citi. Robert, it's good to see you. Thank you, sir. If you are just joining us, nothing boring about the last 15 minutes or so. Upside surprise on the employment cost index in at 1.2%. The estimate in our survey was 1%. Yields breaking through 5%. On a 2-year, again. Let's see if that sticks. We're up by 3 basis points to 5.01%. On a 10-year at the moment, up by 5 basis points to about 4.66. Yields are up, stocks are lower. We're down about 0.4% on the S&P 500. And as you might expect, the dollar's stronger. We briefly broke through 107. We're back above those levels on the euro at 107.06. And if you're looking at dollar yen, which I'm going to do on my terminal, right now on the Bloomberg, dollar yen is back to about 157.32. So we've got a weaker Japanese yen and a stronger dollar. That stronger dollar dominating G10 this morning following that data. Let's get you an update on stories elsewhere. We can do that with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John, not unrelated. Ahead of Wednesday's FOMC decision, EM banks will be hoping for maybe not a boring Powell, but at least a dovish one, something they're unlikely to get, according to UBP's Peter Kinsella. Instead, EM central banks face a trade-off between cuts and currency depreciation.
You may see 1 or 2 rate cuts from various EMCBs, like to Mexico, maybe Brazil, but really they're going to change their language, they're going to change their stance because they realize they need a positive real rate spread over US Treasuries, and as a result, there's a limit to what they can do.
Kinsella spoke with me earlier on Bloomberg Brief, which you can watch every weekday at 5 a.m. The race for NBA broadcast rights is on. NBC is preparing to bid about $2.5 billion a year to air the matches, that according to the Journal. Games are currently broadcast by Warner Brothers Discovery. Warner was unable to reach a new agreement before the exclusive negotiating period closed last week. Amazon is also reportedly in the running to receive some regular season and playoff matches, but let's be honest, the Caitlin Clark matches are the most important. Elon Musk's wealth is on the rebound thanks to a surge in Tesla prices in the past 5 days. Musk's net worth gained more than $37 billion, according to the Bloomberg Billionaires Index. Off the back of news he had gained support for his driver assistance program in China, Musk added $18.5 billion to his fortune yesterday alone. With more than $201 billion, he's close to overtaking second place Jeff Bezos. That's your Bloomberg Brief, John.
Danny, thank you. Up next on the program, Amazon in focus.
Let's not forget, a big piece of Amazon today is advertising. It was roughly $50 billion at the end of last year. Be interesting to see how it evolves for this year. The strategy is keeping people on Prime.
Amazon results coming up after the close. That's a little bit later. Equity futures pulling back by 0.4% on the S&P as we close out a messy month of April. From New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Had some data about 20 minutes ago. A upside surprise on the employment cost index, 1.2% against an estimate of 1%. Marginal move lower on the S&P 500, down about 0.4%. Yields are higher by 4 basis points on a 10-year to about 466, up by just a little bit at the front end, but back through 5%, up by 3 basis points to 5.01%. With those high yields, a stronger dollar dominating G10 again. Dollar yen breaking out to 157.37 on that currency pair. At the moment on the session intraday, we are positive by 0.6%. Under surveillance this morning, Amazon in focus.
Let's not forget, a big piece of Amazon today is advertising. It was roughly $50 billion at the end of last year. Be interesting to see how it evolves for this year. The strategy is keeping people on Prime, is some sort of an upcharge as they add football. They've got a built-in audience, and the thing about that audience is they don't have to pay much to acquire it.
Here's the latest Amazon earnings out after the closing bell. Analysts expecting a sales jump, joining its Mag 7 peers as the online retailer spends on the cloud and artificial intelligence. The results will also be the company's first since it introduced ads into its Prime Video service back in January. Anurag Rana of Bloomberg Intelligence joins us now for more. Anurag, looking forward to this afternoon when this number drops. What are you and the team looking for?
Yeah, the couple of numbers they're really focusing on is advertising as well as Amazon Web Services. I think these two are extremely important for Amazon's total profitability, and those are the numbers we're looking for.
What we've gotten so far from Microsoft and Google were really big beats on their cloud services, particularly some of the artificial intelligence that's being deployed through those offerings. How much do you think that that's cannibalizing from Amazon? Are we going to see a similar type of result from them?
Yeah, I think expectations for Amazon Web Services are very high right now. Now, there are two things to remember. First, Amazon does not have a Microsoft-like relationship with OpenAI where it can capitalize on the more, increased use of ChatGPT, for example. And the second thing is the size of Amazon Web Services is extremely big compared to the other two cloud vendors. So it's possible that they may just be able to either meet expectations or slightly beat them, and people may not like that. So that's going to be the biggest thing for us to focus on today.
What about when people are talking about China and advertising on U.S. platforms, that's a significant driver of revenue for the likes of Amazon? How much are you watching the potential retracement of some of that spending?
Yeah, I think for Amazon, they're taking market share away from other avenues because for a lot of people, they are going straight to Amazon and searching for products, and it gives them the opportunity to monetize on it. Over the last few years, that business has just gone from nothing to, over $50 billion at this point on a run rate basis. And, it's expected to grow this quarter, somewhere around 24-25%.
Seeing a lot of people talk about a potential dividend. Is that on tap today?
Yeah, I think there's going to be a lot of discussion around it, and probably, one of the very few companies that's in the large tech world that's not doing it. So I think it's possible, but again, it's very difficult to predict that.
Anurag, what's behind the recent move towards dividends of these mega cap tech stocks that we're typically used to delivering massive stock buybacks? But what's new about the dividend story? Where's that coming from?
Yeah, but what else to do with cash at the end of the day? You can't buy anything. I mean, you buy a tiny little company and the regulators are all over you. So either you buy back shares, which they all do, or at least most of them do. And the second area would be, give back money a little bit from dividends.
The politicians don't like the buybacks either, as we know. Anurag Rana of Bloomberg Intelligence, it's like lose-lose right now. We've got all this money. We can't buy anyone. Can't buy back our own stock. They don't like that. Yeah. So let's just introduce a dividend.
Basically, these companies have so much cash that they don't know what to do with it, that they're looking for ways to just be like, here you go, just get in a helicopter, throw it out the window.
Like Bernanke?
Yes, you get, an Amazon, helicopter drop.
Why not? As I was saying at the top of the ad, the week would start at 8:30 Eastern time, and it did.
Right.
Week started 23 minutes ago when we got data on the employment cost index. Things start to get busy from here in all seriousness. We get the ISM tomorrow, the ADP report, whatever that's worth. The job openings report, which is still, Lisa, closely followed. You can talk about whether that data is good data or not. It is still closely followed. That goes into Thursday, jobless claims, Friday, the payrolls report.
Yeah, and a lot of people focusing on the quits rate in particular with JOLTS tomorrow. Here's the issue. The data has not been friendly to what a nightmare, but this is like a really bad dream for the Fed. It's going in the wrong direction, and this is the data point that it's hard to strip out and say, well, it's getting skewed because of this, that, and the other. This is something they've looked at in the past, and they'll be looking at right now.
I'm so much more interested now in the jobs data on Friday. To your point earlier, Lisa, the fact that the supply side of the jobs market, immigration, this is supposed to keep a lid on those labor costs, and potentially it's not. We're starting to see that unwind a little bit.
That's a supply-side story that policymakers and investors alike have taken a great deal of comfort in. This idea that you can see numbers like this, 240, 303, and not get carried away about wage growth. And they're taking comfort from that. Now, whether you think as just a layman whether they should take comfort from that is a completely different debate. But that's what policymakers have taken comfort from.
And what this is the biggest jump in a year in the employment cost index. It's above anybody's estimate, and it comes as yet another hotter than expected surprise at a time when people are really holding their hat to that potential thesis, and it's proving to it doesn't really last as long as.
Let's go through the lineup tomorrow. So tomorrow morning, we'll kick things off with Tony DeSpirito of BlackRock, Earl Davis of BMO, who's been phenomenal on the bond market so far. We'll speak to Deutsche Bank's Binky Charter and Jonathan Pingle of UBS. UBS have got some interesting views on the Federal Reserve and the path forward, haven't they?
Basically, if they don't cut and if the data does reaccelerate, they could see a Fed funds rate next year of, 6.5%? Something like that, that rate hikes for next year come back on the table. People are all over the map because you can't get any sense of what paradigm we're in, and that is a scary place for a lot of people.
You know, I know everyone spent the morning, particularly on this show, pouring ice-cold water over Chairman Powell's news conference. I know I'm meant to say this, but I really mean it. I disagree.
I do too.
I think it's going to be quite an interesting news conference. You've had news conference after news conference where the Federal Reserve Chairman has been able to refer to these upside surprises as bumps in the road. Once you've got three, you've got a trend. It's very difficult to do that anymore. And I think what we've witnessed over the last couple of weeks, Fed officials start to think out loud about the prospect of staying on hold for a lot longer than they thought we'd need to, and maybe even consider the prospect of needing higher interest rates down the road. Now, I don't think higher interest rates down the road are a base case of anybody's on the FOMC, but often news conferences are most interesting about how the chairman navigates difficult questions, and that's a difficult question at the moment to navigate.
If it's boring, that will move markets tremendously. Get ready for a rip-roaring rally because this is going to be a Fed that's not trying to pour ice-cold water on that particular market action.
That right there is the Bramo promo for tomorrow afternoon. Live from New York City. Thank you for joining us. Have a wonderful day. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future.
But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. It is countdown to the open. So pop go the bonds on the hottest print for employment cost index in a year. And these equities wobble. We'll talk you through the moves as we count down to the open. Kicks in right now. Coming up in the show, employment costs data coming in hotter than expected. Sending equity futures lower, Treasury yields higher, and stocks approach the first monthly decline since October. We begin with a big issue, counting down to the Fed.
We all want certainty. We all want, and we look to the Fed as some oracle, which we should not, and thus what comes out of his mouth, what comes out of Powell's mouth, people want to grab onto. They want to hear, but they want to hear, and off and running they go. Powell will aspire to be the most boring he possibly can tomorrow. We could be back in the why haven't they cut yet discussion. I mean, like, things can move very fast.
Joining us now is Mike McKee. So the job is difficult to sound more hawkish than the market already is, isn't it, Mike? Good morning.
Good morning. Oh, I think Claudia might even have been surprised at how fast this narrative turned. I mean, the Fed's not going to do anything tomorrow. We didn't expect them to do it, but the idea of when do they cut and do they cut this year, we're looking at the wrong one there. That's the balance sheet. We may get the balance sheet taper announcement tomorrow, but it's not going to be a big story other than that it's happening because they're going to start tapering because Fed's told us that's likely to happen. So watch for that. But this is the odds of a rate cut. They've now shifted now that the ECI has come in hot. I don't know if we have the ECI chart, but the ECI comes in up 1.1% for wages, which is the fastest pace in a year. And at the same time that that's happening, we're seeing inflation rise. And the combination means that the Fed is going to be putting off the idea of rate cuts. There's nothing in today's data that would suggest that rate cuts are possible. Now, Jay Powell is going to be the only story tomorrow because there's no SEP economic projections and there is no dot plot. So questions for him: why is inflation so sticky? How long is for longer? If you're higher for longer, is policy restrictive enough? And would you consider raising rates? I'm not sure that he's going to do that. As a matter of fact, Claudia Sahm went on to say that not only is the chairman going to be as boring as possible, but if he opens his mouth, there's downside risk because people are going to want to hear what they want to hear. So we had a bad number this morning, but we do expect the Fed not to do anything. That's not going to change tomorrow's meeting. The question is, how does it change what Powell says about what the Fed's thinking?
Yep, well, those bond markets are already pretty much ahead of a potential hawkish pivot if we get that at all. Mike, thank you very much. We'll catch up with Mike over the next 24 hours. He's off to Washington. Joining us now is Brent Schutte, CIO of Northwestern Mutual Wealth Management, and Cameron Dawson, CIO of New Edge Wealth. So the bar is high to perhaps getting some kind of a more momentum, hawkish momentum to this bond market. Cameron, to you first of all, are you set? I mean, we've just had this quite high ECI index, so the bar is quite high for the market to stretch further into hawkish territory.
Well, we think that there was a meaningful tone shift out of Powell a couple of weeks ago when he at first acknowledged that inflation has moved against them. Every other time going into this year, he really talked about inflation not being a problem and still having the door open for rate cuts. So we think that he will continue that tone, which is one of saying that inflation does not support them moving to cut rates immediately, still being hopeful that they can make progress, but really talking about patience, which just translates to fewer cuts and much more back-end loaded if we get them at all in 2024.
So keeping the door open, keeping the dream alive would be the base case for you, Cameron. Brent, good morning, good to see you. Look, the market has been aggressively trying to quash rate cuts down to 1, if at all, by December. Surely Powell welcomes that kind of pricing.
I think so, but I guess the Fed chair has been pretty optimistic lately, and I think that's been hopeful, wishful thinking. I mean, look, inflation was caused by COVID originally. And so as we move further past COVID, that's why inflation came down. Now, as the ECI shows, inflation is tied to the business cycle. We are later in a business cycle. That's where wages rise because we're out of workers to hire. And that's where inflation becomes sticky. And that's been in the data for the past 3 to 6 months. I think you're going to see a market that has difficulty just because a lot of the optimism has been priced off of the potential for lower rates, which we don't think is likely in 2024 at all.
So, Brent, you would say that things look a little bit brittle out there. I look through the lens of Mercedes, Volkswagen, Tesla. I look through just idiosyncratic issues around the consumer out there. Now, you can say that's all to do with new models in cars, but there could be something much more there. Where is the most brittle aspect of the economy that we need to shine a stronger light on?
Well, I think it's more the lower end consumer. And so the reality is that rate hikes haven't really affected wealthy individuals because most wealthy individuals just have fixed rate mortgages. And so you haven't seen the existing home market clear. You haven't seen interest costs rise there. Where you've seen interest costs rise is in credit card and autos. And you're seeing that happen fairly aggressively. You've seen them double over the past few years. And that's where you're starting to see the impact of rate hikes in those more interest rate sensitive parts of the economy, the lower end consumers, where they are impacted by rising rates. And that's where I think you're going to see that melt up into the higher income groups, especially if the market stops going up, which has been a bit of a wealth effect lately for more wealthy people. And so to me, the longer rates remain higher, the more these rate hikes of the past work their way into the economy and cause the potential for that mild recession that we think is still a likelihood as we push through 2024.
Cameron, have you shifted from soft landing, no landing, to something perhaps a little bit more pressing?
We've actually been calling it a strange landing, one meaning that you have all of this conflicting data. And if you think about that ECI today, we had that hotter print, but at the same time, we've been getting NFIB surveys, so small business surveys, pointing to slower wage growth. So there continues to be all of this conflicting data. We think Brent's point is really good, one talking about how there are signs of weakness within the lower end consumers, as well as within smaller companies that have more floating rate debt. But the reality is that that high-end consumer and larger companies in many ways have benefited from higher rates. You have a fixed debt cost. However, you're seeing your interest cash income go up significantly as cash rates have increased, which just means that you have this tale of two cities or tale of two worlds within the economy as well as within the market.
Cameron, when does this window open and close for the Fed to do the cuts? Because we've got politics interfering with the calendar, the physical calendar. It's going to be tough for them to get a series of 3 solid PCEs that make them more comfortable in time to cut by the summer.
I think it depends why they're cutting. If they're just trying to do these tweaks of rates lower because inflation is moderating and they think they have room to cut, then June really would be the last window before they're getting too close to the election. However, if labor data starts to fall off a cliff, don't put rate cuts off the table, meaning that even if it is close to the election, the Fed could move. So it all depends on the underlying economic data and the reason why they would be cutting.
I mean, we've had 4 weeks of losses in these bond markets, Cameron. I get the sense that we're tactically short going into this Powell meeting. the market barely blinked yesterday on the quarterly refunding. It takes a heck of a lot, really, to move this market. So do you think positioning is stretched as we go into this meeting?
I don't know if it's quite as stretched yet. You can look at TLT flows, so the long-term bond flows, which haven't shown a sharp degree of outflows of people rushing for the exits out of bonds. I think that there still is an opportunity to think about wanting to add to duration as we get closer to that 5% level, mostly for investors who are buy and hold investors. Really, it comes down to saying that even if yields do continue to rise, you have that offset from the higher yield that you're getting. But that is acknowledging that we still think that there could be upside to yields, mostly on the long end of the curve, because of things like Treasury funding. We're also watching that short end really closely. The 2-year yield has been flirting with 5% really for the past couple of weeks. And it looks like this morning with that hotter ECI data that we are breaking slightly above that 5% level, which is meaningful in the narrative of higher for longer and higher interest rates that will persist.
Brent, do you think that just this flirtation with 5% on the very short end of duration is the challenge to deploying more into equity from money market funds relative to sustaining money market funds, or indeed being at the very short end in duration?
Absolutely. I just don't think that the stock market should trade at 21 times earnings when the short end of the curve is at 5% and the longer end is even closer to 5%. I think Cameron's point really on the labor market cracking, and that's causing the Fed to cut rates, is important. To me, that's what will cause them to cut rates. They cannot cut rates when inflation is moving higher. The evidence is that that's occurring. The only way they could cut rates is if the labor market cracks, and the labor market is a lagging indicator. Once it starts cracking, it doesn't stop typically until the unemployment rate rises by 1.9 to 2%. And so to me, they're going to be too late, which kind of ties into the bond market. I mean, this is where, I think Cameron's point also is well taken. Even if the 10-year Treasury rises by, say 75 basis points, you're still flat for the next year. If it otherwise goes down by 75 basis points to 100 basis points, you make 10 or 12%. And so there's a good skew there right now. And I think investors should be extending duration, because eventually you will see that recession. People will wake up to it, and the reactive Fed will have to cut aggressively, and you won't be able to time that perfectly.
Team, thank you very much. That's Brent Schutte of Northwestern Mutual Fund Management. Cameron, you're going to stick around, a little bit more tech for you. I want to show you just what's going on in the cocoa market. This is one of those moments. I want you to put this in perspective. Why in an equity show do I show you cocoa? Because it's down 27% in 2 days. This is a commodity that traded at $11,000, a historically high level, and we have crashed and trashed. Now, this cannot be a read-through to the rest of the commodity markets. But what you are seeing overall with BCOM is the trajectory of the Bloomberg Commodity Index is also down. So cocoa plunges the most ever, down 27% in 2 days. Costly to carry those trades. Let's take a look at what's moving ahead of the opening bell. Abigail Doolittle is side by side with me.
Well, U.S. futures are down this morning, Manus, but we do have some individual stock winners on earnings, starting out with the shares of 3M. We're seeing a big beat on the top and bottom line. The adjusted earnings range for the year is impressive. They've also cut their dividend for the first time after 6 decades of hikes. Now, PayPal, that stock is also higher despite missing adjusted earnings by 10%, but they did beat sales. The earnings per share growth for the year, instead of being flat, is there is growth, but they're still saying that it's a transition year. Eli Lilly also higher. They boosted their full year outlook on their obesity and weight loss drugs. And then the odd stock out and the group of stocks, all of the crypto stocks, well, they are down in sympathy with Bitcoin and Ethereum.
Okay, Abby, thank you very much. Abigail Doolittle there. And a shake-up at the top of Paramount. Well, the talks of a sale, they continue. More on the TV giant next on Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All in the name of getting a deal done. Paramount replaces the CEO, Bob Bakish, with the 3 executive team as talks on a potential takeover with Skydance Media continue. Joining me now is Geetha Raghunathan, Bloomberg Intelligence Media Analyst. Management by committee is always tricky, but this is about David Ellison's bid from Skydance and enabling the road to do that deal. That is the first take on the CEO being stepped down.
Yes, absolutely, Manus. So Bob Bakish, who was the CEO of Paramount, obviously was opposing this deal from the get-go, creating a lot of, kind of roadblocks for Sherry Redstone, who is the controlling shareholder of Paramount and who is desperately trying to get this deal done with David Ellison's Skydance Media. So, obviously now you have this 3-person committee, but there is still no real strategic direction, right? This is just a transitory arrangement. We're going to have to wait for that May 3rd deadline. That's when the exclusive negotiating period between Paramount and Skydance kind of comes to an end unless they have a short-term extension. But they're obviously trying to move everything, expedite the whole process here.
And she's all in on wanting to do this deal. Is that a fair assessment of where we are relative to now the management by committee? Where are they relative to her?
Yeah, so I mean, it's not clear. I mean, these 3 executives are really just the section chiefs of the different units in Paramount, which is the film studio, the CBS broadcast network and stations, as well as some of the cable networks like MTV and BET. It's not really clear what their position is just yet. I think this is really just, again, a stopgap for Sherry Redstone to kind of get this deal done, which she is absolutely interested in pursuing with Ellison. I mean, this has been an ongoing saga right now, Manus, for over 6 months. Yeah. So they are kind of trying to get something done, but ultimately, I mean, there's a lot of uncertainty here right now. If Skydance were to kind of walk away from the talks, then obviously this 3-person committee has to kind of step in and really lay out some kind of strategic plan for Paramount.
Well, that could always be, the moment of truth. Be interesting to see whether Skydance do a put up or shut up clause in the next evolution of the deal making. Geetha, thank you very much. Geetha Raghunathan of Bloomberg Intelligence. We've also got the clock counting down to Amazon. And this is all about the momentum rolling for the Mag 7. Last week, we saw strong earnings from Microsoft and Alphabet. And now it is down to Amazon to return after the bell. Bloomberg's Alex Webb is with me. So the others gave us tantalizing things such as dividends and upping the share buybacks. What will Amazon have to do to deliver? Alex?
Well, it'll be interesting to see if they do anything on the returning capital front. They are sort of the one holdout in that respect, but it's really looking at AWS, Amazon's cloud business. The difference between Amazon and Microsoft and Google, it's big rivals in that space, though I should say that Amazon is by a long way the market leader in terms of market share, is that it does not have a sort of captive AI arm in quite the same way that they do. Microsoft has got, very close relationship with OpenAI. Google, of course, has Google DeepMind, its own AI research business. Amazon has a relationship, a supplier relationship really, although they've invested in them with Anthropic, which was founded by a bunch of OpenAI departees. Microsoft and Google have both enjoyed tailwinds from that AI business in their cloud operations. The question now is whether they are taking share from Amazon or whether Amazon is enjoying comparable gains.
And in terms of, you know, we talked about it, the others have delivered dividends and upped their share buybacks. Do you think that that could be the spoiler alert here for Amazon, or do you think they're still fully committed to the concept we are a growth company, a growth strategy, and we are about investing in the future? Because that's where they have had the razor's edge.
Well, it's interesting because we have seen some more cost controls at Amazon. They have been laying people off. They have been cutting down on some of the more sort of moonshotty type operations. So the other part of that puzzle that we have seen, you know, Meta do, we've seen now Google do, is pair those savings with more shareholder returns. Now, you know, if there are any issues on the growth front, which, you know, is always distinctly possible, then sometimes those buybacks can offset it.
Okay, well, all eyes down for that. Alex, thank you very much. We'll catch up tomorrow when we have the numbers. We're back with Cameron Dawson, CIO of New Edge Wealth. It's tantalizing, isn't it, Cameron, the thoughts of another payout. These companies have massive cash on their balance sheets. They're struggling to find anything to do with it apart from, let's say, moonshots and daily capex. When you look at this sector, how important is dividend and share buyback? Because it's a nuance in the dividend. It's a new evolution for some of them.
I think it is increasingly important just because the companies are getting that much more mature. And I think the point on the moonshots is also important because we haven't necessarily seen great returns on investment in some of these moonshot type products, which just means that there's probably a better use of that capital. And when you add on top of that, that these companies are sitting on massive cash balances that are raking in 5% yields or plus, it just suggests that they should do something efficient with that, which is give it back to shareholders. So this is just an evolution of the life cycle and the maturity of these businesses, which we think from a shareholder perspective is very healthy.
When I look at the market action from last week, we saw the hedge funds come in and scoop up the dip when there was a definite drop in this market, spectacular in one or two names. We saw the hedge funds scooping up the largest net buying since 2022. They really have a vice-like grip on Mag 7, haven't they?
They do, but I think it's really interesting that even with the great results out of Microsoft last week and that buying that rushed in, it wasn't enough to get Microsoft to trade above its 50-day moving average, which of course is just a technical level, but we've also seen Microsoft kind of deteriorate on a relative basis versus the market all year long. This is significant because Microsoft, of course, is the largest name in the S&P and in the NASDAQ and then the tech sector, so it really does encapsulate so much weight within the index that its strength is important. So it's important to respect the trends. Some places like a Google and an Amazon have better uptrends in place where that weakness is more viable. But we're watching Microsoft really closely, really as an indicator about overall health within the software and tech space.
But then this all plays back to momentum, and a lot of people are concerned that, let's say, I like the way you frame that in terms of a good enough reason to buy, but a dissipation in momentum. Do you get the sense that we're not done yet with it? We had a mini drawdown last week, if you recall. It doesn't feel as if this market is done with testing the downside.
I think that it is likely that the market isn't done with testing the downside, simply because we haven't seen a rush of buying into the market. You can use measures like things like the percentage of names trading to new 20-day highs. It's this idea of a breadth thrust, of people clamoring to get back in because they think that they've missed the downside or the opportunity to buy. That's just sitting at 9%. Usually we see that go above 30, 40% when you have seen the end of a down cycle happen. So it just suggests that maybe there is some more churn. Watch how we interact with that 50-day moving average again from the index level. And if we roll over with that index, with the 50-day moving average, it could suggest that there's more chop to be had.
Okay, Cameron, thanks so much for joining us. That's Cameron Dawson of New Edge Wealth coming up on the show. Bad news for Bank of America. While some are buying what Ralph Lauren is selling. Do you have the chinos? Do you have the shirt? We'll talk about that in just a moment right here on Bloomberg.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The employment cost index just had a spike higher. That has unsettled the bond market nerves, and that is hanging over this equity market. Amazon will report tonight. How are they doing with the cloud? How are they doing with Amazon Prime? You just had a conversation there with Cameron Dawson. She said there is a sense that this market has not done with exhausting the downside. Yields are popping and stocks are dropping. That's the narrative at the moment. Your opening calls, your market calls from Wall Street. Argus downgrades Boeing to a hold, pointing to numerous near-term challenges and more aircraft concerns. Needham downgrades Paramount to a hold, seeing limited upside after replacing their CEO. And finally, Jefferies initiates coverage on Ralph Lauren with a buy, highlighting the healthy balance sheet and impressive leadership from management on Bloomberg.
Also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Get ready for a rough and tumble couple of days. You're counting down to the FOMC into Powell's narrative. Tesla gives 3% back after roaring up by 15%, jolted by a higher employment cost index. That sets the table for a slightly more hawkish narrative from the Fed, counting down. Look at that. So many more people turn up at the NASDAQ relative to the NYSE. Anyway, it's a smaller space. We are shaken definitely by these yields, which are popping a little bit higher. Across the rest of the equity markets and the rest of the assets is what we've got for you. The narrative coming out of Europe is, of course, maybe they should hold off. You've got stronger growth numbers across the core of Europe. The dollar remains stronger, euro down by 1%. Yields are up by 5 basis points. There's no doubt about it. That hot ECI, employment costs index, it has definitely irked the bond market. There is no doubt about that. It comes in at 1.2%. The market was looking for 1% in terms of the ECI, and crude is down by 0.5%. So that is certainly a quavering on some of these commodities. There's only one stock to watch. I mentioned to you Tesla. It is on the verge of reporting that the company is set to undergo another round of layoffs. Ed Ludlow is with me. So Ed, it looks like the bloodletting has not finished at Tesla.
Yeah, the layoffs are deeper than Musk initially stated, something that we had reported 10 days ago would be the case. The stock's down 2.7% at the open, but you have to bear in mind the context that yesterday's more than 15% gain was the biggest jump since March of 2021, and that was on tentative or initial approval for FSD in China. The information is reporting, citing a memo from Musk, that Rebecca Tanucci, who led the supercharger team, will no longer work at the company as of today. Neither will Daniel Ho, who was the head of new products. 500 people on that supercharger team that reported into Tanucci, and in the memo, according to the information's report, Musk outlines that many of them will lose their jobs, some of them will be reassigned. What Tesla and Elon Musk said originally when they first disclosed layoffs is verbatim more than 10%. My understanding from sources is that it will be much nearer to 20%, and that when all is said and done, more than 20,000 people will have been laid off from Tesla. You know, it's a big number here, and as we reported in that big take, a lot of it driven by Musk's kind of psychology rather than any pursuit of bottom line savings. So there are the two catalysts there, the news of deeper and further layoffs, but also giving back a little bit after the astonishing jump we saw in yesterday's session. And there is a note of caution from Evercore analyst Chris McNally, who says, don't overstate the substantive nature of FSD tentative news, right? It's a competitive market in China. Tesla's going to have to price aggressively. A lot still to work out.
Well, they are at position number 4, and I think, you know, if you look at this scenario, it's very much look over here. I'm shining over here. I'm shining over here. Don't worry about what's going on over there. There are many industries and many corporations suffer from the same affliction. Thank you very much. Great reporting, Ed Ludlow, on Tesla. Let's turn our attention to 3M. The industrials giant cutting its dividend. That's for the first time in 6 decades of hikes. Joining me now to tell me why is Abigail Doolittle. Abby, what is the thinking here?
Well, usually investors really wouldn't like a dividend cut, but in this case, it may show some sort of fiscal responsibility because they did spin out their healthcare unit about a month ago, and most of the free cash flow, or about 30% of the free cash flow, I should say, past free cash flow, came from that healthcare unit. Relative to the dividend, in the past, it's been 60% of their adjusted free cash flow. So now that some of that free cash flow has gone with that spin out, they're now reducing it to 40%. So again, many investors see this as a prudent move. Relative to earnings, they did beat adjusted earnings by 18%, putting up $2.39. They beat sales by 5% to put up $8 billion. So investors, given the fact that this has been a tough run for this company, they're liking a lot of these results and that dividend plan. It is the last quarter for the old CEO CEO. The new CEO comes in on Wednesday, perhaps creates a natural spot to reset margins, boost sales, and resolve their many, many legal challenges.
Okay, Abby, thank you very much. Abigail Doolittle, turn our attention to fast food. It is a tale of two earnings. McDonald's drops after missing the comparable sales number, while Coca-Cola organic revenue beats. Joining me now is Katie Greifeld. Coca-Cola getting lambasted, of course, for their price rises, Katie. But talk us through the numbers this morning. Good day.
Let's start with McDonald's. An interesting reaction there. When it comes to comparable sales growth, there was just 1.9%. That was slower than analysts had been looking for. And you take a look at what the sell side is saying, that according to Citi, the stock is likely to fall under modest pressure. You had a near-term miss both on EPS and EBIT as well. So you add all together, the stock is down 2.4%. It's a slightly different story if you take a look at what's going on with Coca-Cola. Like you said, they actually raised their 2024 forecast. That's after organic revenue came in at 11% in the quarter. Turning to the full year, they're now seeing as much as 9% growth. Previously, that had been a range of 6 to 7%. But maybe you're not seeing too much movement in the stock. It is moving a little bit higher there, but some pressure to the downside comes from the fact that unit case volume missed estimates. And like you mentioned, Manus, Coca-Cola said that its prices have continued to climb. It actually hiked prices across a mix of its products by 13% in the quarter. So we'll see how much more pricing power they have.
When do we inflect on a Coca-Cola or a Diet Coke? When does the consumer actually kick back? Katie, thank you very much. Katie Greifeld there on the very latest on the retail side. Turn to the payments platform, PayPal. The stock is down. That's after the company missed its operating income estimates, despite seeing an increase in payment volume. Isabel Lee is with me on the numbers. Isabel.
Hey, Manus. Shares actually popped in the open around 5.5%. That's the highest level since August, and shares are now still up around 3%. So PayPal reported total payment volume that beat estimates. The volume was up 14% to $403 billion. That's above that's the higher end of the spectrum for analyst estimates. And for all of 2024, the firm is expecting earnings per diluted share to be around $3.65. That's compared to the $3.84 in the prior year. But last year, we must also note that it included the sale of a firm that they helped acquire, which is Happy Returns. For the full year, the company is expecting adjusted earnings per diluted share to be around $3.83. So PayPal is seeking to really curb expenses and to really right-size the business after a slew of acquisitions, and that's under its CEO, Alex Chriss. So the company overhauled its upper leadership last year. They also cut its workforce to around 9%. Chriss, who took over the role in fall last year, said this remains to be a transition year. And for now, shares are still up around 3%. And year to date, PayPal shares are up 9%, Manus.
Isabel, thank you very much. Well, we're counting down to the Amazon earnings after the bell. And the bar is set high. Meta, Alphabet, and Salesforce, the three tech companies announcing their first dividends and substantial buybacks. Anne Berry is with me, Threadneedle partner and founder. Anne, good to see you. Here we are. We've been rewarded with dividends, first dividends, and significant buybacks. What is the possibility that Amazon delivers some kind of a dividend?
Oh, I'm looking at Amazon, waiting for that movement to come. And if you look at the attributes of those three names, Alphabet, Salesforce, and Meta, which have been wading into dividend territory for the first time this year, these are businesses which share with Amazon the attributes of enormous scale, very strong balance sheets, historically being acquisitive, but are finding this market really an expensive one to try and get acquisitions done in. And so, again, those sort of three precedents leaning into returning capital to shareholders, I think Amazon's got the same rationale to do it, and I've been waiting for a dividend for a while. Over $70 billion of cash on Amazon's balance sheet and counting. It's trending upwards.
I mean, you said that, you know, I love, you've got so many exclamation marks, I didn't know what to do with the caption, which was, here's looking at you, Amazon, exclamation mark, by 25 exclamation marks. I think you were just enthusiastic. It's your favorite one, and you're adding to it. I mean, what is the ultimate driver of why you would add to Amazon relative to Microsoft and relative to Google on the cloud narrative?
Well, on the cloud specifically and the growth of AWS, we're continuing to see corporate capex in moving towards using the cloud a lot more aggressively, and especially when it comes to thinking about cybersecurity considerations and the intensity of more use of data analytics. So the AWS's growth, it isn't the juggernaut it's been in prior years, but it's steady, it's a fantastic cash flow machine, it's very, very high margin, it's extremely sticky. So if you look at that profile, not just to be the piggy bank, the ATM that's going to fund dividends and getting capital back to shareholders, it's also, you know, a fantastic piggy bank, a war chest to go and allow Amazon to continue to invest in things like more live sports on the video side, continue to invest in developing its private label offering on the retail side. I just think it's a fantastic portfolio of not going anywhere services and products.
I look at what you write about Meta and Netflix, and if we look at the price reaction on those days when they delivered their earnings, you know, the numbers in terms of subscribers was great for Netflix, but it was about the projection forward. And likewise with Meta, it was about the projection forward. So to what extent do those kind of cathartic moments in big tech provide people like you to actually pull the trigger and deploy more cash there? Or are you more hesitant when you see this kind of pillorying of stocks?
I would put them in slightly different buckets. Let's start with Netflix. Had some very good news in Netflix, but what I didn't like about it is the fact that the company announced it would cease to report on its subscriber numbers. And so when you see a business like Netflix taking a core metric, shifting in this case towards talking more about engagement, but creating opacity around the core driver of growth, that I don't like, and I think that was a big part of the reaction, on top of the fact that the earnings outlook was at the lower end of estimate.
Does that just lower your trust in the stock?
It lowers the ability to put together projections, and at the end of the day, these are all DCF businesses, they're growth stocks. It makes it very difficult if you're an analyst on Wall Street to have a model that you've got super high conviction in to make calls. So I think it's not so much about trust, it's about the ability to be credible in making your recommendations, and I think that's problematic. I put Meta in a slightly different bucket, which is Meta actually had a pretty good backward-looking earnings result. The problem there with Meta is it's seeking to double down, and this is another credibility issue, double down an investment in AI when Meta has proven it has not been a great allocator of capital when it comes to new technologies, and specifically talking about its investment in the metaverse, where we've seen $40 billion evaporate and we're not sure what's going to come out of it. The idea that Meta is going to be the trusted steward of capital to deploy against AI without a very clear strategy is problematic. And I think we're seeing those with clear strategies versus don't, and those with clear earnings outlooks versus those who don't, really separating in the pile here.
And you're criticizing the genius for spending $40 billion on the metaverse. That's a reasonable criticism. What does he need to do? What does he need to do to reinstate genius leadership within that space? That you would trust him again as a guardian of capital in the AI space. What is it that redefines that narrative?
There's a couple of things with respect to the business model, and we can start with AI. Generative AI is something that is a buzzword. It's all over the street. Very, very few companies have come out and said, this is how we're going to deploy it in our products. This is how we're going to charge for it and monetize it. And this is going to be the impact on the bottom line. We need to see that specificity and clarity coming out of Mark Zuckerberg and his team over at Meta. We also, I think, need to see the following. If we talk about augmented and virtual reality, and Facebook's position in Quest, it is still the leading headset provider. And we know that Vision Pro for Apple has not been taking off and not been adopted with the rapacity that we had hoped. And that's an opportunity there for Meta to lean in and say, look, finally, we're going to prove that some of that capital is decently spent, still not great ROI, because we're going to remain the leader in that space where Apple is stumbling at the moment. I think those are the two things that we need to see and hear pretty quickly.
And we didn't get to the show and tell that you want from PayPal, but the stock is up 4.5%. We'll get round to that when we catch up again. That's Anne Berry, Threadneedle partner and founder, my guest this morning on All Things Tech. Coming up in the show, it breached 160 and the Bank of Japan had enough. Data suggests they did intervene. We will discuss next on Bloomberg.
family was around so many powerful people my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Japan likely conducted its first currency intervention since 2022. The hope was to prop up the yen. According to Bloomberg analysts, the central bank accounts spent in the region of $48 billion to do so. Enda Curran is with me. Well, if they spent $48 billion, Enda Curran, good morning to you. Dollar yen's trading at 157.46. I wouldn't put it down as a resplendent success, but call me a cynic.
No, it's going to be expensive, Manus, and there's no doubt that the backstory to why the yen is so weak is because the dollar is so strong and US rates are very high, and that isn't going to change dramatically, at least, anytime soon. Now, the Japanese authorities have yet to confirm officially that they did intervene to buy their own currency. Our own colleagues in Tokyo ran the numbers on the published Japanese Bank of Japan accounts, and they've calculated that there's about $5.5 trillion there unaccounted for, which probably speaks to the idea that they were intervening to prop up the yen in the market. Now, as I say, the authorities haven't confirmed this. It did drive at least at least a short-term rebound from that 1990 low that it hit. But as you say, the broader backstory of dollar strength and high US rates, that hasn't gone away, and that's probably going to keep pressure on the yen in the near term at least.
It is, and we're counting down to the FOMC, and there's a number of narratives out there, aren't there, and that, well, if they did intervene, why would you intervene ahead of the FOMC? But take this a little bit further, because the other narrative from John Arthur's column is that Ueda's narrative and guidance on inflation was moderately dovish on Friday, and yet we volte-face 48 hours later, and if they confirm that they intervened, it kind of undermines the narrative of Ueda.
It's tricky for them because, practically speaking, by the way, or tactically speaking, there's a view that if they did intervene, they chose Monday because it was a holiday, so thin liquidity, more bang for their book. But as you say, we've got the Fed coming tomorrow. Broadly speaking, analysts are expecting, something of maybe a hawkish message from the Fed. That's obviously going to impact Japan's currency. The authorities there say it's not about the level, it's about the pace of the decline. It's about gappy moves. That's what forces them to intervene. They're not standing back and targeting any particular level. They have to respond on the day that's in it. And of course, the cheap currency. Yes, on paper it might help exports, but there are variables in that story as well. But it also means Japan is importing a lot of inflation through its energy and through its food. And tradable inflation is a big part of the Japanese inflation story at the moment. So it's a complicated balancing act for the authorities, but the line they keep pushing is it's when it's gappy and when the price action is too volatile, that's when they look to step in. They're not necessarily targeting a level per se.
And if we just broaden this conversation, and we have a strong, a unique position for the dollar. It's already been identified by the IMF as being problematic. Yellen has got this cohort, this trifecta cohort between South Korea, Japan, and herself, i.e. the United States of America, tacitly accepting that they may need to intervene. But from a broader FX perspective, for other emerging market central banks, and this strength of this dollar is becoming almost to a breaking point for them.
Well, it's definitely a complication, no doubt about it. If you're in an emerging economy and you want to bring down your own local interest rates to support growth, it's complicated because dollar strength means your own local currency is weak. That means you're importing inflation, and of course it's creating other problems too in terms of your capital flow. So it's definitely slowing down the process for emerging economies and some advanced economies to bring down interest rates. Now, broadly speaking, the emerging markets have held up pretty well over the past few years, despite everything that's been thrown at them with COVID and with the inflation shock and the high interest rates that have come. One of the messages from the IMF recently was that EM has held up better than expected. But the longer US rates stay high, the longer the dollar stays strong, then of course, yes, that pain will continue to flow over to emerging markets. It was a talking point here at the IMF meetings a few weeks ago, and it certainly does remain a major complication for central banks in that part of the world.
Yeah, well, you just look at year to date and all of G10. There's nobody can challenge the dollar. Even old sterling's down 1.6% against the dollar. Time to change those dollars, Enda. Thank you very much, Enda Kern, on the potential. We wait for confirmation on the Bank of Japan whether they did intervene or not, but the data looks as if it's flexible. Abigail Doolittle is with me as ever to define the sectors and the movement.
Well, it's pretty bearish right now, Manus, even though the overall decline for the S&P 500 itself is down about 0.2%. So not a big decline, but most sectors, 9 of the 11 S&P 500 sectors are lower, led by materials, energy, real estate, consumer discretionary, utilities. Those sectors all down more than 0.5%, but less than 1%. So not huge moves to the downside. Healthcare, on the other hand, being boosted by Eli Lilly on a good quarter on those weight loss drugs, up about 0.5%. You also have communication services just slightly higher. Relative to the month, we're looking at the worst month of the year. The S&P 500 heading down about nearly 3%. That puts it on pace for the worst year of month since September of last year. The two best sectors, energy and utilities. The two worst sectors, healthcare and real estate. It's interesting that utilities and real estate are splitting, Manus, only because they trade largely on dividends and rates. So the one is trading higher despite higher rates, and the other is trading the way, real estate trading the way you would expect, with rates going higher, pushing some of those stocks lower.
There you go, 7.5% is quite a bruising. Abby, thank you very much. Abigail Doolittle on the sectors. Coming up, we'll set your clock for the events you need to know right here with your Trading Diary.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Tesla had a banger of a day yesterday, up 15%. It is the drag today on the tech sector, down 3%. More job cuts may well come through. There is one saving grace in the underbelly here, and it's Eli Lilly, up over 8-9%. It is all about their obesity drugs. It's flying off the shelves. Stocks can't maintain. Right now, we're dealing with a spike in yields on the back of a higher cost index, employment cost index, and that irks the markets as we count down to Amazon's numbers. That's what's on the slate after the closing bell. Then you get the JOLTS data tomorrow at 10 a.m. Plus the Fed chair, he will speak after the Fed's decision. Apple's earnings after the closing bell, how bad was it in China? We will get the authoritative message. And that rounds out the week on Friday with the jobs report. Given the hot print that you've had in the ECI, we're going to keep a scrutiny across the wages data. That was countdown to the open right here on Bloomberg from New York. A very good morning.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast here. Alex Steele and Paul Sweeney, we are here in New York City. I'm looking at some economic data. The Conference Board Consumer Confidence came out 97. The reading of 97. The outlook was 104. And last month was 104.7, and it had a negative revision. So we're going to check in on all that data. We're going to do that with the Dana Peterson of the Conference Board. We'll kick that off. Then we'll check on the markets with Abigail Doolittle, and then we're going to also check in with Ira Jersey and see what his take on this Federal Reserve is. Ira Jersey is the chief U.S. interest rate strategist for Bloomberg Intelligence. Again, tomorrow, Fed Day, so we'll get a preview there. And we're also going to check in with Geetha Ranganathan of Bloomberg Intelligence. What is going on with Paramount? I have no idea. They don't even have a CEO anymore. We'll see what's happening there. All right, let's kick everything off right now with Miss Lisa Mateo.
You got it. And Market Driver is brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, stocks taking a bit of a hit after a sign that persistent wage pressure is keeping inflation elevated. We're talking about the employment cost index. It increased 1.2%, the most in a year. That was higher than expected, also higher than at the end of 2023. Now that comes ahead of tomorrow's Fed decision on interest rates. Comes out at 2 p.m. Wall Street time tomorrow. Our coverage begins at 1:30. Begin to tune in there. We also learned that FHFA's February house price index increased 1.2% month over month, much higher than the 0.2% that was expected. And you heard Paul say at the Conference Board's April reading on consumer confidence, well, that was a big miss. That came in at 97. The survey was from 104, and the month prior was 104.7. As for stocks right now, so we have the NASDAQ little change, the S&P 500 down 0.1%, the Dow down 0.5%. We have the 2-year yield at 5.01%, up 3 basis points. The 10-year yield at 4.66%, up 4 basis points. As far as commodities, spot gold lower at $2,307 an ounce. Brent crude $87 a barrel. NYMEX crude $81 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. That's an ugly number. That consumer confidence number at 97. The expectations coming in 66.4. You got to wonder what's behind that.
Yeah, and that expectation 66.4 is down from last month's revised up 74, so a big drop there.
Well, luckily, we have Dana Peterson here. She's chief economist over at the Conference Board. They do this data, so it's great that we get her for that instant reaction. So just to recap, that consumer confidence number coming at 97. Dana, what happened? What's behind that?
Sure. This is the third month that the index has fallen off, and certainly in the month, consumers were less optimistic about current employment conditions, and certainly looking forward, they were less optimistic about employment, business, and also income. But I would say that if you look out over the last 2 years, the headline measure has been moving back and forth in a pretty narrow range. But still, in all 3 months down, we really wonder what's going to happen in that fourth month.
So how long is a trend here? I mean, it feels like a trend to me, and I'm looking at some of the revisions downward here. What is this data really telling us here? Is there a problem for this U.S. economy here?
Well, I would split it out. So the headline is made up of present conditions and also expectations. So the present conditions index has actually stayed pretty much afloat, even though it's moving back and forth a lot. But expectations really came off about a year or so ago, and they've just been flirting with that 80 threshold, and below 80 usually signals a recession. So it suggests consumers are a little worried about something. They're concerned about inflation still, and they're getting a little bit worried about the labor market.
So to that point, this kind of goes to the whole idea that people feel really bad, even though the overall data, like you could look at the employment cost index coming in higher than estimated. You know, GDP, I realize, was a little cool, but still, the data actually comes in pretty strong. How do we understand that?
So I think the key thing is, on the one hand, consumers are working. And so they feel good about that, and they have income coming in. But then that income is eroded by inflation. Prices are still elevated, even though prices aren't rising as quickly as they were. The level is high. People are saying eggs are $8. I'm not used to that, and I don't really like that.
All right, Dana, thanks so much for joining us. Dana Peterson, she's the chief economist at the Conference Board. Kind of breaking down some of these consumer confidence data coming in today. And again, the headline, as Alex just reported, Conference Board consumer confidence came in at a reading of 97. The consensus was 104. So a pretty big miss there.
Straight up inflation.
Straight up inflation.
I mean, like, you're right. If you're going to go pay $8 for eggs, like, that's how you feel. It doesn't matter what your paycheck necessarily is.
Absolutely. Looking at the markets here, we are open. We've got a little bit of red to the tape here. The S&P off about 0.1%. Same for the NASDAQ. Abigail Doolittle joins us here in our Bloomberg Interactive Broker Studio. She covers all the markets for Bloomberg. Abigail, we've got a lot of economic data today. Of course, lots of earnings releases as well. What are you looking at?
I think those earnings releases stand out to me a bit. 3M right now up about 4% at the highs, up about 5%, the best day in nearly a month. They reported a good quarter. They also cut the dividend, which in this case is seen as financial prudence because they spun out their healthcare unit, and most of the dividend that they would pay would come from the free cash flow for 30% of it. So some financial prudence there. We also have PayPal higher, which is kind of interesting only because the results were a little bit mixed. Eli Lilly up 7.2%. That is the best day since, let's see, I'm pulling it up right now in the Bloomberg terminals, since August of 2023, and they put up a nice beat.
That a Wegovy special, basically?
Yeah, and the weight loss drug. So a lot of heft there. And then on the other hand, we do have Tesla down about 3% on the sort of news of additional layoffs. Microsoft down. So kind of a mixed bag here right now. The S&P 500 down about 0.1%. So not a huge move on the surface.
What do you make of PayPal? So the number seemed okay for PayPal, right? I was trying to get a read on like how people were buying or using PayPal. If there was any sort of buy now, pay later or credit. Did we learn anything from that perspective?
You know, I don't have that level of detail. I was taking, speaking about the surface, I was taking a look more at the surface there in terms of the broader numbers that they put up. I believe that the volumes were relatively
good.
Strong. Yeah.
I just don't know where PayPal fits in the fintech space. It feels like it's a company that's been around forever. Yes, they, as Ariel pointed out to me earlier, they do own Venmo, which to me is a little bit more cutting edge fintech. I use it. I don't really use PayPal. I think by PayPal, you got to go up against Apple Pay and Venmo and Square.
But I think that they're also trying to do like other products, right?
Yes,
as I get out my phone to bring up PayPal, like
Yes.
the other products, credit cards. Like
Do you use PayPal?
I do. I use all of it. I use Zelle,
Yes.
Zelle,
Yep.
PayPal, and Venmo.
Okay.
Because like certain people won't take certain
Right.
things, and there's different securities and stuff
So
like
you're
that. So I
very
use all of
cutting
it.
edge fintech. I would
That's
say.
what people tell me. They tell me, Alex Steele, you are cutting edge fintech.
When's the last time you wrote a check?
I know, my husband still writes checks, and I'm like, oh, come on, man, seriously? Like, that's a waste of money and paper and trees and the whole thing. Abigail, just before I let you go, in terms of levels, what are you looking at? We get Amazon after the bell, so I'm kind of wondering where the levels are that you're looking at for the overall index.
Yeah, well, I'll take a quick look at Amazon because the individual stocks will determine it. So that stock had an interesting bounce off of support, so that's a tough one to call. But relative to the S&P 500, the last time that I looked, the broader indexes looked really pretty heavy. So I'm pulling it up right now, having been out yesterday. Yeah, still below that 50-day moving average, off of the 100-day moving average. It's tough to say. It looks a little bit less heavy than last week, almost as though there's going to be a near-term bottom, but probably not back above the last high. So we might just see a continued battle between the bulls and the bears.
And we got earnings coming out after the close for Amazon, so that'll be a big one. And then, of course, I guess Apple on Thursday after the close, so that'll have a...
And in between the Fed, so...
Yep, exactly.
Something for everybody.
Something for everybody. Abigail Doolittle, thank you so much for joining us. Abigail Doolittle covers the markets for Bloomberg News. I want to go over to... Ira Jersey. He's Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Ira, lots of economic data out today. I guess a lot for this Federal Reserve to chew upon. What do you think we're going to hear from Jay Powell and the Fed tomorrow?
Yeah, I think the consensus is building that Jay Powell and the statement in general is going to be a little bit more hawkish than the last meeting. Given the preponderance of economic data, particularly the hard economic data. You know, you mentioned, you know, about the Conference Board report earlier today not being, just a couple of minutes ago, really, not being particularly good, right, under 100, which tends to mean contraction. But what you've seen in the data is that the hard data, so things like retail sales, the payrolls reports, the GDP numbers, the other inflation reports have all been relatively good. You know, the wage data this morning for the employment cost index showing that wages are growing over 4% a year across the board pretty much. You know, all of those are pretty solid, even though the survey data is suggesting that there should be a slowdown or modest contraction in a lot of things, and you just haven't seen that at all yet. So I think that the Federal Reserve has a reason to be somewhat cautious, and I think that Jay Powell will basically say, hey, we're not going to be cutting rates if the economy stays as strong as it has been.
Do you think that that hawkish bent is already priced in? Like, what's the bar for even more hawkish reaction from the market?
Yeah, well, so certainly if Jay Powell is more hawkish, which is a little bit hard to gauge exactly how hawkish he needs to be, you know, you can certainly see the rates market sell off. I think the treasuries are a little bit on edge right now, so you can see two-year yields maybe pop up toward 1.15% in a hurry, and maybe 10-year yields, if they break 4.7%, could kind of be off to the races a little bit, just as people take off some of their some risk, and the market reprices yet again for the path of the Fed. Because you remember, even though we've priced out a lot of the interest rate cuts and for this year, we're still pricing for interest rate cuts for next year, certainly less than we were, but we're still pricing for the Federal Reserve to lower interest rates by the end of 2025. So the market kind of continues to readjust their expectations as to what the probability of that risk is. And in fact, I've mentioned, you know, to you guys in the past, but the options market now is actually pricing for some reasonably high chance, 25% or so chance that the Fed actually increases interest rates this year, which it was not the case a couple of months ago. And you know, in February and March, the market was pricing maybe just for a couple of percent chance. So basically a very low risk of a hike. Now it's, you know, pretty reasonable chance.
Hey, Ira, just a silly trading question. Do traders ever put positions on trying to trade around the Fed? Like, if I think the Fed's going to be dovish, do I put a trade on today? Does that happen anymore?
Yeah, people do that. You know, a lot of times it's done in the options market, so it's not necessarily done in cash treasuries, or if it's done in cash treasuries, there's some kind of hedge on the other side. So people will, you know, maybe buy, you know, buy treasuries or buy treasury futures, and then on the other side they'll buy puts on, maybe some out-of-the-money puts to hedge that position. So, you know, people still do trade it, but it winds up being more of a, you know, more of a, I don't want to say symmetric bet, but maybe skewed one way or the other. So, for example, if people think that Jay Powell might be more hawkish, maybe they sell treasuries, but at the same time, they're worried that maybe the market's already expecting that, so they'll do something like buy out-of-the-money call options or something like that for rates to go a little bit lower. So, so people definitely trade it. People definitely position for it, right? Because if you have a large risk position one way or the other, and you know, you think that there might be a shift in that sentiment after you know, a speech, or certainly after a Fed meeting, then, you know, people are going to, you know, kind of trade the tails. I would, you know, that still definitely happens on a pretty regular basis. Just look at the options flows every day, and you can see that.
No doubt there'll be a question asked of what will be the conditions for a hike. How do you think Jay Powell answers that, and how do you think the market reacts to that?
I think he'll be a little bit coy. I think he'll just say, you know, if inflation starts to reaccelerate, you know, we'll do what's necessary in order to come back to our target, right? He'll say something like that. He won't necessarily pre-commit. But I think at this point he has to acknowledge that, hey, you know, inflation came down a lot last year. It's now more settled into a range, but it's still not near our target. So you know, we think that we'll do what's necessary in either direction, right? I think he'll try to make the statement somewhat more symmetric and balanced than what you heard, say, in January and December for sure, when you know, everyone was they were very dovish. They were just talking about cuts. They weren't talking about even keeping rates the same in the event that that inflation didn't come down. So the interesting nuance might be in regard to a hike is also, why do they think that policy is restrictive? Like what gives them an indication that interest rate policy is restrictive at this point? My guess is they'll point to the Fed funds rate over inflation, but even that hasn't been growing very much recently. So it'll be that's a question that I would ask. Like if I was to give Mike McKee some advice for tomorrow's press conference, I would say ask him about why they think financial conditions are tight, because it doesn't seem that way when you look at credit spreads, when you look at equity markets, right? When it just doesn't seem that the long and variable lag is even long. It might be even longer than what has traditionally been the case.
Hey, so Ira, when you talk to your institutional investor clients, are they more interested on the short end of the curve where they can get 5% yield on a 2-year, or are they going out 10 or 30 years? What's kind of the smart trade these days?
Yeah, so it depends on your mandate. I think there are a lot of people who are a little bit more biased toward the front end for that reason that you talked about. And also, if you're a real money investor, you don't have to, borrow money or not levered. If you buy 5-year notes at 5%, basically interest rates have to double from here over the next year in order for you to start losing money. So it's, the risk reward in the front end. So, whether it's 2-year notes or 3-year notes is just better. The risk is, and I think that this is the thing that one reason why some people prefer things like the 5-year note is because if they're wrong and the market rallies a lot, right, and you wind up with a situation where 10-year yields, even if they go to only 3.5% and 2-year yields go down to 2.5%, you can wind up underperforming the Bloomberg Ag or the Bloomberg Treasury Index, just because you need to be somewhat long duration. Because if you're short duration, your prices just don't go up fast enough to keep up with the market.
Yeah, I have a buddy of mine, big time hedge fund manager, retired. Now all he does with all his gobs of money is just roll short-term T-bills.
Yep.
I've lost all respect for him. I mean, he used to be a player. Now he's just, it's too good. I mean,
you lost respect, but hey, how's that yield there, buddy?
He yields darn good. I mean, so maybe he knows he's onto something. All right, Ira, thanks so much for joining us. Ira Jersey, he's U.S. interest rate strategist for Bloomberg Intelligence, joining us via Zoom from Princeton, New Jersey. But he says, he's been in the game 30 years. He says, we haven't had this in such a long time. I can take zero risk and get a very nice return until I can figure out what to do. And he's like, this is fun. It's easy.
Yeah, I mean, I don't blame him. But what's so funny, though, is I feel like even a couple months ago, we were like, oh, well, it's going to be over now. We're going to get cuts. So where do you put that money market fund money? And now that is definitely not the case. We're going to ask that very question to Chris Watling. He's CEO and Chief Market Strategist of Longview Economics. He's going to join us in just a minute from Canada. So he was looking at equities undergoing a pretty healthy correction, albeit a relief rally last week. And then the question is, now what? As we're digesting earnings and then the Fed as well as jobs data, how do you manage this kind of market? Is it just short covering now? Is there real money coming in? We'll discuss. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got right on the screen after the employment cost index, it increased the most in a year, and that's kind of reinforcing those thoughts that the Federal Reserve will be in no rush to cut interest rates. We have the S&P 500 down 0.2%, the Dow down 0.4%, the Nasdaq also down 0.2%. We'll take you over to the bond market. The 2-year yield at 5%, that's up 2 basis points. The 10-year yield at 4.65%, and that's up 3 basis points. To commodities, we'll take you to spot gold lower, $2,305 an ounce. We have Brent crude, $87 a barrel, NYMEX crude, $81 a barrel. And to currencies, we have the dollar stronger, Japanese yen, euro, British pound weaker. We have Bitcoin down 3% at 60,730. Finally, some news from Walmart. Their shares are down more than 1% since it's closing its health centers, telehealth business due to escalating costs and reimbursement charges. And some more news. Vizio saying that Walmart's deal to buy the smart TV maker is going to undergo an in-depth antitrust review by the FTC. Vizio shares down 2%. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. Happy Tuesday, everybody. We made it to the second day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news with our amazing analysts worldwide. They cover about 2,000 companies and 130 industries. We also want to give you the perspective of bigger market strategists, right? Like, how do you look at it if you're looking at the longer-term perspective when it comes to equities, and how the short-term is dictating how you're going to see the outcome. Chris Watling is CEO and Chief Market Strategist over at Longview Economics. He joins us now from Toronto, Canada. So I'm looking, Chris, at an S&P chart of 1 month. And clearly, we had a decline last week, right? We've retraced that. We're up about 3% from the lows, but we're still down by about 2.5% from the peak that we saw back in early April. What do I make of the market?
What do you make of the market? What a great question. And morning, Alex and Paul. Great to be on. Yeah, I mean, I think it's time for a bit of give back. I mean, think about it. It's been extremely good run all the way from the sort of lows in October last year through to where we were at the beginning of April when we sort of hit the highs on the S&P. And since then, I think we've had just a bit of give back, a bit of a pause, what I would call a healthy correction. And, you know, part of the reasons for that is I think the market's starting to think about the liquidity environment over the summer. You know, the RRP, this draining of the RRP has been a real driver for stock markets, for risk assets over the last 7-8 months. As that's been drained and liquidity's come into equities, that's been a real positive. And also, I think there's some issues about yields backing up is a bit of a sort of biting on the valuation side of the equity market. And then on top of that, personally, I think growth's going to surprise a little bit to the downside in the States this year. So grappling with all of those, I would say. And as you said, the market bounced last week. It sold off the prior week. You know, markets don't go down in straight lines. They don't go up in straight lines. So I think we've begun early April a bit of a give back, a healthy correction, as I say. And I think it's good for the market. So it's important. And it often happens at a time when you begin some rotation in sector leadership. So that's kind of interesting as well.
Chris, we're about halfway through earnings season here. Anything jumping out at you so far? I mean, I guess revenue is surprising, maybe 1 or 2% on the upside. Earnings, maybe 8 or 9% on the upside. Anything surprising you?
Well, I mean, the interesting thing, I mean, somewhat surprising, but somewhat sensible, I suppose. You've got that following wind when earnings have been a bit better. So as you say, the earnings are surprising to the upside. They are delivering growth. I think the collective surprise is about 8% at the moment, and normally it's 3 or 4% positive surprise. So that's coming in. I think it's quite interesting how some of the big stocks have been very mixed. We've seen over the last 7 or so days, you know, some of the big cap tech having very different outcomes and very different performance as a result. So there's a lot of volatility on the back of that in some of those stocks, you know, 10% moves on the day on earnings announcements. So I'd say those are probably so far the key features. Lots to go for lots to come.
So Cameron Christ writes a daily newsletter. He also contributes to MLive, and he had one of the best sentences I've heard in a while on his daily article today, Chris. He said, one of the basic principles of successfully navigating financial markets is that you should only date, not marry, your positions. Begs the question, what positions should you date, and what should you marry right now?
Well, I like to think of it as renting, not owning, rather than dating, rather than marrying.
Okay, I kind of like the date and marry, but okay, I see your point. Rent versus owning. Fine.
Yeah, it's all the same. What should you date? What I think you should be dating if you're a very short-term trader, you should be short this equity market for a bunch of weeks, a couple of months, and you should be thinking about marrying at the bottom in a month or two's time, because you know the soft landing that I think is going to come in the US, coupled with some eventual rate cuts. Certainly out of the Fed, but also, of course, out of the European Central Bank and out of the UK. That's all coming. That's all very positive. So, you want to date in the short term and rent in the medium term. Gold we like, and gold you could almost marry. I mean, gold is it's a terrific asset class at the moment. It's had a great run already this year. Of course, it's given a bit of that back recently, but it's got a lot going for it. The Chinese are buying. There's some stories, I think, on the Bloomberg terminal today about Chinese buying, central bank buying. That's been a theme all year. And it's not just the central bank in China, it's also the retailer in China is starting to buy. And there's of course, an awful lot of them and a lot of liquidity around there. So we like gold, and it'll be helped when the Fed eventually starts cutting rates. So I as I say, you could almost marry that. I actually think European banks you should own and rent and buy and everything. I think our left of field recommendation at the moment is buy Spanish mid caps, which is really out there. But
Spanish mid caps.
Yeah, I know. It sounds a bit nuts, but actually there's a lot to be said for them. It's an economy that's been neglected and no one's really talked about for 10, 15 years since the Euro crisis, of course, the pigs crisis, as it was known, with the S being Spain. The economy's really sorted itself out over these last 15 years, healed a lot of structural imbalances. It's well set, and it's going to get rate cuts when the ECB starts cutting, and it's going to benefit from those. And I think we're going to see strong growth out of Spain. And of course, mid caps is a great way to play a domestic economy. So that is an own and a marry, basically, not a rent or whatever the other one was, date, yeah. So there's so much going on. There's so many opportunities out there. But yeah, you've got to distinguish between trading and investing, which I think.
Let's go hyper local. How's the economy in Clapham, which is a neighborhood south of London?
Clapham.
How's it going? That's a great question. I do actually live very close to Clapham. I'm obviously in Canada at the moment, but
that's too bad.
Clapham in South London is buzzing because it's full of 20 and 30-year-olds, basically, who love to get out, and the sunshine's starting to come out, and it's that time of year. So, but the British economy is not good.
No.
Which is perhaps more to your question. The British economy is flat. It's had no growth in 2 years. It's flat as a pancake. It desperately needs rate cuts, and we're going to be getting those pretty soon.
Yeah, so is that the expectation, that the Bank of England is not waiting on the Fed, that the Bank of England is confident to cut rates sooner?
Absolutely. I think the Bank of England is just like the ECB, and you would have seen Christine Lagarde a couple of weeks ago say, the ECB is data dependent, not Fed dependent, trying to make that distinction between the Fed and the European Central Bank. So same in the UK, different inflation dynamics, different growth dynamics, and therefore a need to get on with cuts.
Wonder what the currencies are going to say about that and the rate differentials. But okay, let's play it out a little bit. How strong does the dollar actually get? I mean, it is definitely breaking things.
It is breaking things, and you're quite right. It's probably I think it's got one more flurry in it, in this sort of risk-off phase that we're thinking about in the near term. And of course, the dollar's a classic recipient of liquidity when it's risk-off. But beyond that, I think we're going to get into a dollar bear market. We've had a dollar bull market now for a long time, sort of 10 plus years, depending on your starting point. But a long old dollar bull market, and I think we're due a change in that sort of secular status of the currency. So, yeah, I'd give it a few more weeks of strength in the dollar as we complete this risk-off phase. Then as we get closer to Fed rate cuts. Because, I mean, I think really in this risk-off phase that, the market wants to bully the Fed for cuts. We're still doing QT. I mean, this is an extraordinary thing. And I think this will be tough for the stock market with QT ongoing. So I think one more flurry in the dollar.
One more flurry. And real quick, Chris, I mean, are we going to get a rate cut in the U.S. here this year?
I think so, yeah. Okay. I mean, I know the data's so mixed, isn't it? I mean, ECI not so good today, consumer confidence bad. It's a two-speed economy, and I think that's why the data's so confusing. But I do think the reality is money is much tighter than it has been. Fiscal stimulus is not as good as it was last year. In fact, quite the reverse. And so I think inflation will dissipate and you'll get a cut. And maybe two, but certainly one.
Hey, Chris, really appreciate it. Chris Watling joining us from Longview Economics. Just side note, Paul, Chris knows this, but you don't.
No.
He is my mom's favorite.
He is?
He is.
Nice.
He has been for a while. He doesn't know what to say to that. I just feel like he used to be on with me in the morning show. We used to jam for like an hour or two, and she's Carol Steele's favorite.
Oh,
putting that out there. It's a big deal. It's a big deal.
That means a lot.
And speaking of the Fed, Bloomberg Radio has full coverage for you starting at 1:30 Eastern tomorrow. Very much, Paul, looking forward to that.
Tom, Lisa, and John Farrell. How good is that?
So good. Can't get any better.
Talking about the Fed, and then and Michael McKee. We're sending him on the Acela train this afternoon. He'll be down there ready to go and ask his question or two of the Fed chairman during the press conference tomorrow afternoon, which starts at 2:30 p.m. Wall Street time. Looking at the markets here, S&P 500 off 0.3%. NASDAQ about 0.4%. With our news in New York City, here is John Tucker.
All right, Paul and Alex. Donald Trump has been found in contempt of court. He's been fined $9,000 after a New York judge overseeing his criminal hush money case ruled the former president repeatedly blasted key trial witnesses on social media in violation of a gag order. Judge Juan Merchan issuing his ruling this morning after prosecutors argued that Mr. Trump had repeatedly posted on social media about adult film star Stormy Daniels and ex-Trump lawyer Michael Cohen, both key witnesses in the case against him. Trump was fined $1,000 for each of 9 violations. If he does it again, the judge warned he could be jailed. The pro-Palestinian college protests have been expanding across the country. Students at Columbia University have been occupying parts of a campus building. Dozens of students entered the campus building known as Hamilton Hall after midnight, barricading themselves inside, piling tables and chairs to block doors. Seta Pollitt, one of the organizers, refuses to go. She calls the protest peaceful and even unifying.
There has been no violence on this encampment. Students from diverse backgrounds have shared their religious observances together.
And this from the Yale Daily News this morning in Connecticut. New Haven and Yale police, they've moved in to arrest protesters on the Cross campus there. King Charles returning to public duties today, visiting a cancer treatment charity and beginning his carefully managed comeback after the monarch's own cancer diagnosis sidelined him for 3 months. The event marking the king's first formal public engagement since February 6th, when Buckingham Palace announced that he would be taking a break from public duties to focus on his treatment for an undisclosed type of cancer. Global news 24 hours a day and whenever you want it, but Bloomberg News Now. I'm John Tucker, and you're listening to Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks set for the worst month in 2024 as data showed a plunge in consumer confidence, also high labor costs. Now, this comes before the Fed announces their decision on interest rates tomorrow. The central bank is expected to hold borrowing costs at more than 2-decade high. We shall see. Right now, we have the S&P 500 down 0.2%, the Dow down 0.4%, the Nasdaq down 0.3%. The 2-year yield at 5.01%. That's up 3 basis points. The 10-year yield at 4.66%. That's up 4 basis points. To commodities, spot gold lower at $2,298 an ounce. We have Brent crude at $87 a barrel, NYMEX crude at $81 a barrel. I want to check in with Europe's largest bank. Yes, we're talking about HSBC. Their shares are up 4% in Europe. And this is after solid earnings, but also the surprise departure of its CEO, Noel Quinn. And then Goldman Sachs, they're down about 0.2%. Wall Street Journal says it's in talks to transfer its GM credit card business over to Barclays. Barclays shares, they are up 0.2% in London. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that as always. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. Also streaming live video on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. All right, Paramount. Paramount is the old CBS television network and stations. It's the Viacom, which is MTV and all that kind of good stuff, the Paramount movie and TV studio, all that's wrapped up into this company being named Paramount. A lot going on there. Let's put it. I mean, they got reported earnings last night, mixed. They replaced their CEO. That's not good, with an office of CEO. And, oh, yeah, they're actually in discussions to be sold to one or more parties. I'm not sure what's going on there. A lot of moving pieces. Luckily, we have Geetha Ranganathan joining us. She's a media analyst, the media analyst for Bloomberg Intelligence. She's based in Princeton, New Jersey. So, Geetha, let's start with the potential ownership change here. There's lots of parties looking at Paramount. I guess the Skydance, which is the media company owned by Mr. Ellison, the son of Larry Ellison of, what is that? Where is he from?
Oracle. Oracle.
Oh, yeah, Oracle. Thank you. So where are we with those negotiations, Geetha?
Yeah, good morning, Paul and Alex. So we're in the thick of those negotiations. There is an exclusive negotiating window that Paramount agreed to with Skydance. That one actually expires this Friday. So obviously the ouster of Bob Bakish as CEO, who was vehemently opposed to the deal, seems to suggest to us that they really have something lined up and something's kind of going to go through pretty quickly.
What did we make of the actual earnings? I mean, I was on air breaking the numbers yesterday, and we didn't even talk about the numbers. We just talked about the CEO replacement and the weird 3 CEO thing they got going on. What did we learn within the numbers?
So the actual earnings by itself, Alex, was not bad at all. I mean, there were definitely some encouraging elements. We saw advertising hold up really well. But again, one could argue that core advertising is still challenged. The reason that they reported the 17% increase in advertising revenue in the first quarter was really all driven by the Super Bowl telecast. That said, I mean, if you kind of looked at their streaming business, we did see a pretty good momentum there in terms of subscriber numbers. We did see some progress on profitability, which is not to say that it's actually profitable, just that the losses were a little bit better than what we were expecting. But overall, I mean, this is right now, as Paul kind of pointed out, this is peak uncertainty at Paramount right now. We don't know what's going on with ownership. We don't know what's going on with leadership. We don't know what's going on with strategic direction. So it's all up in the air.
So, Geetha, I guess one of the big questions on any change of ownership is what are they going to pay per share of the buyer, and are they going to pay the same price for Sherry Redstone's controlling shares, the super voting shares? Are they going to pay the same for those shares as they will for the plain old shareholder shares? So how's that work?
Yeah, they're not, Paul. And that's kind of been the whole bone of contention, right? So the whole Skydance proposal is kind of this very convoluted offer. It's this two-step proposal where they basically pay out Sherry. Her interest in Paramount is worth something like about $850 million. They're going to pay her upwards of about $2 billion. So she's getting a nice pocket of change there, but it's basically diluting everybody else. And that's why you have all of this shareholder consternation. Of course, Skydance is kind of addressing announcing that now. They have sweetened the bid a little bit. They've thrown in about a $3 billion cash infusion to pay down debt, to buy back stock. But I'm not sure if that's going to be enough.
Do you feel like this is the best and final offer from Skydance as we get to that Friday deadline?
That's what they have said, yes.
Okay. Did we learn anything from the numbers yesterday that shows what a buyer should be paying for shares?
So we do have another concrete offer on the table, one that Sherry Redstone rejected. This was the offer from Apollo, which basically offered, $12 billion for the equity of the company versus what it's currently trading at, which is about $8 billion. Roughly about $19 to $20 a share. So that's kind of where the Apollo deal stands. Of course, now there have been rumors that they're partnering with Sony to again take that bid up a little bit. But when we kind of did a sum of the parts analysis, we think that this company is easily worth upwards of $20 a share.
Yep, I've seen that. So folks, if you want to check out that research analysis, you can go to BI, go in the terminal, and search for Geetha's work. They did a lot of valuation work on Paramount. A lot of investors are looking at that work as well. So, Geetha, Friday is, I guess, one kind of date to keep in mind, but it just seems like with this dual class of stock and maybe different prices being paid for different classes of stock, this thing's going to end up in court. It just feels like. What are most people thinking about this?
I think it definitely there's a very, very high probability of litigation. I mean, it's not probability; it's almost a certainty at this point. Everybody has said, all the big shareholders, including Mario Gabelli, has said that they will definitely litigate if Sherry Redstone actually goes through with this deal, a deal which does not treat all shareholders equally. And this isn't something new, Paul, with Paramount. I mean, we've seen this litigation stuff happen over and over again. But it definitely is a huge risk, and it's going to be interesting to see what Sony and Apollo kind of come up with in the meantime.
Before I let you go, Warner Brothers Discovery is down like 8%. Why?
Why? Because no NBA. So their NBA rights are actually being negotiated right now. They're currently paying about $1.2 billion. Rumor is that NBC, which is owned by Comcast, is kind of swooping in, ready to pay about $2.5 billion to the NBA and snatching away the rights from TNT. That's where Warner Brothers owns TNT. That's where they show the NBA games. And remember, TNT is kind of the anchor to the Warner Brothers TV portfolio, and the NBA is the anchor to the TNT network. So not having that is really going to hurt them. It's hurting them, as you can see in the stock price today.
Speak of turnover and CEOs. How about David Zaslav, the CEO of Warner Brothers Discovery here? I mean, the stock's down 34% this year, down almost 50% over the last year. Holy cow, John Malone cannot be happy with what's going on here. What's the thinking about Warner Brothers Discovery here?
Hard to say, Paul. I mean, the whole story here was supposed to be synergies, which I think they've done a pretty good job on. But what's really kind of been out of their control has been the TV ad market, which has really, it's of course secularly challenged. And I think what made it even far, far worse was the Hollywood strikes, which just kind of resulted in no good content right now. And so they're kind of trying to work through all that. But, we've chatted before about this. The EBITDA number that they kind of showed everybody was 14 billion. This year, they're going to go below 10 billion. Add to that, about $40 billion in debt. And it's really just a train wreck right now.
I mean, I feel like that is well said. I said hot mess yesterday about Paramount, train wreck about Warner Brothers Discovery. It kind of sums it up, I think, for
the
us
life
here.
of a media analyst and media investor these days.
Yeah, it's so crazy.
Tough place to be. Yep.
It is.
It's a tough place to be.
And we can make hay about Paramount. What I think is 71 million subscribers. Like, but then compare that to Netflix.
Right.
Forget it.
A couple hundred million.
Geetha, thanks a lot. We appreciate you. You are the best. Geetha Ranganathan. She joins us. She is head of U.S. media coverage for Bloomberg Intelligence. What's interesting, too, I think, Paul, is that when you get to these companies, like the numbers in some ways then matter less.
Yep.
It's more about what the strategy is going to wind up being and who's going to be able to turn it around. Same thing for Warner Brothers Discovery and same thing for Paramount.
Yeah, absolutely. And it's been a very big challenge for the industry overall, navigating that transition from the traditional distribution through cable to all this streaming stuff. So we'll have to see how that plays out for both of these companies. Paramount might be as soon as this week. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. 3M said it's cutting its dividend for the first time after 6 decades of hikes, but shares are higher this morning. Bloomberg's Abigail Doolittle explains why.
In this case, it may show some sort of fiscal responsibility because they did spin out their healthcare unit about a month ago, and most of the free cash flow, or about 30% of the free cash flow, I should say, past free cash flow, came from that healthcare unit. Relative to the dividend in the past, it's been 60% of their adjusted free cash flow. They're now reducing it to 40%.
And shares are up 5%. Eli Lilly shares, they're higher. They're up 5% as well. The company raised its annual outlook for sales, profit, as demand for its weight loss and diabetes drug, well, they continue to soar. Then we have fintech company PayPal reported total payment volume for the first quarter beat estimates, and that has shares up more than 3%. To Coca-Cola issued a more optimistic 2024 forecast. Its first quarter results beat estimates. Coca-Cola right now is little change. But meanwhile, McDonald's, their results missed estimates in the first quarter. But it also said it's testing out a bigger burger this year. Just what we need. Shares are up 1%. And after the close, all eyes will be on Amazon. It's after we saw strong earnings from the likes of Microsoft, Alphabet last week. Bloomberg's Alex Webb says the focus will be on Amazon Web Services, cloud business, where it uses generative AI.
Microsoft and Google have both enjoyed tailwinds from that AI business in their cloud operations. The question now is whether they are taking share from Amazon or whether Amazon is enjoying comparable gains.
Amazon down just a fraction. And Tesla reportedly kicking off another round of layoffs. The information reporting Elon Musk plans to cut hundreds of jobs as 2 more top executives leave the company, shares down about 4%. That's your company news at this hour. I'm Lisa Mateo.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. We are live from Interactive Broker Studio right here in the cloudy Midtown Manhattan. We made it to Tuesday. We are covering all the top news for you. We get great analysis from our Bloomberg Intelligence analysts. They cover 2,000 companies, 130 industries worldwide. We also get you updated on all the world and national news. And for that, we go to John Tucker.
All right, thanks to Alex and Paul. Donald Trump found in contempt of court today. Let's get details in this late-breaking report from Bloomberg's Jeff Bellinger.
The former president was fined $9,000 after the New York judge overseeing his criminal hush money case ruled Trump repeatedly blasted key trial witnesses on social media in violation of a gag order. New York Judge Juan Merchan issued his ruling after prosecutors argued Trump had repeatedly posted on social media about adult film star Stormy Daniels and ex-Trump lawyer Michael Cohen, both key witnesses in the case against him. Trump was fined $1,000 for each of 9 violations. In New York, Jeff Bellinger, Bloomberg News.
In an extensive interview with Time magazine, the former president said he'd leave it up to the states to decide whether or not they want to monitor women's pregnancies to see if they get abortions and then get prosecuted. Mr. Trump added it's irrelevant whether he's comfortable with what the states decide. The former president has previously said it's a states' rights issue when asked if doctors should be punished for performing abortions. And colleges from Columbia to UCLA rushing to confront pro-Palestinian demonstrations, with disciplinary actions escalating and campus life thrown into turmoil as the academic year comes to a close. At Columbia, dozens of students entered a campus building known as Hamilton Hall after midnight. They barricaded themselves inside. At Yale, the late word is that police have been called in to clear a protest encampment. And the Environmental Protection Agency said this morning it's finalized a ban on consumer uses of methylene chloride. This is a chemical that's widely used as paint stripper, but it's also known to cause liver cancer and other health problems. EPA says the actions will protect Americans from health risks while allowing certain commercial uses to continue with robust worker protections. Global news 24 hours a day, and whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Paul and Alex.
Thank you so much, John Tucker. Let's stay with college for a second, because apparently tomorrow is May 1st.
Oh.
That's the deadline for a lot of colleges, for seniors to pick a college. I don't think it's the only one, right? But it's like the big one. The
Yeah,
big
depends
first
on
one.
what.
Right.
Yeah.
So
ED, ED1, ED2, you know, all that kind of stuff.
And they make the point in this article on Bloomberg that for the brightest students across America, it's easy, right? Go to the best college, don't worry about the cost. but the cost now is so high, and there's a greater awareness of the burden of student debt that now people are actually doing the crazy thing of turning down an Ivy to go to a school where they get a free ride.
Yeah.
I don't know. That makes sense, doesn't it?
I mean, it does. I'd have to really do the math because I just, I don't think anybody questions the value of an Ivy League education in terms of what it provides for you. Now you just have to pair that, or I guess compare that against the cost today. And if you can get, obviously not a comparable, but a very good education at a much lower cost, then you have to do that math, I guess, for a lot of people.
You also now have to throw in the calculus of the protests at universities. Whereas we approach the end of the year, you can't even go to graduation at some of these places.
Yeah, which is unthinkable.
Yeah, and I was speaking to somebody who is sort of in academia saying that a lot of kids now are also rethinking where they're applying based on the protests too, which is also shifting kind of Ivy or not. We did a great piece. I think you were actually on your vacation about the ROI.
One of my many vacations.
Of going, the ROI of going to college and where, right?
Yeah.
Clearly it depends on your major, so put that aside for a second. That the ROI for the Ivies is still best, but after that, it's like a state school. That the ROIs of those small liberal arts colleges is just not great at the end of the day.
One of my offspring, Penn State Engineering, great job. Other one, Colorado, great job. So I don't know.
Right.
NYU,
Again, it
job.
depends on your major, right?
Depends,
Like engineering, huge. That's going to be helpful.
And they're going to pay you back, right?
Oh yeah, of course. They're paying me back just every day.
I mean,
Exactly.
I majored in theater, so go me. She says while she's on radio. All right, more coming up in the next hour. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we started off strong. Gene Munster, managing partner at Deepwater Asset Management. He is our go-to guy on all these big tech companies. We'll get a preview of Amazon. They report after the close tonight, and Apple after the close Thursday. We're going to check in with Michael Halen, Bloomberg Intelligence. He covers all the restaurants and food services. And we're going to talk about McDonald's. What's up with that new bigger hamburger? I think that might be interesting. And whatever happened to like the fake beef that's not a thing anymore, right?
No, it's there. It's still there. Impossible Burger, it's still a thing.
Okay,
yeah, it's just
They
not
say-
necessarily healthy for you. It still has stuff in it. It's just not meat.
They sell about one a week.
Yeah, I see like a little display in the corner of the supermarket, so I don't think it's so much of a thing anymore. Anyway, all that's coming up. But let's kick it all off with Mr. Charlie Pellet.
Thank you very much, and here's what's going on. We are looking at a down day for the Dow, the S&P, NASDAQ 100 index. Throw in the Russell 2000 as well. A lot of red on the screen ahead of the Fed decision tomorrow, Jobs Friday. This Bloomberg Business Flash brought to you by BNY Mellon Insight. June 4th to the 6th in Nashville, Tennessee. Don't miss this essential event for the financial advice community. Visit insight.bnymellon.com. Right now, we have got the Dow down 157 points, a drop there of 0.4%. S&P 500 index down 16 at 5,099, a drop right now of 0.1%. NASDAQ lower now by 66 points, a decline now of just about 0.4%. 10-year 4.66% with a 2-year 5.01%. Spot gold now down 1.5%. Gold 22.93, and West Texas Intermediate crude down 1.2%, 81.39 for a barrel of WTI. So next up for Wall Street, tomorrow's Fed decision and Jay Powell's news conference. But Victoria Fernandez, chief market strategist at Crossmark Global Investments, told Bloomberg Intelligence this morning she's looking ahead to the jobs report.
We don't think the Fed is going to announce anything groundbreaking this week, so that's why we're already looking forward to Friday to see what happens in that labor report. And look, there can be a lot of seasonality. The birth death rate has adjusted some of the numbers. People are a little leery of is the labor market as strong as these numbers say it is?
And you can hear more of the conversation with Crossmark's Victoria Fernandez on the Bloomberg Intelligence podcast. You can download it wherever you get your podcasts. Again, Amazon, after the close of trading, will be all over that report when it breaks. Amazon down now by 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so very much. I'm Alex Steele alongside Paul Sweeney. So just to recap from our last hour, I was a theater major. John Tucker majored in science. Paul Sweeney? Business. Business. Yet we're all here talking on radio. I don't know what this means. This probably means something. Jess Menton joins us now. She covers equities for Bloomberg. You, what was your major?
I did communications and I did business.
Okay, so her trajectory makes sense.
Yes.
The rest of us, not the only one. The rest of us, not so much. Especially John Tucker with science. We got to dig into that a little bit.
I think also he told us once, Paul, that his dad was a dentist and he was supposed to take over the practice, and then he did some sort of internship.
Yeah.
And look at him now, though.
Look at him now.
A living
Look at him now.
legend of Bloomberg Radio.
Proving everybody wrong with that science degree. We're also looking at a market here that is definitely trading a little bit heavy. It's the last day of April. Lots of earnings rolling in. What stands out to you, Jess?
Well, I wanted to point out Coca-Cola. The ticker symbol on this is KO. Even though it's down about 0.2%, its sales did beat estimates, but it did happen on price increases. And the reason I want to bring it up is I did interview Tom Barkin recently, and something that he looks at closely, not surprisingly, it's price to mix in relation to what that means to volume. So if we are going to different grocery stores, and a lot of times we might not have, especially in the last couple of years, just given the dynamic with COVID and the pandemic and then obviously inflation, seeing different sales going on with more items. And so basically Jen Bartashis over at Bloomberg Intelligence, one of your buddies, of course, Paul, she was talking about recently how she thinks that when it comes to companies, and specifically consumer packaged good companies like General Mills, J.M. Smucker, Conagra, and others like that, will have to use basically low-cost promotions in the first half of this year, and then probably in the second half as well, to really entice shoppers to end up buying more, just because of the volume type issues that they've had. So this is really when you're looking at through the lens of a Coca-Cola. And then also we actually have PepsiCo's annual meeting is tomorrow morning. So that's something that's interesting too, because you have a rival company like that. Obviously, when you think of diversity and diversifying more when it comes to the foods division and PepsiCo, it's a little bit different than when you're thinking about Coca-Cola, especially with PepsiCo being anchored by snack and breakfast brands like Doritos and Quaker Oats.
Coke versus Pepsi, go.
Oh, well, definitely Coke.
I actually like Pepsi.
Because you're from Texas.
That's right.
Yes.
Well, Dr. Pepper,
Yes.
of course, is
Dr.
reigns
Pepper.
supreme down there.
Because
But
Pepsi, I think, is more of a, they might have a little bit stronger position in the South.
That's right.
They defined.
So
And I was told that was because it's a little sweeter. I don't know.
yeah.
Interesting. Fun fact. On vacation, my daughter had her first Coca-Cola.
Really?
Yeah, and
You
it was
guys
like,
broke down.
what? Well, I was like, okay, if I'm gonna have a Prosecco, you can have a Coca-Cola. I don't drink
I like
much
that.
anymore. That makes sense. And her whole face was like, what is this beauteous thing that I'm drinking?
Now, I am Coke versus Pepsi, but if you put a Pepsi in front of me, I'm equally as happy. I could care
I think
less.
that's
I
fine.
don't
So
have
in the
broad
Sweeney
strands.
compound, you load up with Coca-Cola.
Coke's in there, yeah, along with
Okay.
the Budweiser in cans.
Budweiser, of course.
In cans.
It's important. Are you looking at 3M also?
Yes. So MMM is the ticker symbol on this, up about 0.5%. If you look at intraday trading, the reason I wanted to point it out is it was actually trading above its 52-week high intraday. So looking at what's happening with this particular company, obviously industrial type firm, it's planning to cut its dividend. It actually ended more than 6 decades of boosting the payout each year. So it is entering this new era following the spinoff of its healthcare products division. So when you are looking at more of a bright spot in today's kind of lackluster session, 3M is one of those names.
Okay. E-Lilly, is it all just the weight loss drug? I mean,
yes.
That's a gift that keeps on giving, and
Because
will for
that's
a while.
what everybody wanted to know. I know Romain over in TV keeps a close eye on these. He always jokes about it when we're on the simulcast, as Alex knows about these. But he always talks about that. But looking at this, it's really driven by its obesity and diabetes drugs. So, of course, Eli Lilly, LLL is the ticker symbol on this, up about 6% today. So this is the world's biggest healthcare company by market value, and it actually overtook United Health last summer when you are looking at basically by market market cap. So investors really wanted to see how fast sales of its obesity drugs and diabetes drugs were going to climb. So when you're looking at this, the stock has actually nearly doubled over the past 12 months. And then also the A&R function, something I know Paul likes to keep a close eye on. 22 buys, 6 holds, and 1 sell on this stock.
Interesting. All right, great stuff. Jess Metton, thank you so much for joining us. Jess Metton covers equities for Bloomberg News. Appreciate getting the update here. S&P 500 off 0.4%. Smack dab in the middle of earnings. And right now we're getting through the tech earnings, and it is a big week here next couple of days. Today after the close, Amazon set the report, and then Thursday after the close, we'll hear from our good friends at Apple. Walk us through what are some of the key issues that we need to focus on, that the market needs to focus on, is Gene Munster. Gene Munster is the managing partner, co-founder of Deepwater Asset Management. He's been covering Silicon Valley for decades. He is absolutely a go-to voice. We appreciate getting a few minutes of his time. Hey, Gene, let's start with Amazon. I guess it's all about the cloud, isn't it?
Indeed, Paul. The cloud AWS is expected to continue to accelerate. So just taking a couple steps back, AWS growth over the past year and a half has been declining from high 20%, and then it bottomed at 12% in the September quarter, bumped up to 13% year-over-year growth in December, and expectations in print are for 15% year-over-year growth in March. I mentioned and emphasized the word print there because the whisper numbers have been stoked after Azure and Google Cloud reported last week. And of course, they had upside to their cloud numbers. I suspect that the whisper number is 16% plus. In other words, if they print a 16% growth up from 13 in December, that may be viewed as a slight disappointment. A couple other just quick, really important parts related to the whole AWS conversation. As a reminder, this is 17% of Amazon's revenue and about 67%, this is for calendar 23, of their earnings. So it punches above its weight when it comes to profitability, and that's why investors are so hyper-focused. And when you put all this together, Paul, what you have is a picture where AWS, with leading market share, continues to lose market share. I mentioned that 16% whisper number. If they deliver on that, they're growing at half the rate that Azure and Google Cloud are growing. So this dynamic it will post an improvement undoubtedly in AWS growth, but still the broader picture around the future of AWS, not the future, but the future market share, is still in question, as Google and Microsoft are really benefiting from how much they've been investing in AI, and that has been powering their cloud business faster than Amazon.
Folks, I've seen this time and time again. When Gene Munster speaks, people take notes. Alex Steele has been writing furiously over here, listening to Gene.
It's so true. I'm like, oh, I got to break Amazon after the bell, so let me really pay attention here. So if you go back to the AWS growth, why? Why did we see that decline in growth? And do we expect them at some point to get back up to 20 and then grow from there? Or is it now going to be in some kind of range?
So during that period of, call it high 20s to that 12%, Azure showed some also deceleration from mid-30s down to high 20s. Google Cloud from around 30 down to low 20s. And so it was just a kind of a broader corporate pullback in cloud spending, I think had part of it. But I think the other part was this piece around what's going on the model front. And specifically, of course, with Azure, they've got the integration with OpenAI's models, with Google, their own DeepMind, and what they've done with Gemini and building those models into their cloud offerings. And when it comes to Amazon, they do have an offering. It is related to Anthropic. They also host a lot of the kind of open source models like Llama, but I think that has played into it. So, Alex, to put it in a perspective, I think that half of the decline has been that we saw earlier was because of the broader market, corporate spending, and I think half is because I think that their AI strategy, well, it is forward thinking, still lacks some of the punch that Azure and Google Cloud is integrating.
So, Gene, this company has certainly evolved over the years that at least you and I have covered it. How do investors view this company right now? Like how do they think about the retail business? Do they just kind of put a relatively low multiple on it and kind of really just focus on the cloud?
Tonight it is all about the cloud. I think that that is the central takeaway. I think that beyond this, we are seeing an improvement in some of the metrics around the retail business. And this, of course, is the vast majority of their sales. And the profitability is starting to move in the right direction. And part of that is because of how they've improved the logistics. Some of those have been more recently related to AI in terms of the planning. Some of it's just been good old-fashioned algorithms that make their delivery more efficient. But the retail opportunity I see is kind of a changing of the guard in the Amazon story over the next couple of years. I think investors will progressively focus more on that business. I mentioned today almost 70% of Amazon's earnings come from AWS, and I think that number is going to continue to decline going forward because I think the retail business is going to improve, and the substance of the improvement is better efficiency at logistics. Of course, this is real AI. It's not hype. It's real. And second is related to robotics. It's something that they've done, this Kiva acquisition a long time ago. That's the start to it, but they have a profound opportunity in terms of integrating robotics over the next decade into logistics, which would have a positive impact on earnings. So I do think that we will see the baton switch over the next couple of years in terms of the pressure point. We will be talking about AWS, but it won't be the center focus.
All right, so I feel like I'm relatively prepped now.
Nice.
To break those earnings.
Time well spent.
So can you prep us for Apple on Thursday?
For sure. I think Apple's going to be much more exciting in terms of kind of what the investor reaction is going to be, because the setup we have is pretty well known that the business has been slow. The expectations, their guidance was for revenue to be down 5% year over year, and that's generally where analysts are at. The iPhone segment, analysts are expecting it to be down 10%. And if you take a step back over the last few years, it's continued to be flat to downish, the iPhone. In particular, China is a weakness. I just want to call out that's one of the key metrics that investors are going to be focusing on. In September, the China business was down 3%. In December, down 10%. And I believe that it's going to be down, call it around 13 to 15% in the March quarter. So continued softness in China. That's about 20% of Apple's overall revenue. So that's going to be one of the themes. The second theme, of course, is going to be related to when the bottom of the cycle happens. And I think they will give softish guidance for the June quarter. But the stock may actually react positive to that, because once they've got that negative guidance in, then investors can start to look to the back half of the year. Of course, the new iPhone cycle comes. That will probably have some AI branding around it, and that we should start to see some reacceleration. So the irony of this print is the weak March quarter, punky guidance for June might actually kind of mark the bottom. One last piece, of course, I buried the lead related to AI. This we're going to hear a lot more in the beginning of June at their developer conference. And I think that there is a piece around this on CapEx. Of course, that was a hot topic last week. Apple is yet to talk about CapEx, any big uptake in CapEx. They stand alone amongst big tech. And I think this is going to be a quarter where investors get some medicine when it comes to Apple and how they are going to be spending in CapEx. If, in fact, Apple wants to participate in AI, which it sounds like they want to, it's going to require a significant uptake in CapEx, and that potentially could be at the cost of margins, a couple percent in margin. So that's the piece I'm bracing for, is what their commentary on CapEx is related to generative AI.
Are you surprised, Gene, that we haven't seen a more aggressive move on AI from Apple?
Absolutely. I mean, their silence to date, it's more recently, they've said more, but has been deafening, at least in 2023. And I think that they've got a golden opportunity here. They have a brand around privacy. The current stage of AI that we're operating in is generative AI, where we prompt a model, it gets back, we can have a conversation. The next phase, and it won't be products today with Apple, but I think ultimately where they're going to go is what's referred to as agentic or agent or personalized AI. You'll hear those terms interchanged. But this is the idea of AI actually completing a task for you instead of just responding in part to a conversation. And again, because I think what Apple does around privacy, I think they're going to have an invitation for consumers really to build some unique products around agentic AI down the road.
All right, Gene, thanks so much for your time. Really appreciate it. Gene Munster, managing partner, co-founder of Deepwater Asset Management, give us a preview here for Amazon tonight after the close and Apple reporting their results Thursday after the close. Coming up, we're going to check in with Michael Hallam, Bloomberg Intelligence Senior Restaurant and Food Service Analyst, talk about McDonald's. They had some earnings, talking also about a bigger burger. That got my attention. Plus, we're going to have a simulcast with Bloomberg Television. John Rogers, Chairman, co-CEO, CIO, and founder at Ariel Investments, is going to speak with Bloomberg's Ed Ludlow and Caroline Hyde. It's interesting to see what Mr. Rogers has to say about this market. He has tremendous amounts of perspective and experience in these markets. Get his thoughts about where we're going in the investment markets, broadly defined. So that'll be coming up at the bottom of the hour. S&P 500 off 0.6%. We're plumbing some new lows here. NASDAQ off about 0.75%. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We are just about at the lows of the morning right now. The S&P 500 index down 31, drop there of 0.6%. Stocks under renewed pressure after this morning's economic data, with the Dow down 288 points, down 0.7%. The Nasdaq Composite Index down 114, a drop there of 0.7%. 10-year ahead of the Fed, 4.65%. 2-year, 5.01% on that 2-year right now. We do have spot gold down $17 the ounce, down 1.6%. West Texas Intermediate crude down 0.9%. Lots of news out of Walmart. Among the headlines this morning, Walmart abandoning its plan to build out a network of low-cost health clinics due to escalating costs and reimbursement challenges. Walmart shares today, they're down 1.3%. Recapping, worth repeating, that 2-year, 5.01% on the 2-year. S&P down 32, drop there of 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you very much. I'm Alex Steele. Here alongside Paul Sweeney, we are live from Interactive Broker Studio right here in Midtown Manhattan. This is Bloomberg Intelligence Radio. We cover all the news for you, all the top news for you, with our amazing analysts worldwide. They cover about 2,000 companies and 130 industries. So let's get to one of them right now. Look at McDonald's stock, doing a whole lot of nothing. It was down earlier today. It has slight miss on earnings per share, and their comp sales, particularly international, missed estimates. But the big news everyone seems so excited about is this biggest burger thing. They're going to test it to try and spark some traffic growth.
Test it right here. Let's bring it.
I mean, okay, just buy 2 of them. Anyway, let's get more details on this with Michael Halen. He is a Bloomberg Intelligence Senior Restaurant and Food Service Analyst, and he joins us now. Okay, let's just kiss off the earnings before we get to this big burger thing. What was your biggest takeaway?
I'd say the biggest takeaway was, the fact that April's flat so far in the United States. That's trailing the industry level, the industry data that we get. So, and also, Restaurant Brands reported this morning, and Burger King showed an acceleration in the U.S. in their U.S. numbers. So I would say that was the biggest surprise. McDonald's still on a 5-year trend is vastly outperforming Burger King and most of the other quick service names. But there seems to be some slowing. If I was to guess, some of that bad press around the $18 Big Mac meal in some markets, could be hurting, because we are seeing U.S. consumers really push back against price increases right now, and they're being more picky about where they spend their money.
Mike, I see just in the Bloomberg reporting here, executives have also said that low-income consumers in the U.S., which is an important part of the company's customer base, are pulling back. Does that mean we're going to see more promotions, which might put pressure on the margins?
Yeah, we see. McDonald's has come out and said they're going to focus more on their value menu. They're going to continue to offer promotions, a lot of them through the apps. So it looks like a full-on value war is here. I mean, Burger King said they're going to be a little bit more careful than they've been in the past with their price increases, because they've had some increases over the last 5 years or so. So Burger King's gonna be a little bit more careful with their discounting because in the last 5 years or so, they've gotten too aggressive and it hurt franchisee margins. So they kind of poo-pooed that a little bit, but we think a full-blown value war is here, and it's on the table for 2024.
So does the value war take into account a bigger burger? Is that the deal?
Well, value, it's measured in a couple ways. It's not just the price, but it's what you get for the price, right? And so, I'm sure McDonald's has done their legwork, and they have some customer feedback that says that they want some bigger burgers on their menu, and so that's going to be interesting. They said they're going to start testing it in the second half of this year, so it may not hit the United States for quite some time.
Sorry.
But yeah, there's a couple ways to measure value.
Hey, Mike, what are the McDonald's of the world and the other restaurant companies you talk to? What are they saying about these GLP-1 drugs? Are they really going to impact their business?
I don't think there's too much worry about that anymore. I know that was a big thing last summer and into the fall, and it really impacted the prices of some of these quick service restaurant chain stocks, especially McDonald's. But, I've seen a lot of different reports out there, and the amount of people on these drugs ranges from, 7 to 12 or maybe 15% best case if once they get to like maybe a pill form instead of a shot. You know, and we don't know about long-term side effects from some of these drugs. So I think initially there was some concern, but over time, McDonald's and these other chains, they're going to figure out how to make a 7 to 12% smaller cheeseburger, right? They're getting smaller anyway because beef prices are going up. And, you know, there's a historical situation in the cattle market right now. And so beef prices are going to continue to stay elevated here for a couple of years. And so chains are already starting to try to, you know, solve for some of these problems, you know, ahead of broader adoption. Of
I mean, you have to think that shrinkflation is going to hit in many different ways. But before we let you go, we have about a minute left. So who wins the value war right now, based on what you've seen?
Well, it's interesting because, you know, McDonald's historically has. And so that's what's most interesting about them underperforming in April. Burger King is an interesting one because, you know, they have easier comps. They struggled coming out of the pandemic for a few years, right? And so they have easier comparisons to lap lower average unit volumes at the store level. And so there's room for some upside there. Chipotle absolutely continues to knock the cover off the ball. And, you know, McDonald's has scale, right? And so when they really start pushing on value, everyone else is going to feel it. So you know, I'm confident that McDonald's can kind of turn the tide here a little bit because they can just offer burgers and other items at prices their competitors just can't match.
All right, Michael. Great stuff as always. Mike Halen, he's a senior restaurant and food service analyst at Bloomberg Intelligence. McDonald's putting out some numbers a little bit disappointing. The stock kind of flat here today. Maybe talking about just kind of where the demand is or where some of their customers are facing some pressure. So how promotional do you need to be and how innovative do you need to be in products, you know? I don't know.
You just already said, right? I mean, he likes Chipotle.
I get the same thing today that I got when I was like 15.
Which is?
A number 2 with a Coke. It's like a quarter pounder or something with cheese.
Okay. And can you offer the price for that? Like,
I don't know. I don't even know. No, but I'm sure the price is going up dramatically. So, but we'll have to see. But it still works. But I only do it once or twice a year, so who cares? All right, coming up, John Rogers. He's the chairman. He's the co-CEO, CIO, and founder at Ariel Investment Management. Speaking with Bloomberg's Ed Ludlow and Caroline Hyde, talk about the future of his firm and investing these days. Ed Ludlow, Caroline Hyde. Let's listen in.
We welcome now our Bloomberg TV and radio audiences worldwide to discuss what is occurring at Paramount. Currently, we'll shine a light on how shares have been trading lower after, well, first quarter earnings actually beat expectations. But what's actually taken the focus of Wall Street is the CEO, Bob Bakish, stepping down, being replaced by a trio of executives now being depended on seemingly on an interim basis to lead Paramount amid what seems to be ongoing speculation of a deal with Skydance. We want to get to a key long-term investor in Paramount who's been in the name since 2006, who believes in the streaming opportunity and the value of its content. It's John Rogers, Ariel Investments founder, co-CEO. You've been throughout this business in its many iterations. And I just want to focus first, John, on yesterday, growth being borne out, being shown by the business, particularly in its streaming, thanks in many ways to the Super Bowl, but it was overshadowed by the departure of Bob Bakish. What did you make of the move?
It was pretty shocking to us. You know, Ariel's been in business for 41 years. We've not seen anything remotely like this. It's just extraordinary. And it can't be good for shareholders to be able to have all this uncertainty at earnings season. You're in the middle of a merger and acquisition transaction. You're negotiating with Charter Communications. All these important things are happening all at once, and you need the CEO in place. So this has just been very, very disappointing, disheartening, and it also in the context of what you said. Business has been getting better. A lot of the initiatives that Bob and his executive team have worked on are really starting to show fruition. So the timing just seems extremely, extremely problematic.
Let's just talk about probably why Bob Bakish has exited. And it's because he felt that the negotiations reportedly underway with Skydance were not within his agreement. Now, Sherry Redstone is a controlling shareholder at the moment with, of course, National Amusements. It seems to be the deal that she's looking for with Skydance. How are you currently dealing with the reports of a so-called sweetened deal? What would you make of a combination of Paramount with Skydance?
Well, we don't know enough. We've read all the same, pieces that have been written about this, and institutions like Puck have had really good information that we've had confirmed. And so if this transaction really is focused on Skydance, we think that may possibly have a chance to work, but we really would much rather see the Apollo deal with Sony that's been so rumored to be out there to get certainty of, Apollo's a world-class firm with extraordinary resources. Sony has proven to be so successful, in this industry. That seems like a marriage made in heaven. And so we wouldn't rush to the altar with a smaller company that's not as proven as Apollo and Sony.
John, good morning. It's Ed in San Francisco. Do you get any sense, because you've held this idea that we should look at other offers on the table for a while. Do you still hold that belief, but actually the hope that other offers will be looked at?
Well, that's what we hear. We had a lot of confidence in management. It's been nothing but straightforward and candid with us, that they cared about all shareholders. And, as you know, the employee bases all own the secondary shares. So we really have been very, very hopeful that they were going to do the right thing for shareholders. And that's been something that's been committed to us consistently. And we believe them. And we just continue to think that you don't need to rush. When things are going well, this is not a melting ice cube. This is a company in recovery, in a turnaround mode. And we want to make sure that all shareholders get to be able to take advantage of that. And the price that Skydance is suggesting seems to us, from what we've read, much lower than what we would get from the Apollo-Sony deal, and many others that could possibly be out there if this company was truly shopped around. And the final thing I would say is the directors, we know several as independent directors, and we know that they're committed to doing what's fair for all shareholders. So I'm hoping they'll be able to get to the finish line.
John, what does a change of ownership structure or this M&A path fix for Paramount?
Well, I think that with Apollo and Sony, you would end up with enormous resources that would help them with their balance sheet that has, gotten higher than we would have hoped. You'll be able, if you're working with Sony's been an expert at being an arms dealer, being able to use content in ways to generate cash flow and profits, and have the extraordinary library that Paramount brings, the history of Paramount's lot, where they have been able to make movies for generations, and there'll be enormous synergies. I think the synergies between Sony and Paramount are much, much greater than you can imagine with a smaller company like Skydance. So we're really hopeful that you'd be able to get great synergies, higher cash flow, and an experienced management team that will be able to make those tough calls of what happens with Paramount Plus. How much do you use content there? How do you use it in selling it to other competing services like Netflix? We want that kind of experienced leadership that has been proven. And I know there are some other large streamers out there that could possibly also get into the mix.
We are, of course, with John Rogers of Ariel Investments, founder, co-CEO to our radio and TV audience. John, regulatory issues, though, with both potential tie-ups. Is that a concern for you?
I think it's a modest concern for the real large guys that are out there. I understand that people would be worried if Netflix, for example, was to buy Paramount Global. But ultimately, I think if people are really looking at this for the long run, there's been lots of litigation around some of the regulatory constraints that are out there in today's economic system. I think ultimately rational people will see, do you want to see Paramount Plus collapse? Do you want to see all those jobs lost? Do you want to see a world-class American company in disarray? Or do you want to see it find a great parent where they can merge and have a successful, growing business over the next decade or so? So I think I'm hopeful that regulators will be able to make the right decision, have an open mind about all the various different possible combinations that are out there. And I certainly think the Apollo Sony deal should not have any significant regulatory concerns.
John, you've written to your own investors in your Q1 report, really saying, look, you're not an activist investor, but you feel it's your fiduciary duty to raise concerns, particularly from a corporate governance perspective here. And I want to go back to the fact that you have held this stock throughout these iterations, and you've seen the fact that there was this controlling shareholder. Did you sort of worry this might ever evolve from this corporate governance structure? Particularly, your worry was the fact that 3 independent board members have recently stepped down amid this M&A speculation.
You know, over the years, as I've mentioned, you know, over the 41 years, we've not seen anything like this. I've never, in all the years of owning stocks that have dual class shares, I've never seen a scenario where the A shareholders were going to get a significantly larger premium than the B shareholders. And that's just something we've never seen before. And there's been a lot of smart investors. It's, you know, factual over the years. You know, Warren Buffett's been a shareholder. We know Mario Gabelli, my friend Mario's been a shareholder. We had several good, smart people looking at this. And we've always felt that people would do the rational thing and do the right thing for all shareholders. That's what management's told us. Frankly, that's what Sherry has said over time. And so we think that this is something that came as a real, true surprise. And it's something, again, like we've never seen before.
John, I watch the Masters on Paramount Plus. I get my Champions League football through Paramount Plus. I liked Halo. What is it that you like about Paramount's existing portfolio and offering?
Well, you started at the right place. They have extraordinary content that you must see. The Super Bowl, had great ratings. Grammys were great. You mentioned the Masters. They've got great scripted shows. The CSI franchise. The news franchise, CBS Sunday Morning, 60 Minutes, CBS Evening News, and this robust history. But then you put on top of it this extraordinary library with, the Paramount greats, Mission Impossible and The Godfather. You could go on and on and on. They've got Pluto, which is an extremely successful streaming service. You've got worldwide assets that Bob Bakish used to run that are extremely valuable and seem to get ignored by the analyst community and the value that's there. So they have a well-diversified group of assets, many hidden assets, real estate that hasn't completely been utilized, institutions like Showtime and BET that I wish they had found a way to have sold earlier. But these are real, true assets to this company. And I think sometimes people get into the groupthink of the moment. They're worried about the cord cutting, and they're forgetting to value all of the assets that Paramount Global has.
You're a value investor. You look at the value.
Yes.
John, you also say you don't sell into chaos. What do you do, though, if a deal with Skydance goes ahead?
Well, we've been looking at all of our options. We did write a letter to the board of directors explaining our position. We've been, of course, talking to expert legal counsel, and our general counsel is terrific, and she's been on top of those issues. So we're looking at all of our alternatives, and we'll see how this all plays out. But we would like to see this play out in a way that is very constructive, because it would be not a good thing for a Skydance to be trying to buy a company where you're in litigation with all your shareholders, or many of your shareholders, I should say, many of your shareholders, and at the same time, your senior management's not going to be happy if the deal isn't fair for the B shareholders. That's what the management team owns. And as we all know, M&A is difficult in the best of circumstances, getting all the synergies done and all the tough calls that have to be made. And it would be a difficult environment, I think, for them to be able to be successful while you could have such a cleaner deal with an extraordinary company like Apollo and Sony.
John Rogers, Ariel Investments founder and co-CEO, grateful for your time. Thank you.
That was John Rogers, again, Ariel CEO, speaking with Ed Ludlow and Caroline Hyde. A fascinating discussion, I thought, focusing on Paramount. They are the 12th largest shareholder, about 11 million shares. So what came across to me, Alex, not real happy with what's going on at Paramount, not happy necessarily with the ouster of Bob Bakish, maybe the preference for the ByteDance transaction, which would potentially reward Sherry Redstone and the controlled shareholders with a really significant premium versus the non-voting shareholders, or the one share, one vote shareholders. So again, very interesting, his take there, and you wonder how prevalent that is among the big shareholders.
So here's my question that I feel like only Paul can help me answer. If you're buying the B-class shares, don't you know that you're basically a second-class citizen when it comes to shareholder value? So why is it a big surprise that the premium is there?
Typically, as John Rogers said, typically they went in there eyes wide open. Most media companies, many technology companies have dual class shares for editorial independence purposes. And you do expect to potentially see the control shareholders get a premium, just not this to this degree. And so it's really just the magnitude here. So that's kind of what we're hearing from. So fascinating interview. They made news on that interview, folks. All right, let's get a reset here. We'll go to Charlie Pellet for a Bloomberg Business Flash.
All right, thank you very much, Paul. We have got red on the screen, the Dow, the S&P, NASDAQ, all declining. Paramount stock we were just listening to a conversation about, down 3.9% right now. So Paramount Global moving lower today. The S&P trading down by 38 points. We have got the Dow lower by 322. For the Dow, down by 0.8%. The S&P also down 0.8%. NASDAQ Composite Index right now down 145 points, a decline there of 0.9. 10-year 4.66% with a 2-year 5.00%. Spot gold moving lower by $38 the ounce, now down 1.7%. Gold at $22.96, back below 2,300. And West Texas Intermediate crude holding around $82 a barrel, down today by 0.5%, 82.17 right now on WTI. Federal Reserve has opened its two-day meeting with a fresh set of data suggesting inflation lingers. And with that story, here's Bloomberg's Vinny Del Giudice.
The Labor Department reports U.S. employment costs rose by the most in a year. The data cover the first quarter. Bloomberg Economics says the report provides one more reason for the Fed to take a more hawkish tilt toward inflation. That would reverse Fed Chair Jerome Powell's dovish pivot last year. The Fed's interest rate target is currently at a two-decade high. No change is anticipated this week. Vinny Del Giudice, Bloomberg Radio.
On a down day for the Dow Jones Industrial Average, 3M shares are advancing. 3M planning to slash its dividend, ending more than 6 decades of boosting the payout each year. 3M shares up now by 4%. Recapping the 2-year 5.00%, S&P down 38, drop there of 0.7. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so very much. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We keep you updated on all the news that you need. We are live from Interactive Broker Studio right here in Midtown Manhattan. And Bloomberg Television and Radio is also now live at Columbia University. Here is the latest. Student demonstrators barricaded themselves into a campus building at Columbia. They are occupying Hamilton Hall after Columbia has now begun suspensions of those who are still involved within the protests. We're also seeing something similar at Yale. The police were called in to clear an encampment that protesters are vowing to reoccupy. All of this really putting pressure on leadership at elite American universities as the time ticks towards that college admission date of tomorrow, May 1st. Scarlet Fu. I've known Scarlett for like 15 years. But Scarlet Fu, Bloomberg Television and Radio anchor, is standing by from Columbia University. Scarlett, you're in Amsterdam. Talk me through, and for our radio audience, what you're seeing as you're there.
Well, there's a lot of media here, and there aren't a lot of students or faculty walking around, and that's in part because of the fact that the spring semester has largely ended. Classes have finished for the semester, and right now they're in study period, and finals begin on Friday. And then, of course, there's